I'm Brian Sozzi. Welcome to Yahoo Finance Live. As you can see, still broadcast comfy confines of my home like the rest of the Yahoo Finance Live team. You awake to a market in a little bit of a rally mode, what some people on the street are calling turnaround. Let's get right to our very own Emily McCormick, who has the latest on the stock futures. Emily, not always good to see a bit of a rebound here in this bear market.
Absolutely, Brian. So we did have stock futures for the S&P 500, Dow, and Nasdaq rallying about 5% during the overnight session, hitting that upper trading limit and being capped at those gains. We do see them pairing some of those gains now. We have the S&P 500 futures just up about 4%, but still in the green. So definitely a positive sign after the past couple sessions of losses. I want to point out a couple of stocks that we're watching, and one of those is Ford. So Ford just said today that it's working with General Electric's healthcare division along with 3M to help speed up production of ventilators for patients and respirators for healthcare workers as the coronavirus outbreak spreads. So in cooperation with the United Auto Workers Union, Ford is planning to assemble more than 100,000 plastic face shields per week at a Ford manufacturing site. This is just one of a number of automakers that have stepped up to the plate here. We had General Motors, GM, saying over the weekend that it's working with Ventec Life Systems to also manufacture ventilators at its auto part plants. We had Reuters reporting that the ultimate goal here is to build some 200,000 ventilators. And then earlier, we also had Tesla donating thousands of ventilators to California and also reportedly to Washington amid the coronavirus outbreak. This is coming as President Donald Trump said over the weekend. He really challenged these automakers to step up to the plate. He said in a Twitter post, quote, Ford, General Motors, and Tesla are being given the go-ahead to make ventilators and other metal products fast. FEMA, go for it, auto execs. Let's see how good you are, end quote. So definitely a call to action here from the highest levels of government, and automakers so far are stepping up to the plate. And we have those stocks up. Ford is up about 6% right now in the early trading.
Yeah, Emily, always good to see titans of industry, critical time. But switching gears, we had Twitter. Interesting release from them last night, what amounted to a pretty major earnings warning. Strange in the sense because the stock had been sent up. You would think a lot of people right now talking about coronavirus, stock should be moving a little bit higher, not exactly what Twitter had to say last night.
Definitely. So Twitter is one of the latest companies now to pull its first quarter guidance. It said it's withdrawing its revenue and operating income guidance for the first quarter amid the disruptions from the coronavirus outbreak. This is particularly because of some of the ad revenue that it's expecting to lose as major sports events, and now things like the Olympics even are being disrupted with this outbreak. So the company said in a statement, quote, while the near-term financial impact of this pandemic is rapidly evolving and difficult to measure based on current visibility, the company expects Q1 revenue to be down slightly on a year-over-year basis. Twitter also expects to incur a GAAP operating loss as reduced expenses resulting from COVID-19 disruption are unlikely to fully offset the revenue impact of the pandemic in Q1, end quote. Now, good to note here, though, that Twitter did have a good fourth quarter coming into the coronavirus outbreak. We do have shares up just about 1.8% in the pre-market, so trailing the broader S&P 500, but not showing declines in early trading. Brian?
All right, Emily McCormick, thanks so much. Let's get right to our very own Anjali Kemlani with the latest on the coronavirus. Anjali?
Thanks, Brian. Yeah, unfortunately, the news is not good. We still see those numbers continue to really spike around the world. We're nearing almost 400,000 cases. Easily will be reached pretty shortly. Meanwhile, in the US, we're well past 45,000 cases, on our way to 50,000. And we know that, unfortunately, New York State is really bearing the brunt of it, especially New York City. Looking at what that spread looks like, a lot of experts are saying it's very possible this virus was around a lot longer than when we were detecting. But detection is the key right now. We know that testing has been ramping up. Yesterday at the coronavirus White House task force meeting, briefing, Dr. Deborah Birx was saying with this testing that's coming online, we are seeing more and more cases, and we're waiting to see just where those hot spots are. We won't get that clear picture until the end of the week. Yesterday, the Centers for Medicare and Medicaid Services did say that they are ramping up targeted efforts to look at nursing homes and what they're doing to help avoid spreading the infection, because as we know, nursing homes have been disproportionately hit, and the elderly are also disproportionately affected as well. So still waiting to hear a little bit more about that and what those efforts will entail, but they are suspending regular inspections of the more than 15,000 nursing homes in the country right now, Brian.
Anjali, Alexis here. What are you hearing regarding President Trump wanting to reopen the economy, sort of relax or lift the stay-at-home order as early as next week? I know there are some in the medical field who say that is way too early, that he is putting American lives at risk, but President Trump is saying the American economy was built to be open, and so he wants to get it reopened as quickly as possible.
Absolutely. You did hear that yesterday, and you also heard many of the health experts say that it is not possible. Even non-health experts, people who are in the political sphere, are saying that they are concerned about that, and you cannot, in fact, do two things at once. As President Trump was saying, he was indicating that it is, in fact, possible to reopen the economy as well as curb the outbreak. As we know, hashtag flatten the curve is the trend right now, and we need to be paying attention to that. But health experts are saying that it is going to be impossible to achieve that if we do in fact reopen the economy. Related to that, actually, Wuhan, as we know, is going to be reopening on April 8th. So it seems really interesting that that's happening, and look at how long that took to get to where it is. And we know that with their, quote unquote, draconian measures is how they even got to the point where they can reopen the economy right now. Meanwhile, we still have a little bit of freedom with people moving around, so that may not achieve the optimal curving that we were looking for, flattening the curve that we're looking for. So it just remains to be seen really how this all pans out and what decision the president ultimately takes. He did indicate that he was looking at weeks, not months, in terms of a shutdown if need be. So again, we're waiting to hear what the final decision is.
Anjali Kamlani, thanks so much. Let's bring in Admiral James Stavridis, former NATO Supreme Allied Commander, and now an operating executive for our group. Admiral, thanks for taking some time here, a very critical moment in our country. Very curious on your thoughts on the best use of our military right now.
Well, first and foremost, the military has to preserve itself, right? I mean, we don't want to have the coronavirus strike the nuclear facilities. We want to make sure our Navy ships can go to sea. But beyond taking care of the 1.2 million active duty people and 800,000 Guard and reserves, that's a manpower pool of 2 million people. They can do a lot. And you've seen a very vivid example in the last couple of days with the announcements that the two massive hospital ships, Comfort on the East Coast, Mercy on the West Coast, are setting sail. On the West Coast, Mercy will pull into Los Angeles shortly, and we'll see the Comfort get to New York City Harbor sometime in the next week. They're coming out of the maintenance availability. Each of those have 1,000 beds, 1,200 medical personnel. They're highly skilled at all of the kinds of work that need to be done. They'll probably be used as auxiliary hospitals. So there are many, many examples, and I would start with medical response, and then you'll see things like Governor Cuomo is doing up in New Rochelle, calling out the Guard, the state Guard under federal auspices, but working for the governor. They can provide crowd control. They can run testing sites. They can do logistics. They can do water purification, all the above. So quite a bit is the short answer to the question, Brian.
Admiral, I know it's Alexis Christoforous here. Thank you so much for joining us. I know that you were an active commander with the Navy during a cholera outbreak about 10 years ago. During that time, we also had the Ebola situation in West Africa. What did you learn, sort of being on the front lines of the military during that time? What did you learn then that we could be implementing now during this pandemic?
I think three crucial things to bear in mind here. Number one, we need to take advantage of the skill sets that the military actually has. In other words, the military is not going to show up with thousands of doctors and nurses, but the military can come with logistics, with trucks, with aircraft, with crowd control personnel, with construction units. During the Ebola crisis, we built hospitals very, very quickly. During the cholera outbreak, we did water purification. So there's a huge logistic muscle piece of this, manpower, as I said, about 2 million folks. So that's number one, tap the military for what the military is actually very good at. Number two is don't regard the military as a panacea as follows. At the end of the day, the frontline people here are going to be the civilian medical personnel. I have two son-in-laws who are both physicians, one an emergency room doctor in Atlanta who is truly on the front line. He's seeing COVID-19 patients every single day. That's not the job of the military. The military has to back up those medical personnel. And third and finally, keep this under civilian control. You don't want to turn this over to the military for command and control. You don't want to have to declare martial law. We're nowhere near doing that, nor should we get there. We have to have our civilian leaders like Governor Cuomo in New York, the governors all around the country, the president and his team. All of that command and control has to be from the civilians, so we preserve civilian control of the military. So there's three things I would throw out there, Alexis.
Admiral, how vulnerable is the U.S. economy? You look across the country and the U.S. economy is pretty much shut down. I'm most concerned about potential cyber attacks.
You're spot on. And I have written and spoken a bit. I think last time I appeared on your program, and by the way, thank you for having me on. We talked about cyber. It's the number one security threat to the United States. And unfortunately, during a period of time like this, when our large national structures in the world of finance, in the world of business, in the world of medicine, in the world of our actual military are so focused on COVID-19 coronavirus, it's unfortunately a higher possibility that we might see a cyber attack. And as you probably know, we've seen a few probing attacks against the Department of Health and Human Services, not against the Department of Defense. So yes, we need to be very concerned about cyber attacks in this period. But let's face it, the virus is all hands on deck at the moment. We're going to need to really keep our focus on that, but not lose the thread of other challenges that are out there for us. And lastly, the economy. A way to think about this is the virus, of course, threatens the most vulnerable among us demographically, the elderly. But the virus, as it attacks the economy, threatens the most vulnerable among us economically. That's youth, those who are working in the gig industry, people who are often living paycheck to paycheck. So there are two threat vectors out there. And the difficult job for the president and the state governors and municipal governors is to find the balance between protecting appropriately the elderly, the demographically vulnerable, but finding a way to maintain an economy that can come back rapidly when we come out of this stand down, this pause, this gap month or 2 months or 4 months. That's a delicate balance that our leaders need to find.
Admiral, to your point about the economy, we know that President Trump is talking about wanting to get the economy reopened as early as next week. Do you think that is a responsible thing for the president to be doing and talking about?
I think the president needs to be listening carefully to our medical professionals. And I look at someone like Dr. Fauci, whom I've known for a decade, have interacted with him in previous crises. People like the head of the CDC, including the former head of the CDC, Dr. Tom Frieden, who is another expert in this area. We need to be taking our advice from the medical people on the medical side of this. And once you've done that, then it's perfectly appropriate to listen to the economic side. You've got to be able to do both. But I think that this is a time when we shouldn't operate from our gut instincts, which is what the president has a tendency to do. Sometimes that works for him, sometimes it works less well. Here, I think we need to base our determinations on science, medicine, certainly taking into account the economics, but that's going to require listening to the experts and following expert advice. That would be my counsel to the president.
Admiral, what's the capacity of the U.S. Navy? We have the Comfort and the Mercy being deployed here. How many more ships do you think we will need to have deployed?
Well, let's do the numbers for a second. We have two of these big deck amphibia ships, these big hospital ships. Each of them have about 1,000 bed capacity. But here's the good news. Right behind them, we have what are called big deck amphibious ships. These are ships that are used typically to carry U.S. Marines from port to port. Those have a capacity likewise of about 1,000 beds on each of those. You take the Marines off, you have the sailors drive the ship, poof, you have a floating structure with 1,000 beds in it. And those are a capacity that can be brought forward. And we have about a dozen of those, Brian. And then we also ought to look beyond the military in this, look at the cruise line industry. Many of these big, beautiful cruise ships, which, by the way, are all stateroom, unlike these Navy ships, which have large bays, less good when you're trying to do separation. Cruise liners have enormous capacity in terms of staterooms, individual staterooms. So they could come into this. They could be chartered by the government. There are statutes that permit that. And there's a lot of maritime capacity that can come in from the sea and support these hospitals as they face this surge wave we've all been talking about that I think most experts will tell you is coming in the next 2 to 3 weeks. Let's get those ships underway.
You know, Admiral, for a lot of us, we see our healthcare system in this country and it surpasses those from around the world. Some of us don't understand why we just can't seem to get a handle on this pandemic in a quicker way. Is it because our healthcare system is not as well coordinated with, let's say, local and federal governments? What are we missing here?
You've got it exactly right. And, you know, there are pluses and minuses to any system of government, right? We have a federal system here where each of the 50 states and the territories have their own authorities. They have their own surgeons general. They have their own governors. It's a big, sprawling situation, and each of those states has different capacities and, frankly, different cultures, different approaches to medicine. So it's very challenging to just on the spur of the moment get all of that together to face something like a pandemic. So here's the point. Rather than bemoaning our lack of organization, what we ought to be thinking about is how do we structure ourselves for the next pandemic? Because frankly, we're lucky with COVID-19 because it has a relatively low mortality rate, you know, somewhere in the 1% to 3% range. Terrible for those who do die, but compared to Spanish influenza 100 years ago, 20% mortality rate. Compared to avian flu, 60% mortality rate. So we've got this pandemic to learn how to get prepared for an even more lethal one that probably will come in the next 20, 50, 100 years. Every 100 years in human history, we see the emergence of a pandemic. Last one 100 years ago, Spanish influenza. So we've got to find ways to create structures that can quickly bring this medical establishment together in better ways. And I'll close by saying the military learned to do this. After World War II, each of the services was very unique, Army, Navy, Air Force, Marine Corps. We created a system of joint command and control. You've heard of that chairman of the Joint Chiefs of Staff. We learned how to bring them together. We're going to need to do that, not 100% of the time, not 24/7, but in a way that allows us to respond to the next pandemic. That's going to be crucial.
Very helpful insights here. Retired Admiral James Stavridis, former NATO commander, now an operating executive at the Carlyle Group. Thank you so much.
Thanks for being with me, Brian and Alexis.
And do hang on. We will have a quick check of overseas markets straight ahead.
Welcome back to Yahoo Finance. We're about 9 minutes away now from the opening bell on Wall Street. Want to get a check of overseas markets, things rallying there, but I know Oscar Williams-Groot standing by for us in London. Oscar, the UK has now stepped up its measures against this pandemic, locking down the UK. What's the latest there?
That's right, Alexis. Late yesterday evening, Prime Minister Boris Johnson delivered a special address to the nation from Downing Street, where he radically escalated the measures here in the UK to crack down on the spread of COVID-19. Now, there had been rumours of a full lockdown just in London, but what was announced was a lockdown across the UK. What that means is all non-essential businesses have been told to shut. The exceptions are things like groceries or pharmacies. And the entire population has been told to stay at home. People are only allowed outside once a day to exercise or to buy groceries and visit pharmacies infrequently. Groups of 2 or more are banned on the streets. Police have the power to enforce this here in the UK by issuing fines. But the Prime Minister made it clear that he hopes it doesn't come to that, and he hopes that community police can simply stop people from going outside. Now, this policy will be reviewed every 3 weeks, and the Prime Minister said that the population are being enlisted to flatten the curve of infections and save the NHS, using wartime rhetoric there.
Oscar, I want to talk a little bit about economic numbers that we're getting, and of course, they're pretty dreadful. We got the flash PMI numbers coming out of Europe. What are they telling us?
Well, as you said, Alexis, they really are dreadful. The Eurozone and UK numbers this morning, and what they showed is the steepest drop on record of business activity for both the Eurozone and the UK, worse even than in 2008. Not only was it the steepest drop, but it was also dropping down to absolute levels that we haven't seen even during the depths of the 2008 crisis, signifying just how bad things are economically. Chris Williamson, the chief business economist at IHS Markit, said a recession of a scale we have not seen in modern history is looking increasingly likely.
You know, Oscar, we have a trading limit up here for U.S. futures, meaning that all 3 indexes have risen 5% in the pre-market. You've got a rally going on by you as well?
That's right. Despite this poor economic news and the UK lockdown, we're seeing major indices across Europe up between 4 and 6% this morning. Now, partly that is because of the rally in the futures that we're seeing over there and optimism that the US might pass this stimulus package that we've all been talking about. But I think it's also to do with the fact that the UK has put in place this lockdown. It's a sign that authorities here are taking this seriously. And the overwhelming thought here in Europe now is that actually it's better to have this harsh medicine now and potentially flatten the curve rather than to have a protracted, long crisis, essentially. We've also had numbers from Italy over the last 24 hours showing that there's been a slight slowdown in deaths and new cases, which again speaks to this idea that hopefully getting a handle on this crisis with possibly draconian measures may be the right way to go.
We'll take any encouraging news we can get. Oscar Williams Group live in London. Thank you. And stay with us. We'll be right back. We still have the opening bell straight ahead on Yahoo Finance. Welcome back to Yahoo Finance. We're just a few minutes away from the opening bell on Wall Street. Want to get right to Jared Blickery with a look at the futures, which are in rally mode, Jared.
Yes, we've had futures lock limit up since about 5:30 a.m. They have come off a little bit, and we're dialing up the Wi-Fi interactive here. We can see the Dow, S&P, and Nasdaq futures all up about 5%. This is a two-day chart, so here's that big spike on the Fed announcement yesterday, and then here is where we reached that lock limit up. And we can see there's a lot of green around the world right now. London's up over 5%, as well as Paris, the CAC 40, they're up over 5%. In Frankfurt, the DAX is up over 6%. But I want to check out gold here because that is just on a tear, having its best day since 2008, right after the Lehman Brothers blew up. And we can see this candle right here. This is a year-to-date chart. Yesterday was a nice day too, and it doesn't come as any surprise that this comes after the Fed announced it is doing unlimited QE. It is buying $625 billion worth of bonds this week alone. In QE3, it was only $85 billion per month. So we're really seeing gold responding here. Also, copper is up. We're seeing that at 221, kind of bottoming here. We'd want to see this continue back up to the 2.5 resistance level that used to be support. And finally, we'll just take another look at the S&P 500 futures here. This is, again, going back to the beginning of the year. We're still locked in this downtrend here. But, you know, if we can finally climb out of this, we do have the Fed as a definite tailwind at this point. And we can also check out what's going on in the currency markets. The US dollar had been very strong, but today it's very weak. And that represents all the red that you're seeing on your screen right there. The US dollar index, this is what it's done over the last 2 days. If we look at a year-to-date chart, we can actually see this big rise, and that caused a lot of headaches for EEM and some multinationals. And it looks like we have the opening bell here in just a few seconds.
Yeah, all right. Thanks, Jared. We're gonna And a new trading day is underway. This is the second straight day that the iconic trading floor at the New York Stock Exchange has been closed, as that exchange goes completely electronic with no human element in trading there. And we did see Jared just talk about how stocks are rallying right now, right out of the gate. We've got the Dow Jones Industrial Average spiking higher. And this is also because investors believe we're going to be getting some fiscal response to the pandemic at some point today if Congress can indeed pass that $2 trillion stimulus package. We're joined now by Aryan Vojani. He is with MV Financial Investment Strategist. Thanks so much for being with us. We appreciate it. We're seeing these huge swings in the market, one day up big, one day down big. Is this just the new normal for Wall Street right now, do you think, Aryan?
I think for the time being, it definitely is the new normal. I don't think this is going to go anywhere. And I have to say investors should brace for continued volatility and potentially increased volatility. We know that we're on the onset of this thing. I think there's more pain ahead in the markets. You'll continue to have relief rallies and days like this. So I don't think it's going anywhere. I think investors should act accordingly.
And what about opportunities? Are you taking advantage of this market right now? What are you telling clients? Are you seeing that they want to hold on to cash? Are they running to treasuries? What are they doing right now?
It's a great question. There is a lot of fear. This is a heightened fear environment for multiple reasons. I wouldn't say it's time to sell out yet, depending on your timeline. However, opportunity will come. I don't think we're in the thick of it yet. So I think opportunities will get better. I think the market will become more attractive in terms of a long-term buying opportunity. I just don't think we're there yet. I think now is the time to brace yourself, hold on, and not make any sudden knee-jerk moves.
All right, Aryan Vojani, we're going to ask that you stick around. We're going to take a quick break and come right back with much more market action here at Yahoo Finance. All right, we're about 4 minutes into a new trading day. Stocks are rallying. We have the Dow Industrials up better than 1,100 points right now, being led higher by shares of Boeing, up about 18% right now. Chevron and United Technologies higher as well. Joining us is Aryan Vojani, investment strategist at MV Financial. We also have Brian Sozzi here with us. And Brian, I understand you have a question for Aryan.
Yeah, Aryan, good to talk with you here. What do you make out of, let's say, the president coming suggesting people go back to work, but we still have coronavirus cases on the rise? From an investment standpoint, doesn't that worry you a little bit? And how do you position for that? Because theoretically, if that does, coronavirus numbers will continue to rise, perhaps pretty big.
Yeah, it is confusing given the messaging recently. The best thing for the markets will be for this thing to move on, pass, right? So we need to do everything, or really we need officials to do everything to make sure that life can go back to the way it was, right? Economic shutdown around the world is what's hurting the markets, the uncertainty from that. So if we do something that endangers our ability to get back out there, that is worrisome from a market outlook.
Aryan, I'd love your take on the airlines because they are rallying today after being beaten down, but it seems like everything is rallying. All 11 sectors of the S&P 500 are higher here, as well as we're seeing this bounce back, at least a temporary bounce back. There is talk that domestic passenger flights could virtually come to a halt, in essence, grounding the entire U.S. airline industry. If you're holding airline stocks right now, what do you do?
It's a great question, Alexis. I think you hold. I think there's pain ahead. I don't think this rally is going to persist. We're going to see things slow down. We know that this is going to continue on. However, there's no reason to believe that the airlines are going to go somewhere. We know the government's going to come in to help them, but also what other alternatives are there when the world goes back? Those airlines have a firm footing. And I think the sell-off has been a little bit drastic up to this point. So maybe we're seeing a little bit buyback because we understand the markets react ahead of time and have really reacted really negatively. So the sell-off might have been a little bit drastic and dramatic, but I do think there's still pain ahead.
And
Brian,
Aryan, what other sectors are you looking at right now? We're starting to see cyclicals outperform defensives. Is that the good trade to be putting on?
I would still put my money on defensives. I think anything that can outride this kind of environment. So anything that, communications, staples, companies that'll continue to produce revenue through a shutdown phase for the short term intermediate will be strong. I still like those. I think that there's going to be opportunities. Obviously, tech is going to continue to be strong. I would not buy into a relief rally like this. I would think that they're premature, and I think that you could get hit on the upside because I do think, again, we're going to start to see data come through, and the data will really help us guide what stocks, what positions are going to be the winners throughout this negative period.
Aryan, we're seeing the past 24 hours, 36 hours, a lot of Wall Street firms are actually taking their estimates for the market off the table. They're saying there's just so much uncertainty. We can't even guess where the S&P 500 is going to end this year. Are you in that camp, or do you actually have some forecasts for us?
I actually am more in that camp. If we look back at historic data, there's nothing in the playbook that covers this kind of event. Even if we keep talking about the Great Depression and the recession, those are such different events. We've never seen an event which has shut the entire world down. So really, our best estimates, we're looking at different scenarios when we talk in our internal investment committee about how long the shutdown lasts and how that affects the U-curve, as it were, of how badly it affects the economy. That's what we need to look at. Is this thing 2 to 4 months? Is it 3 to 6 months? And is it potentially longer? Because every time that scale goes longer, the longer and potentially more deep the U will be. And that's not something any of us as investors want at this time.
And what do you do if you do, let's say over the next couple of weeks, we had James Bullard weekend suggest 30% unemployment rate. I would imagine if you're going long here, seeing that number potentially cross the tape is jarring. It's shocking. You take those long into a print like that.
Yeah, that is very troublesome. 30% unemployment. Honestly, we've never, the Great Depression was 20%, and that was a very different market period. And again, tough comparison. A 30% unemployment period would be very hard on the markets. And I think to your point, you have to look at this as a long-term play. If you're someone more short-term, intermediate, like some of our clients, people who are getting ready to retire, there is going to be some pain for those kind of people in their portfolios. If you're more long-term, you would hope that would wash out. But again, that 30% is the most bearish of estimates. I do think that we're going to see a lot of unemployment. We're seeing a lot of data come through, which is troubling as is. And I do think we're going to have to, again, see how long this thing lasts, because that is really what's going to drive these different data points.
Arian Vojani, investment strategist at MV Financial. Thanks for your time today, and be well.
You as well. Thank you.
Thanks. All right, coming up next, we're going to hear from the governor of Connecticut in today's Influencers with Andy Serwer. Do stay with us. We're back here at Yahoo Finance. We've all been waiting for a fiscal response to this pandemic, and it looks like it may be coming in the next few hours. We want to share some breaking news with you now. House Speaker Nancy Pelosi, in an interview just moments ago, said there is, quote, real optimism for a deal on coronavirus legislation in the next few hours. It is that optimism that is sending stocks higher right now. We have the Dow up more than 6%, a gain there of 1,100 points. We know that yesterday we heard from the governor of Connecticut, Ned Lamont, urging President Trump to really lock down the entire country as we try to wrap our hands around this pandemic, even as the president is suggesting he may reopen lockdown states next week to try to get the economy going again. And Lamont told our Andy Serwer that lawmakers were really slow to respond here.
President Trump has repeatedly called the coronavirus the Chinese virus. And the CDC director, Robert Redfield, has said that's wrong to do so. What is your take on that, Governor?
I don't think it helps things. By the way, China had no new infections yesterday. Compare that to the United States, compare that to Italy. Italy has had more deaths than China. This is a virus that knows no borders.
And that, of course, is Influencers with Andy Serwer, brought to you by Verizon. And we have Andy joining us right now. Andy, what else did Lamont tell you in terms of government response to the pandemic?
Yeah, hey, Alexis. Governor Lamont was talking about the fact that Washington was slow to respond, the White House in particular, but also Congress. And we've seen that, and that's what actually has contributed to the market decline. Of course, we've seen the Senate being slow to respond. And as you said, it looks like we may have a deal today, which is sending the market higher. So that's good news. Another thing I think to point out here, though, is that actually the states hit hardest by the coronavirus, just coincidentally perhaps, are blue states. So you're talking about Connecticut, you're talking about New Jersey, you're talking about New York and California. So the governors there, Lamont, Cuomo, Murphy, and Newsom, have had to be proactive on their part because they've considered Washington to be, as we said here, slow on the draw. And, you know, that's because these states are more densely populated, but it's created a tension between those states and Washington, D.C. And we hope that these parties are all coming together now. Alexis?
Andy, Brian here. How do you think the states will react if President Trump comes out in a week or two and says, people, it's to work?
It's time to go back to work. Yeah, I mean, obviously, he's been talking about this, Brian, for the past couple of days, and the response in many quarters has been alarmed. And people are suggesting that it would be premature. The scientific community certainly are saying that it would be premature to go back to work at this point, that it would actually make the situation worse. And I understand the president is concerned about the U.S. economy, but, you know, I remember talking to Francis Collins, the head of the National Institutes of Health, and him saying that, you know, health has to come first here. And so it could be a real mistake, but this is, again, a tension between the federal government, in particular the White House, and states, again, like California and New York.
And Andy, while we're in the throes of this pandemic, it's easy to forget that we're in an election year. And some are saying that the president wanting to get the economy up and running sooner rather than later is really a desperate attempt on his part to get reelected. Do you think there's a little truth in that?
Yeah, I mean, listen, and any president, Democrat or Republican, would have his or her eye on that November date, Alexis, to be fair. The question, though, is would that individual compromise the health of Americans to accomplish getting reelected? And, you know, that should not be the case, that everyone's health should come first. But it's possible, and I think Anthony Scaramucci was talking about this just yesterday on one of our programs, that in fact there is some sort of resolution process when it comes to the coronavirus, and the situation gets better and the economy starts to heal, and President Trump gets a lot of credit for it. So right now, you know, all bets are off. But of course, the first concern for everybody is the health of the citizens of our country.
Andy, we're just getting in some new U.S. PMI data, and this is some shocking data from March here. Falls to a record low, the services index. You know, how some of these headlines on the economy, which might be negative, which will probably be negative, how does that hurt Trump's chance for re-election?
Well, right now, you know, I think if the election was held today, you could make a strong case that if Biden was in fact a Democratic nominee, that he would win. But remember, just a couple months ago, you know, it looked like Trump would win re-election handily. So it's possible that things have flipped now, but as I just said, Brian, it's possible things could flip again. And, you know, it's interesting when you talk about that economic data, because if you were to make a call, if I were to ask you, are we in a recession right now? I think you'd have to say America's in a recession. But of course, that's not the official definition of a recession. That would be the Brian Sozzi definition, because the actual definition of a recession can only come from one of two measures. First, you have to have a decline in GDP in 2 consecutive quarters. We won't know about that until July 25th, or the NEBR declares, or the NBER declares that we're in a recession, which is just something they do looking at a variety of factors. So, you know, right now we know the economy is slowing, but we don't know exactly how much, and it's sort of ill-defined at this moment.
You know, Andy, it seems as though in the past few days, especially with the steps that both the Federal Reserve and the U.S. government are taking to get a handle on this pandemic, our capitalist society is feeling a lot more like a socialist society. And just today we learned that the president signed into law a bill that requires the president to create an agency, an interagency strategy to secure 5G, 5th generation and future generation technology. Do you think that it is the government's place to do something like that?
Wow, that's a big question, and it speaks to your definition of government in our society, as you sort of hinted at when you in the beginning of your question. And it goes against the nature of Donald Trump and, in fact, the Republican Party to sort of act like big government, which, in fact, they're doing right now. And of course, the situation calls for that. But when you're talking about these kinds of measures, Alexis, you really have to go back to the times of Franklin Delano Roosevelt, which was the high point of big government in this country. And of course, the reason why FDR felt compelled to act in that manner is because of very dire economic circumstances, i.e. the Great Depression of the 1930s. And so the only way to respond to that was to have government programs like WPA, et cetera, and all those public works programs and infrastructure projects to get the country's economy going again. And you could argue strongly that we're in a situation right now which is going to require big government to do it. But the question is, can the Trump administration and can the GOP have the wherewithal or even the understanding and the desire to act this way in a situation where they might need to do so? That's a huge question.
Yeah, extraordinary times calling for extraordinary measures. Our editor-in-chief, Andy Sherworth, thanks for joining us this morning. Stay safe. All right, stay with us. We're going to take a deep dive into tech in during this pandemic. Stay with us. Welcome back to Yahoo Finance as we continue to broadcast our 8 hours of live programming from our homes as we all practice social distancing during these challenging times. Thanks so much for being with us. Want to welcome Daniel Newman of Futurum Research now for a deeper look into tech. And Daniel, I mean, look, the whole market is rallying today, including these recently beaten down tech stocks. But can you make the argument for why you should remain in big tech, especially the FANG stocks right now?
Oh, I think across the board, there's a couple of things. If you've hung on this long, there's no way you can predict the bottom, but we are down 30% in some cases and more. Of course, today everybody's up and everybody's feeling really good. But think about how tech is impacting our lives right now. You look at everybody working from home, everybody being at home more. This means more Netflix. This means more time on social media. This has become the key way that we're communicating with one another. You look at how we're getting our goods and services from Amazon right now. So across the FANG space, we are certainly seeing a compelling case that our economy continues plodding forward with these companies in mind. I mean, tech is really going to be at the core of keeping businesses operating, especially those non-essential companies where people are working remote and trying to keep their businesses going, despite what's going on in the economy right now.
Daniel, Brian here. Always good to talk with you. Who has the best supercomputing power right now in the tech industry that could probably get in the good graces of the government? I know the government has teamed up with Google on some things, but who could really get close to them at this point?
Yeah, there's a few companies. Yesterday, IBM made a big announcement about a new consortium, and actually Amazon is involved, Microsoft is involved, along with a number of the world's largest laboratories like Argonne and others, that they were actually making the horsepower of their computing available to those that are looking to utilize it to solve some of these issues with the pandemic, whether that's developing drugs, utilizing data to slow the spread and flatten the curve. So that was a really interesting announcement. You could check it out yesterday. It came from IBM, but it was a number of different companies and laboratories and organizations involved. Another one's NVIDIA. NVIDIA has not only the high performance computing, but they have a number of models and algorithms. And they actually made their Parabricks, which is a modeling and set of tools that could be utilized for a similar purpose as what we just talked about. But this is more on the AI and machine learning side. So there are a number of companies right now that are volunteering the technologies that they've built and invested in to be utilized by industry, by biotech and pharma, by healthcare, and of course, universities and laboratories that are really trying to put their best data scientists and engineers and healthcare leaders forward to make progress, which is, I think, what the market is really looking for right now is hearing about finite progress, that we are going to be moving forward and moving on, with a more definite timeline.
Daniel, what about people who are looking at how far some of these high-flying tech stocks have fallen? I mean, the valuations have come back down to earth for a lot of these companies. Would you recommend getting in now, or is this still too risky?
Well, I think it personally, I would say I'm dabbling and I'm buying a little bit, kind of with each step down, because I think it was really overbought, and I think there's starting to be value right now. It's a little scary though, as I mentioned, without kind of having a longer horizon of when we're going to kind of turn the corner. But some of these companies are tremendous values. I'm working on an article about some of these companies I think are going to really bounce back. And for instance, like a Qualcomm, the company that's sort of pushing 5G into market, and that's going to be something that's going to catch wind in a big way over the next couple of years. Stock fell 30% plus in a short period of time. Cisco, we've all heard about Zoom, and Zoom's gotten a huge ride up. Well, Cisco has one of the largest platforms on the planet for web collaboration. Chuck Robbins came out and said 5.5 billion minutes of meetings in March. And the stock's gone down. It has not benefited. Maybe that's because of a more diverse portfolio. So that's on my mind. And just one other thing that's really interesting is talking to the OEMs, the client and PC makers, they can't keep these devices on the shelf right now because companies are outfitting workers. So companies like HP and Dell, Lenovo are all selling PCs at a really breakneck pace to try to outfit to outfit workers that are working from home.
Hey, Daniel,
companies to benefit.
Daniel, I got to jump in here. We got to take a break. Thank you so much for those insights. We appreciate it. Be well. Stay with Yahoo Finance. We're going to be right back. Big rally underway. Will it last, or is it a fake out? We'll be right back. Welcome back to Yahoo Finance. Stocks are rallying on the belief that we are going to get some sort of a fiscal stimulus package from Congress, perhaps within the next hour. That's according to House Speaker Nancy Pelosi, who gave an interview earlier today to CNBC. Want to check in with Inez Ferre, who's usually down at the New York Stock Exchange floor. We know that floor is now closed because of this pandemic. Inez, I know you have your eye on a few stocks today, including Ford. What have you got?
That's right, Alexis. Well, Ford and GE Healthcare, also 3M, they had a conference call this morning talking about Ford's efforts to help with making ventilators and also respirators. You'll recall that some of these car companies have said that they can help in this situation. Ford says that it's got its manufacturing capabilities, engineers, designs, and in some cases during the conference call, Ford executives said that some of the components that they even use currently, some of the components that they use for some of their vehicles, some of those components can be diverted. Others will be remodified to use for other products. Also, I just want to mention GM because GM has said that it's drawing down $16 billion from its credit facilities. This is a proactive move to help with its liquidity. It's also withdrawing its guidance for 2020 because of the uncertainty of the coronavirus. You'll recall that its North American facilities are closed until the end of March. And GM is also, by the way, helping out with making ventilators with another company, Ventec. And just taking a look at some of the cruise liners and also some of the casino stocks, those today are in the green. They've been badly battered by the coronavirus, trading at multi-year lows. Today, they're seeing a little bit of a relief. Alexis?
All right, I think we're going to see more and more companies drawing down those credit lines and taking their guidance off the table. Want to welcome our panel now. Of course, Brian Sozzi continuing to be with us throughout the morning. We also have Dan Roberts and Heidi Chung. Heidi, what are you keeping your eye on? I know the restaurant area is sort of your niche, your beat, but what are you looking at today?
Well, at least in the broader market, we are seeing a bit of a bounce here. The market's looking to rebound on the hopes that we will get a fiscal stimulus package, Alexis. But I think the main question going forward for the markets is, can we trust this bounce? Because we have not gotten that fiscal stimulus package just yet. But the stocks that are moving higher this morning are the ones that have been getting battered the hardest ever since the COVID-19 outbreak. We are seeing casino stocks higher, airlines, cruise liners, like Inez mentioned. But whether or not we're able to hold on to these gains throughout the rest of the trading session will be very closely monitored by market participants, Alexis.
All right, I believe we have with us now Chris Pollard, Cowen Head of Market Strategy. And no, I'm being told we don't now. All right, Dan Roberts, then let me go over to you and see what you're watching this morning.
Yeah, absolutely, Alexis. As Heidi mentioned, we're seeing quite a rebound. It's funny, in the last 2 weeks, getting notification after notification, or at least I did, of, X stock is down at a 52-week low, X stock is at a 52-week low, X stock is at an all-time low, especially low tech names. It was all losses. Now, this morning, I wake up and all my notifications for futures were everything is up, everything is in the green. To point to a couple highlights, things that I cover, I wrote yesterday about Uber stock, interestingly, has been up for the last 5 trading days in a row. And that is because even though Uber is seeing a 60 to 70% decline in its rides business, which of course you would think is terribly devastating, the CEO, Dara Khosrowshahi, last Thursday on an analyst call highlighted a number of silver linings. So maybe he was just kind of making a lot of a little, but he said Uber Eats is seeing a huge boost. And he also said the company has quite enough cash on hand for even a worst case scenario. Even if its rides drop by more than 80% on the year, it would end 2020 with $4 to $6 billion in cash. Investors liked that a lot. So again, today, Uber up big.
All right, now it does look like we have Chris Pollard, Cowen Head of Market Strategy. Chris, thanks as always for being with us. We've got this nice rally here so far today, but you say the probability for more market downside has actually increased. Tell us about that.
Hey, good morning. Yeah, thank you for having me. So I think the issue here is that we're beholden to the viral curve, and we are still in the teeth of that exponential growth. It was noted by Governor Cuomo last week that we were about 45 days out from the peak. And until we get through that, doing the work to set a valuation floor is going to be next to impossible. We can't model the impact to earnings, to macroeconomy without first getting through the virus and seeing where we are in terms of protracted measures with regards to suppression and keeping the population safe. So until we get through there, it appears that downside has opened up, and the break of 2350 that we saw last Friday really opened the door to that. So while we're optimistic that eventually we'll find a footing, it's too early to put in place the valuation support that we're going to need to ultimately set the base for a protracted bull run.
Chris, Brian here. Good to talk with you again. I had a source yesterday on the street suggest to me S&P 500, 1900. 1900.
Do we have Brian Sozzi here? I know that Brian had a question for Chris. All right, Chris, I'll take it. We just had Daniel Newman on from Return Research making the case for tech stocks right now. Are you have a stomach for that? I mean, a lot of these companies have come down in their valuation, and people sort of feel that itch to want to get back in. We're seeing it today as they continue to rally, at least for today. What are your feelings on big tech?
What's interesting about this is despite the absolute carnage we've seen across the index and index subsectors, relative performance trends continue to favor areas like big technology. If we think about how portfolio construction has been dictated for the better part of the last few years, the themes of growth over value, secular stories, service as a software type stocks, those continue to outperform. Granted, the denominator of the ratio has been doing the bulk of the lifting of late. But if you were to look at the trends underpinning, say, the triple Qs versus the S&P SPY, you would see that ratio making new highs on almost a daily basis. And that speaks directly to tech stocks continuing to outperform.
Hey, Chris, Brian here. I had a source suggest to me that S&P 500, 1900 could be in play here. Do you think that's right?
Well, so breaking 2350 was the last clear technical support, and this market is really being dictated by technicals right now since we can't do the fundamental work necessary to establish a valuation framework. It could go lower than that, frankly. We don't know where E is going to shake out, but if we think back to the financial crisis, we bottomed out at about 12 times earnings. Let's just say that current 165 estimate moves to 140. Not saying that's the case, I don't know, but if it did and we applied a trough multiple like we saw in the financial crisis at 12 times, that's a market that trades slightly below 1,700. So it's not unrealistic to think that that level of 1,900 is in play. We're focused on that range from 2015 to 2016. The last time we had real global recession fears, that market traded around 2,100 to 1,800. Yes, that's a wide range, not very precise, but I do think that's the appropriate level to be looking for real support coming into view here, should this virus remain protracted in the near term.
Chris, Dan Roberts here. We know that today the bump isn't necessarily, a change in sentiment or real overall market optimism. It's in response to what we hear out of the government and some excitement about stimulus measures, but it's not really the buying in that everyone hopes might come. I guess I'd ask you in general, a bird's eye view, what you think it will take for regular people and investors to decide, okay, now it's time to buy, because even last week, there were days when we thought, okay, maybe now the selling will stop, and the selling has just continued. And it's tempting to think that today, when you see gains, we're seeing so much volatility, it might just be another temporary bump. Will it take all the way until the coast is clear, so to speak, and the experts are saying, okay, we have flattened the curve, success, or what might it take to really see protracted buying and maybe see the bottom?
So it's a good question. I think that, look, markets are forward looking. So I think before the peak in the curve, you'll probably start to see some re-engagement. I think along with the institutional community, there are certain just very glaring measures that need to settle out. And hopefully the Fed actions that have been taken over the last 2 weeks are going to help to do that. So for instance, the dollar liquidity concerns have been front and center now for the better part of a week and a half. The Fed's expanded dollar swap lines. They've moved beyond just G7 central bank counterparties to other regions that could potentially be constrained from dollar liquidity. If the dollar starts to soften from here, that relieves pressure on some of the more vulnerable emerging market economies. That'll be helpful for stabilizing broader risk. Similarly, the credit markets, IG spreads were incrementally tighter today, but they have been dramatically wider. Last week had a very liquidation-oriented feel to it. It had the dynamic of being, let's sell what you can, not sell what you would. I think a good place to capture that is looking at triple C spreads. Triple C spreads are below the peak we saw in 2016, whereas IG spreads, the highest quality corporate issuers, actually moved above those 2016 highs. I think that really is a function of people finding markets where they could, raising cash where they could. As those measures start to settle out, I think that will give a bit more support to broader risk appetite. And those are key places to be watching as we move forward from here.
All right, Chris Pollard, we're going to ask that you please do stay with us. We're going to take a short break. We're also going to talk about the status of the Summer Olympic Games in Japan. We know more now, coming up next. Welcome back to Yahoo Finance. It is now official. The 2020 Summer Olympic Games to be held in Japan have been postponed. This was an announcement made earlier today between Japan's Prime Minister and the International Olympic Committee. They've been pushed out to sometime in 2021. And this is only the fourth time in the history of the modern games, which began back in 1896, that we're seeing Olympics being postponed. Joining me is Dan Roberts and Heidi Chung. Dan, what's your response to this? I mean, and also it's just devastating, crushing for the athletes who were going to be competing in this.
Yeah, it is devastating, Alexis, although at least it's being postponed and not outright canceled. In fact, what IOC member Dick Pound had said a few weeks back when there were first kind of glimmers of, might this thing last long enough that it's going to interfere with the Olympics? He had told the Associated Press in an interview that outright cancellation was the likeliest thing if something were to happen. Like, if we need to change it at all, it would be cancellation. And his quote said, look, an event this big, you can't just say, we'll push it off till October. So that really stoked a lot of fears that it turned out were incorrect, because for now it's postponement, not cancellation. So that is a silver lining. But I'm with you. The interesting question to me now becomes, what does this mean for athletes? Because, you know, for these athletes, it's their entire career. It's not as simple as saying, oh, okay, it'll be a year from now. Instead, you got an extra year to train, because, you know, we know that the lifespan of an Olympic athlete is only so long in terms of how long they can compete. So if you were 36 and this was definitely going to be your last rodeo, well, are you still going to be able to compete at 37? It really changes things. But again, at least it's postponed. Now, in terms of the timing, Shinzo Abe, the Japan PM, has not specifically said it will be summer 2021. What he did commit to was it wouldn't be later than summer 2021. So the official statement out an hour ago, the joint statement from the IOC and from Japan's organizing committee, says that the Olympics will be, quote, beyond 2020, but not later than summer 2021. I think it's fair to assume that means it'll be summer 2021. In fact, I imagine it'll end up being exactly a year later than it would have been. So July 24 is when it was going to start for 2020. Maybe it starts around that same date, 2021, but maybe it'll surprise us. Maybe it'll start earlier. Maybe it'll be in the spring. I don't know. And of course, I still wouldn't rule out outright cancellation because this is a really complex event to put on. And it's far from simple to just say, we'll do it a year later. But this was inevitable. There was rising pressure. And I think the real domino that kicked it was Canada came out and said, well, even if it happens as planned this summer, we're not participating. So that kind of forced the IOC and Japan's hand.
I mean, in some ways, you can say the Olympics has a little wiggle room because it happens every 4 years. So you do have next year where an Olympic Summer Games was not supposed to be happening. So I guess, a silver lining here is that they do have the ability. They wouldn't be pushing another Olympic game out of the way to have the 2020 games in 2021. Heidi Chung, I'd like your response to this decision. And also, what does this mean for the advertisers? You have to think that most of the advertising for the Summer Olympic Games has already been bought. Will that just translate into next year for these advertisers?
Yeah, Alexis. So like Dan Roberts just mentioned, this is an extremely complicated issue, but there had been a lot of speculation heading into this that this would perhaps be the case when it comes to the Olympics this year. Now, your point is a very good one. Advertising for sure is going to take a big hit. I believe it was just moments ago that GE said that it may be pulling its advertising for the Olympics. So that could be certainly a big issue going forward. But I also do want to highlight the fact that this will definitely impact Japan's economy. So whenever we're headed into these Olympics, the country looks at the infrastructure, really spends a lot of money building that up, but also the temporary hiring that the Olympics do. If that's pushed until next year, that could certainly hit the labor market in Japan as well. So there are a lot of trickle-down effects from this postponement, though it isn't canceled. So if it does in fact get canceled, I'm sure the long-term impact would be far greater, but at least for now, there certainly will be a near-term impact, it seems, Alexis.
Yeah, and Alexis, let me just add to what Heidi Chung just said. There's one other interesting note, and I'm glad Heidi highlighted the effect for the Japan economy. There's also an effect here for Shinzo Abe, who really kind of made the Tokyo Olympics his thing and was pushing that, and that was going to help him get reelected. That was really helping curb some of the other criticisms of him. And now with it postponed, I don't know how that is going to affect him politically, but it is an issue. Shinzo Abe was really making the Olympics kind of his stand in terms of, look what I'm doing for Japan's reputation and global standing in the world. And also, another side note that I've been following closely, I've talked to many of these small travel companies that book trips for people. So, there are families that had booked their travel for the Olympics already over a year ago. And you hire one of these companies to book your flights, book your hotel. They've been getting slammed by customers now wanting full refunds, even in cases where those customers decided to skip the optional travel insurance. And so legally, the contract did not guarantee 100% refund, but customers are saying, well, this is unprecedented. I want all my money back. But those requests are going to put these small travel businesses out of business.
Yeah, great point, Dan. And another reason to postpone these games is, how is everybody going to get there? I mean, if the airline industry is basically grounded for all intents and purposes, how do you get the athletes, the fans, and everybody else over there? All right, thanks, guys, for that conversation on the Summer Olympic Games, which have been officially postponed to sometime in 2021. Stay with us. We've got Chris Pollard back with us to talk markets in just a moment. Welcome back to Yahoo Finance. Connecticut, we know, has joined many other states in lockdown. And yesterday, Connecticut's Governor Ned Lamont spoke to our Andy Serwer in this Influencers segment brought to you by Verizon about just how the pandemic is affecting the job market throughout his state.
During the last recession, which is a bad recession, 08, 09, let's say 5,000 people a week applied for unemployment compensation. Yesterday, 12,000 people in one day applied for unemployment compensation. So the economy is dropping off a cliff, especially when it comes to those small businesses, those Main Street merchants.
And nationwide, we're expecting jobless claims to top 2.5 million when we get that number this Thursday. The Connecticut governor also urging President Trump to, in essence, shut down the entire country for a period of time so we can wrap our hands around this pandemic. I want to talk about the markets more now with Chris Pollard, who joined us in a previous segment. He is head of market strategy at Cowen. Chris, what are you looking at right now in terms of outside of equities, taking a look at commodities? We know the dollar was very strong. It's taking a bit of a hit today. I guess no surprise there. But we are seeing gold rally at the same time equities are rallying. What does that tell you about investor sentiment right now?
So I think it's important to remember that gold is vulnerable to positioning elements just like every other instrument. And in a liquidation event like we saw last week, gold is sold to raise funds, just like we saw people selling IG versus CCC credit. There was a market for that. There was liquidity for that. And so people took advantage of it. Gold coming into the last couple of weeks of volatility was about as crowded of a long as it's ever been. And some of that came out of the market last week. So gold rising now along with stocks, I think suggests that some of the liquidation phase is behind us. I would say in addition to gold, it's important to look at markets like energy. Crude oil has bottomed, at least in the near term, off of the low 20s. Not to say that the price war between the Saudis and the Russians and the United States is over in the near term, but certainly some of that extreme volatility is working its way out of the market here. That's reverberating in areas like tip break-evens. And as tip break-evens start to move higher, that's helping to settle out some of the volatility we saw within the Treasury space. So it really is a cross-asset market right now. But the fact that these instruments are not seeing outsized pressure to the downside, I think speaks to us moving away from that pronounced liquidation phase that we saw last week.
Chris, what's the one hot trade you're starting to see folks on the street put on?
Look, I think it's going to be a continuation of those relative themes that we talked about earlier. Areas like technology outperformance, bigger areas like growth outperforming value. I think those trends have shown themselves to be quite durable, and during this process, even more durable. So I would expect that as the market begins to find a risk footing, you'll see those trends accelerate even further. So for us, it's playing what we know right now, and that means tech outperformance. That means things like large cap outperforming small cap. So that would be SPY over IWM as a ratio. Those are the trades that we're really focused on right now. It's tough to make absolute calls given the uncertainty around the fundamental and macroeconomic environment. But from a relative basis, there's a lot to do. And I think those are two areas where we would be really focused.
Hey, Chris, it's Heidi Chung here. So this week is gearing up to be a really big one, especially with those initial jobless claims coming out on Thursday before the bell. Markets attempting to come back here. But if we do indeed get that perhaps 3 million number in initial jobless claims, what do you think is going to happen to the market? Is it just more pain ahead?
Well, so I think the market has begun to discount the sharp deterioration we're going to see in macroeconomic data. You saw that this morning with the release of services PMI. Even before the real pronounced suppression measures relating to the virus, we knew there were going to be some hits in jobless claims just relating from the volatility we've seen in the energy patch and the jobs associated there. So I think that, again, markets are discounting mechanisms. They knew that this was going to get worse. I don't think one in particular data data point is going to lead to another, say, limit down type session. But what I do think it's going to do is it's going to continue to underpin the idea that stimulative measures are needed, monetary for sure, but also, and importantly, fiscal stimulus measures. The legislature is working on getting a package over the goal line this week. We're going to need to see more of that. There is going to need to be real fiscal support. If we think about the aggregate demand function, consumption, investment, government spending, and net export, the government spending portion of that is going to be critical for us to get through this year, and we're going to need to see an awful lot of that coming out of Congress.
Chris, it's Ines here. When we talk about later on about a recovery, are you looking at a V-shaped recovery? Are you looking at U-shaped? Does this depend on how long we stay in a lockdown in some states, or if the whole country goes sort of in a lockdown? Talk to us about that.
So I think that it's tough to see a V-shaped recovery. I think one of the things that's important to keep in mind here, the U.S. is a services economy, and the services demand that's been destroyed throughout this virus process, it doesn't come back one for one. All of us on this phone won't be coming back and ordering 2 entrees every time we go out to dinner. Those entrees they're not coming back. So I think that it's going to take a while to replace the shock to overall GDP that this has caused. Stimulus from the government is going to be critical in that, but it will take time. First, it's going to be figuring out how long the suppression impact is going to be on earnings and the macroeconomy. That will allow us to establish a valuation framework. And then it's going to take time for people to get back to normal. It's unlikely that you're going to see an immediate resumption of the social trends that we all exercised prior to this virus hitting. There's going to be a fear element here, and it's going to take some time. So I think that speaks to much more of a U recovery as we move out of this unfortunate period.
All right, Chris Pollard, head of market strategy at Cowen. Thanks so much for being with us today, and be well.
Thank you.
Stay with us. We have got the CEO of Hasbro up next to talk about how the toy industry is actually a bright spot during all this. Stay with us. Welcome back to Yahoo Finance on this Tuesday morning. We have the Dow Jones Industrial Average, folks, up 8% right now. Again, there are 1,500 points. Want to check in with Ines Ferre for a closer look at the markets. Ines?
And Alexis, that's right. The Dow right now is up almost 8%, as you just mentioned. The S&P up 7%. The Nasdaq up more than 6%. Just taking a look at some of the Dow components that are leading the gains right now. You've got Chevron up more than 21%. These energy companies, which have been really hit because of the low oil prices, they're in the preserving cash mode. Chevron being the latest company to say that it will be cutting capital spending in 2020 by 20%, especially also in the Permian Basin area. It is also suspending its share buyback program, although it's saying that its number one priority is keeping its dividend. And just taking a quick look at oil to see where that's at right now, you're looking at WTI that's just above $23 a barrel, up more than 1% right now. Alexis?
All right, Inez, thanks very much. We sure all could use a little good news right now. And we are hearing that toy sales are actually up during this pandemic. Joining us now is Hasbro's CEO, Brian Goldner. Thanks so much for being with us. And I'm going to take a wild guess here and say that educational type toys are the ones you're selling the most of right now. Is that true?
What we're really seeing is that clearly people are all together and they're spending time together, and our games business is quite robust. You know, clearly people know our games brands, from Monopoly to the Game of Life to Operation and so many other games. People want to be able to spend some time together, quality time together, connecting. So games have performed incredibly well and are continuing to see very strong demand. Play-Doh products, as kids are entertaining their creativity, as parents are looking for ways to educate their kids and allow them to accomplish developmental milestones. Clearly another area of growth for us, and you know, a number of other products in the play school arena that are doing well for us. And then our partners, which we can talk about, have also advanced a lot of their home entertainment windows for their motion pictures, which have benefited our brands like Frozen and Star Wars.
Brian, always good to speak with you. You know better than anyone that major movie releases drive toy sales, but you have seen Disney come out here, delay, I believe, Mulan, Black Widow, a couple other. How will that impact the toy industry in the months ahead?
Well, look, I think there's still a factor of when, in fact, people are going back to retail, and that timetable, and us going from social distancing and spending time in homes to making that pivot to getting back to work and then back to more normalcy, I think will have an impact. Clearly, people are expecting that in third and fourth quarter, we get back to more of that cadence and that rhythm. I think the industry, entertainment industry, is reflecting that. Our own entertainment business is reflecting that. Clearly, there'll be some elements of first quarter episodic deliveries that may not happen in first quarter. It may get finished in the second quarter because, of course, we have editors and others working to finish episodes of television programming. I just think it all gets shifted back a bit. However, movies that were already produced are available to consumers today, and increasingly you're seeing, whether it's Amazon breaking the paywall, so allowing people to watch kids' content. We're seeing Peppa Pig being offered directly to Amazon shoppers. Through that window.
Brian, Dan Roberts here. I'm glad you mentioned streaming, because I know that you guys recently re-upped your contract with Disney for Marvel and Star Wars toys. You know, Baby Yoda has been such a merchandising hit. And I think Brian Sozzi made a good point about, you know, movies being delayed in theaters. But the flip side of that is that Disney and others like Universal with Trolls are now releasing movies earlier than planned on streaming, or releasing them earlier for rent. And I guess I'd ask whether you might actually see a positive bump from that. The idea that, well, if more people are watching streaming shows and streaming movies and they're at home, which has helped toy sales, ergo, maybe you see a boost for the toys that have some kind of connection to movies or shows. And obviously with Baby Yoda being such a mega hit, I think we've seen the theory that, you know, new streaming shows are going to have to try to have kind of one character, one thing that can be duplicated across various industries and toys and merchandising and licensing. So talk to us about that, and just how much Disney is really driving sales for you guys. How much of your boost lately is thanks to Disney and to Baby Yoda?
Well, our most recent sales are probably most thanks to people's embracing of our games business and our Play-Doh business. That's what we're really seeing accelerate now in the first quarter. those opportunities for people to play together and connect and make really robust connections around brands they love with the rules of the game that they know and wonderful brands that have been shared for generations. That's all really present. However, what you're bringing up are a couple factors. One is, we clearly have seen that streaming has become more of a force in making connections with consumers and driving merchandising. That's always been the question. Could streamed content drive merchandising? And clearly Baby Yoda has done that. We saw that in the fourth quarter with some of our Black Series product directly related to The Mandalorian. Our pre-sales around Baby Yoda have been incredibly robust, and we're very excited to begin to ship Baby Yoda late spring. We still expect to get Baby Yoda in markets, but consumers are excited about that, and also excited about the second season of The Mandalorian, which comes later in the fall. We're also seeing that overall Star Wars sales are performing well year to date because the movies was obviously incredibly popular, and then the home entertainment window has come more quickly, as has Frozen, as Disney has advanced those windows and made those home entertainment windows available to consumers more quickly on Disney Plus. We clearly see Disney Plus as a major advantage to Disney and also to partners of Disney, licensees of Disney like Hasbro, as we look at our properties.
Brian, I'm very excited about your animatronic Baby Yoda. Everybody in my house is. So you're saying late spring for that?
No, not the animatronic product. That's more of a holiday product, and we just previewed that on another program and throw that morning show in that preview. We sold out of that preview product, the pre-order product. That's more of a holiday product, but we'll have plenty of action figures and plush around Baby Yoda that will come late this spring, and that we've shown several SKUs of product around Baby Yoda and around The Mandalorian, which was already selling well in the fourth quarter. Some products around characters that we could reveal earlier. Remember, part of this was the reveal strategy where the filmmakers didn't want to reveal Baby Yoda until later, so therefore the product wasn't available till later.
Yeah. Brian, quick question about your supply chain, because so much of the toy industry is reliant on the supply chain coming out of China. What's the status of that right now as we see China sort of get back up and running?
Yeah, China is principally back up and running. In fact, our business, I'd say by the end of this week, we're fully back up and running. So that means that for the first quarter, there've been a few gaps, but now at a full capacity as we're running forward, we see by April, maybe early May, we would make up those gaps and get fully all of our product fully available. They've done an incredible job. Our teams have done an amazing job in Shenzhen and in Hong Kong, and working through obviously their weeks of working virtually, and now in Shenzhen are back in office, obviously abiding by all of the health protocols that we need to abide by and making sure our employees first and foremost are safe. But I would say that we're really back up and running in China, and it's giving us great access to those products being created there.
Brian, given the pickup in demand, we've seen a lot of retailers do some extra hiring full time. Are you doing any of that?
Well, we're not doing extra hiring, but we certainly have said we're going to continue to have our full employee base on board. We're paying everyone as we go forward. Principally, most of our company can work virtually, and that includes both E1 as well as Hasbro, and everyone's getting paid. But we do have people who are without laptops, whose jobs wouldn't call for a laptop, so therefore they're really not working, and yet we're paying them. And that includes co-ops and interns and others that have been with the company. We're paying those folks. So we'll want to continue to pay people. We think that that's our responsibility, to continue to try to pay people, and we would love to see us move through the curve over a certain period of time and get back to normalcy over the right period of time, having gone through the curve in other developed economies, and then getting people back to work. But for now, what we're doing is we're paying all our employees.
Well, that's certainly good news. Brian Goldner, Hasbro's CEO, thanks so much for being with us today.
All right. Thank you, guys.
And stay with us when we come back, a closer look at educating your kids at home. We're all doing it. We'll be back right after this. Welcome back to Yahoo Finance. We have millions of school kids at home now as we all are moving to homeschooling, as many schools are using software to bring their classes online. And this is K right through 12 and even into college. And joining us now to talk more about educating your kids at home is Stephanie Dua. She is the president and founder of Homer, a software-based early learning company. And Stephanie, thanks so much for being with us. You have some tips for parents as well, and we need them. We're going to get to that in a moment. But first, are you seeing increased demand for your product, for Homer, during this pandemic?
Yeah, I mean, it's unprecedented. We have seen 300% increase in just the last 2 weeks in demand. And I think that that is a testament not only to the demand for parents for quality learning materials, but also our relationships with schools and how we've been free to schools for some time and trying to support schools in any way we can during this crisis.
And Stephanie, what are some of the top selling items or some of the biggest things you're hearing from parents right now as their kids are home?
I mean, we're hearing a range of things, and it's changing, I'd say, by week, because to some degree, we don't know how long it's going to go on, right? So early on, it was sort of, how do I keep sane? How can I keep working? How do I create some structure for my kids? I think we're seeing shifts from, screen time too much, too little, to what does quality screen time mean? So I think there's much more of an acceptance amongst parents about the value of screen time. To, how can we stay sane? We have two working parents, kids trying to homeschool, parents taking shifts. So what can the rhythms be for parents and families, and how can they best support their children?
To that end, Stephanie, how important is it that we give our kids some structure? I mean, even I find myself, I need structure throughout all of this because our worlds have sort of been turned upside down. So how do you help your kids have structure right now?
Yeah, it's a great question. The way I like to think about it is kids, especially young children, view their own lives through the lives of their parents. They're our closest relationships. And so I really think of it as stability, and what you're trying to create is stability for your children during this time. I think about it like a three-legged stool. So on the one leg, it's predictability. So it doesn't mean you have to have a rigid schedule, but what are ways as a family you can have some predictability? In my family, at 5 o'clock, we all take a half an hour break and we read together. It could be having breakfast together, but what is something that kids can predictably rely on each day? The second leg of the stool is really agency, and this is really important for control for young children. So what are the small and big choices that they can make each day? It could be what activities they're doing. It could be, maybe teaching you something. Pick something each week that a child can teach you. They love that sort of agency and control. And then the third is quality. We're so busy. We have demands that we didn't even know. As working parents, we're not only working, but we're also trying to be a teacher at the same time, and we're not trained for that. So how do we think about quality interactions with our children, that allows us to have that kind of calm, compassionate time together?
Stephanie, we've seen schools, pretty much a lot of them closed for the rest of the year. Guys, testing done for many schools. What does that mean for child development?
Yeah, for very young children, they're not going to miss a beat, right? Because so much of young children, it's around these they're learning while they're playing. So the one thing we forget for young children is play is learning. So even unstructured time where they're playing or drawing, that's learning. As children get older, and the demands, and you're seeing this with, the disruption for college applications, kids trying to figure out how do they take their AP exams, what's going to happen for SATs and ACT exams, how are they actually going to tour colleges, how do they learn which colleges they want to go to? I think that, as the child gets older and, certainly the pressures on big choices for their life are more significant, I think that that's where some of the tension is.
Yeah, I can certainly relate. I have kids ages 10 through 17. I have someone that's going to be going off to college in the fall, and I can tell you everything has moved virtual. But how do you relate to your kids the fact that what they're doing right now is going to matter, that these grades are going to matter, and they need to sort of keep their head in the game, if you will?
Yeah, I mean, this is the tension for parents historically, which is like, how much is it the teacher's job to say it matters versus the parents, and I think it's both, right? I think it continues. This is where I come back to as much stability as we can provide for our children, and predictability, that while they're learning from home, they're still learning, while they're learning in a different modality, right? They're taking exams online instead of in a classroom. The weight of it still matters, and what they're learning matters, and even their class interactions still matter. This is all new for teachers, and teachers are also adapting and trying to figure out, how do I engage a class of teenagers? I have 2 teenagers and a 10-year-old, and I'll tell you, this is not easy, for a teacher to engage them online. So I think it's the repeatable message of it still matters, and it matters for you today.
All right, great advice, great tips. Stephanie Dua of Homer, thanks so much for being with us.
Great to be here. Thank you.
And stay with Yahoo Finance. Disney Plus is going to be rolling out in Europe. What a time for that rollout, right? We'll be right back with that and more after this. Welcome back to Yahoo Finance. No doubt you have gone to the grocery store throughout this pandemic, and you have seen empty shelves as Americans flock to stores to stock up as they spend time at home. And so we decided to reach out to the CEO of Tyson Foods, which is America's largest food company. And in our C-Suite segment today, I got to actually correspond with CEO Noel White via email, and he was able to tell me what they're doing there to assure that the food is going to get on store shelves. He did say, and it's important that everyone hear this and understand this, that the food supply in the U.S. is ample. It is more than sufficient. We are not having supply chain issues. But he did say that Tyson is pivoting away from supplying the food service industry, mainly restaurants and, of course, hotels, which we know have ground to a halt. And so he is pivoting their factories at Tyson to deal with the retail industry. And he said they can do this quickly by changing packaging at individual plants. They can pivot quickly because of their scale. And he's calling this the most significant shift they have ever initiated. So, Brian, it looks like Tyson definitely understands that they play a vital role during this pandemic, and they're trying to get product to market as quickly as possible.
Alexis, you know me, I love me some chicken. I just have not seen chicken in my local supermarkets going on 2.5 weeks. So I think in the supermarkets, there remains a lot of out of stocks. But listen, we've had Host Restaurant Brand CEO. We've talked to Papa John's CEO, Rob Lynch. so far the U.S. food chain is holding up well. We talked to PepsiCo North America food chief yesterday, Stephen Williams. He said the supply hanging in there. So I think this thought that we're going to run out of food, even though we are seeing in pockets of supermarkets, might be a little misguided.
All right. Also, I just wanted to share this inspirational quote. Noel White on his blog, on his website, shared a quote from the food master Jimmy Dean. And it said, "I can't change the direction of the wind, but I can adjust my sails to always reach my destination." I think suffice it to say, we're all adjusting our sails right now during this unprecedented time. Today, we've got Disney Plus rolling out in parts of Europe. What a time to do it, right? With a lot of people now just in lockdown, staying at home. What are they going to watch? Disney's hoping they're going to watch them. Heidi Chung is joining us now. And Heidi, I understand they rolled out in the UK. I don't know if that was the first European country, but they're experiencing glitches there.
Hey, Alexis. Yeah, so Disney Plus officially launching in 7 European countries today. We had the United Kingdom, Ireland, Germany, Italy, Spain, Austria, and Switzerland. Now, Disney Plus was also supposed to launch in France, but that launch has been delayed until April 7th. Disney will also, I just want to point out, be temporarily cutting its bandwidth usage by 25% earlier this week. And late last week, we heard some other companies were doing the same to sort of limit the online traffic that we had been seeing. And those companies were Netflix, YouTube, Amazon, and Apple. But like you mentioned, we have heard of some early reports that folks over in Britain were struggling to be able to sign up for Disney Plus, experiencing some glitches there. But I think the main question going forward is, it was such a huge successful launch here in the US. But when we take a look at the timing and the situation and environment that we are in right now, this could either be extremely good for the Disney Plus launch, or it could prove to be a pretty bad time for the company. So I think going forward, we're going to be paying very close attention to the actual numbers that the company provides, but also it'll be critical for this company to make sure that a lot of these countries aren't experiencing these glitches so people can sign up successfully.
Brian Sozzi, what are your thoughts? Is this a good time for Disney to be rolling this out? Should they have perhaps waited?
I can't think of a better time, Alexis. Everybody's at home. Why not try to get people engaged with Disney Plus? Very key initiative. I was now former CEO of Disney, Bob Iger. I just want to call attention to, we're seeing another big day in Roku shares, up double digits yesterday, up close to 10% this morning. Definitely a trending ticker page on Yahoo Finance. Again, Roku shares had not been playing at the stay-at-home trade, at least for the past 2 sessions. They're finally starting to catch a little wind.
Yeah, I want to take a look at Netflix right now here on my Yahoo Finance screen. Netflix is actually down just slightly, but it has rallied big time throughout this crisis as more and more people turn to Netflix. I want to check in with Inez Ferre now for a closer look at some stocks that are moving today. Right now, and as we've got the market higher across the board, we're off our highs of the day. I know the Dow was up better than 1,500 points earlier, now up about 1,300. S&P gaining 6.5%. We've got the tech-heavy Nasdaq up about 5.5%. What are you keeping an eye on?
Well, right now, what I'm keeping an eye on are the sectors which are all in the green. You have energy that's leading those gains. You also have materials, industrials gaining the least right now. You've got communication services, but still all the 11 sectors in the green. And then if we just take a look at some of the Dow components that are leading right now, Chevron have been announcing today that it's cutting its capital spending by 20%. Chevron right now up more than 15%. American Express, also a big gainer. And Boeing a big gainer today, which has lost so much over the last 3 weeks. Boeing is sitting at around $120 a share. And then if we just take a look at some of the FANG names you were just mentioning, Netflix, well, Alphabet is up more than 4% right now. Apple up more than 7%. You've got Amazon, which yesterday was in the green. Amazon also right now up around 2%. And then if we just take a look at Microsoft is gaining more than 6%. And just taking a quick look at oil, which has been bad. Remember that oil contracts in January were at $63 a barrel. Right now it's at $23 a barrel. Alexis.
All right, thanks very much, Brian. I'm going to give you the last word. What's a trending ticker you're watching?
Trending ticker, our good old friend Zoom Video Communications. The stock has been on absolute fire, almost a 45 billion market cap right now. Go figure, but the stock is down about 12% today as you see the broader market rally. We're finally starting to turn the corner on coronavirus. Obviously, tough call on that one.
All right. And again, we have all 11 sectors of the S&P 500 moving higher right now. We also have the Dow Jones Industrial Average up 7.5% at 19,999. We have all 30 stocks higher there. I just want to tell you what's leading the charge for the Dow at the moment. Chevron. We heard Inez talking about Chevron throughout the show, up better than 15%. Boeing bouncing back nicely, up 14%. American Express up 14%. A lot of the optimism we're seeing today is because of a possible fiscal stimulus package coming down the pike as early as today. House Speaker Nancy Pelosi earlier in an interview said that they could have that stimulus package out within hours. So that's one of the reasons why we've been rallying so much. Also, just out, U.S. new home sales dropped in February. I'm sure that's not a very big surprise. We're expecting to see even more erosion in the housing market as a lot of people unable to go out and even tour homes. A lot of that's being done virtually. So we're seeing demand for the housing market fall, even as mortgage rates sit near record levels. So again, a rally underway on Wall Street. Is it to be believed? A lot of the experts we spoke to said not yet, that this is just a mini relief rally. Stay with us. Much more to come on Yahoo Finance and throughout the day as we continue to broadcast to you from our homes. Do stay with us.
Just after 11 a.m. here in New York City, we are broadcasting live from Yahoo Finance. And we can tell you right now that we are enjoying a stock rally. The Dow entered this trading session off 34% from its peak. The Dow was off 37%. The S&P 500 was off 34%. But right now, we can see that the Dow is trading higher, over 1,300 points. The S&P 500 is up 150 points. The CDC reports that in the United States, we have more than 43,000 cases of coronavirus, with 537 people who have died. Globally, that number is approaching 400,000 cases. The Wall Street Journal is reporting that the Trump administration is going to use the DPA, the Defense Production Act, to produce 60,000 coronavirus tests. Wall Street is rallying today because the Senate is close to a $2 trillion stimulus package that will include oversight for the Treasury's spending of almost $500 billion. Speaker of the House Nancy Pelosi says there is possibility for House unanimous consent. Finally, the Tokyo Olympics have been postponed until 2021. Global airline industry expects to lose $252 billion in revenue, according to the International Air Transport Association, because of coronavirus. Good news today from Ford. Ford announced it is working with GE Healthcare, among others, to make ventilators. They are also testing new face masks. They expect to produce roughly 75,000 of these shields for local hospitals. That will come possibly towards the end of this week and next week, with more than 100,000 face shields produced per week when they are up and running. To discuss this and other things that Ford is doing to help the nation during this crisis is Jim Bombeck, Vice President, Enterprise Product Line Management at Ford. He joins us now to discuss what they are doing to switch their factories over. And one of the things is working with 3M to make air purifying respirators. Tell us about how quickly that can happen, Jim.
So we're having an immediate effect working in collaboration with 3M around increasing the throughput and capacity of their existing lines. In parallel to actually trying to get more out of what they currently have and adding capacity, we recognize that there's going to be a huge surge demand in the short run. So we've kind of gotten scrappy working with 3M and Ford jointly around the basic elements of air purifying respirator. There are some elements in automotive that we could use to create a simplified system and potentially increase in parallel capacity using different sets of components, but using some of those critical components that are inherent in the 3M machine. So think of, as an example, our initial design development was around using a fan blower motor out of a heated and cooled seat out of an F-150, mashing that up with the filtering technology that 3M is currently using in their production units, and then trying to create a additional battery pack source out of a power tool. A combination of that, working with the same design standards across the 3M production design and the simplified design, we're looking at how we can stand that up in parallel to get more of these to our first responders and healthcare workers.
Jim, it's Julie Hyman here. Thank you for joining us. It's amazing the efforts that we're seeing across industries to mobilize for this effort. I'm wondering if this is something that is being enacted in part because of the DPA, the Defense Production Act. How does it work in terms of payment to companies like Ford? Do you have to negotiate a contract with 3M or with the government directly? Are you paid at a full price, a discounted price, because this is an emergency time? How does all of that work?
You know, from the minute we started working down this path, we haven't really discussed any of that at all. The primary focus and the mission that Bill and Jim set us on is how do we help? And so we've been 150% focused on how do we help partner up 3M and GE Healthcare around getting more throughput, getting this critical protection equipment in the hand of first responders and healthcare workers. And our view is we'll sort it out later. There'll be mechanisms to deal with it, but what's most important is we get the stuff to those people that are in need and help these two amazing companies and collaborators around increasing the amount of output to get in patients' hands and first responders as quick as possible.
Jim, let me pick up on a point that Julie made, which is the cost. And you point out that right now is not the time to talk about numbers, but I'm curious what the cost is to switch over your factories to produce these medical supplies. And also, you've got a global footprint. Is there talk within the company to start mobilizing some of your other factories outside of the U.S., given that we're now dealing with a pandemic?
There is. We have some collaborative work that's happening in the UK. And obviously, we're sharing insight across both of our active activities, as well as trying to share openly. We've had discussions with GM, and we're going to follow up discussions with GM as an example around how we can make sure all of our efforts are net additive and they're not actually working cross purposes. In some cases, we may be pulling on the same supply base for raw materials, and we want to make sure that it's all synergistic. And everybody just wants to kind of band together to help. And I do think there are quite a few things we can scale quickly. what inspired us as we really dove into this over the last couple of days, listening to healthcare professionals, is the really strong need, not just for ventilators to help patients, and that's why we're collaborating with GE Healthcare, but these first responders and the way the virus can be contracted through multiple means. We wanted to think about how we could help levels of protection. And so certainly the air purifying respirators that we're working on with 3M are kind of the top level. But if you think of a healthcare worker that's using a disposable respirator, we've come up with a very simple design for a plastic shield that covers the full face. And while it's not the same level as a sealed air purifying respirator, this is another level of defense that we can scale very quickly. We expect to be up to 100,000 units within the week. We're currently trialing some of these parts in a couple of 3 different area hospitals with the intention of making this available to really everybody. And if you think about the basics of this, we need to make sure that there's a wide portfolio of protection available to everybody. First and foremost, the medical professionals and first responders, but really it actually extends to others like factory workers, which is going to be critically component. We're taking all those appropriate precautions for our amazing UAW partners that are a big part of this effort. And then store clerks.
Jim, real quick, I am curious. There was the news as we were coming into the 11 o'clock hour that Ford has decided it's probably not likely to restart its factories by the end of March. Are you getting any sense of when that might return to auto production from senior management?
No, I don't have anything more to share than what's already been shared. At the moment, we're just very focused on why we have this downtime. How do we repurpose it? How do we repurpose parts? How do we actually channel it to actually do more good around the critical need for the country?
All right. Jim Bombyk is the Ford Vice President of Enterprise Product Line Management, and I know the nation appreciates what Ford and several companies are doing to try and get our healthcare workers the necessary products that they need. All the best to you and the team at Ford. We want to turn our attention to what's happening on Capitol Hill with the stimulus package pending, $2 trillion. To help us understand how this could impact the economy is Nouriel Roubini. He's a professor of economics at the NYU's Business School, the Stern School. And Nouriel, you were with us within the last 10 days, and you said it would be possible to avoid, you used the word depression, if the stimulus package was large enough. Do you still feel that's accurate?
Well, at this point, it's clear that we are going to have a recession that is more severe than the global financial crisis. Even the IMF, even folks on Wall Street that weeks ago were talking about a mild correction or a V-shaped recovery. Now, Goldman Sachs, JP Morgan, Morgan Stanley say in the second quarter, up is going to fall between 25 to 30% annualized. So we're already in a state in which this is going to be a very severe recession, worse than the great financial crisis. It's been front-loaded. This has been actually so far worse even than the Great Depression, because the free fall of output did not occur like in the previous episodes in 3 years, but in 3 weeks. The stock market, the credit spreads, the unemployment rate, credit market seizing, employment, economic activity, consumption, investment, capex, everything is in a free fall. It's not a V, it's not a U, it's not an L, it's an I, it's a straight one down. So right now we are on the verge of something could be worse than the great financial crisis. There are conditions under which we could get into another greater depression. Now, the good news is that the central banks are doing everything necessary. Pretty much all the kitchen sink of policy tools that were used 10 years ago are being used again. Fiscal policy has been behind the curve. We'll see whether this package is passed, but we need similar types of packages, not just in the United States, but also in Europe and other parts of the world. But I think that the key things for the market and for the economy is going to be to deal with this spread of the pandemics, because markets are not going to stabilize. Today they're up because there'll be a fiscal deal. But if the news are going to be, as they've been for the last week, that the rate of spread of contagion is 30% per day, that means that every 3 days, the number doubles. In a month from now, we'll have 500,000 cases in the United States. And therefore, we're not going to be able to reopen economic activity. Economic activity is already worsening more than expected. Therefore, the economy can still tank. The market can go lower after the good news of today. And if that happens and the contagion is not stopped, then we'll have the condition for having a depression, not a recession.
Noriel, it's Julia LaRoche here. So what I'm hearing from you is that the best case scenario is that short-lived recession that you're referring to, that we would get to growth in the fourth quarter. But as you're referencing, that depends on, that's contingent upon the kitchen sink Federal Reserve monetary policy, getting the virus under control, getting the right fiscal stimulus. So I'm wondering, because even that scenario doesn't sound so great. The depression scenario that you lay out sounds really dire. Are we past the point of no return at this point?
We're not past the point of no return. There'll be a great recession, more severe than the global financial crisis. That's consensus. You ask anybody now on Wall Street, they say this is going to be worse than 10 years ago. That's agreed. It was not a month ago, but now we're there. The question is, are we going to have a three-quarter severe recession worse than 10 years ago? And then by the fourth quarter, we have a recovery, or it's going to get worse? I think the condition and the things get worse are the following one. First of all, if we don't do a full lockdown of the economy for a month or two, the way China did and the way Italy is doing right now, this thing is going to explode. So this idea of reopening everything in a week after 2 weeks doesn't make any sense. Even in the UK, Boris Johnson decided we're going to shut down everything, lockdown fully and compulsory. We're not doing it, and that's dangerous. Even if we were to do that, by next winter, we know that this virus is going to mutate, and we're not going to have a vaccine until another 18 months. And unless we find miracle antivirals or therapeutics going to work, every study scientifically suggests there's going to be a return of this infection under a different form, mutated. So by the time we're supposed to recover in Q4, it'll be winter, and we'll have another round of this thing, maybe less severe than this time around, but again. Secondly, by that point, the stimulus is going to run out of steam. And for how long we can do budget deficits of 10% of GDP fully monetized by the central bank? We can do it for a year. Can we do it for 2 years in a row? At some point, given the supply shocks that imply there'll be less production, there'll be bottlenecks. If you monetize fiscal deficit, you're going to have stagnant deflation, meaning recession and inflation at the same time, stagflation. That's a risk we're facing right now. And on top of everything else, there is a bunch of geopolitical risk, US and China. There is a collision course. There are a bunch of revisionist powers like China, Russia, North Korea and Iran that are going to be interfering in our election. We'll see what's going to happen with the election. There is a risk of rigged election and confusion and political chaos. And I would not even rule out that Iran is going to strike the United States by the middle of the year. They'll start a war in the Middle East because they need to have regime change in the US. If Trump stays in power, the regime is dead. So they're going to escalate conflict in the Middle East. So we have the combination of having a pandemic that might not be contained, running out of policy bullets, and having rising geopolitical risk that could lead to what I've called the Greater Depression rather than the Greater Recession. That's the risk we're facing right now. The Greater Recession was already baked in the numbers and its consensus. The question is whether there are downside risks. I see downside risk compared to the baseline of a Greater Recession.
Noriel, it's Julie here. So we're talking about potential depression or a greater recession here in the US. Talk to me more about what a global recession or even depression could look like. Because in addition to the countries that you mentioned, yes, China coming back online slowly, but Italy shut down, Britain shut down. Now India talking about a 21-day lockdown for a nation of 1.3 billion people. Are we going to see a coordinated global depression?
Well, what has happened this time around is usually when there is a recession in one country or one region of the world, there is economic growth in other parts of the world. This time around, it's as if an asteroid that hit planet Earth all at once, and you have a complete collapse of economic activity in US, in Europe, in Japan, in China, in Asia, in emerging markets, in advanced economies. We have not seen anything like this. And even China, where output collapsed at the rate of 40% in the first quarter, is not going to recover in the second quarter, because now the consensus is that in US and Europe and other advanced economies, economic activity is going to collapse at the annual rate of 40% in the second quarter. So how can China recover when it's a major exporting country, when the rest of the world is going to have a more severe recession in Q2 than Q1? So in Q1, China faced a negative supply shock. in the Q2 quarter is going to face a massive demand shock, and that's going to exacerbate the global economic contraction. Now, we know everybody in the world there'll be a recession in Q1, in Q2, and it's going to spill over in Q3. The question is whether by Q4 you have a recovery or you end up into a depression. And I think the answer to that depends on whether we do the right policy action on the health side. We're not doing it in the United States. We're not doing it everywhere in Europe. That, I think, is the biggest risk. The idea that you're going to release the rules about kind of social distancing in a week from now is totally crazy. I mean, look at what happened in Italy when they did it too little, too late, and now there is a nightmare. US in a week from now or 2 weeks from now is going to be worse than Italy at this rate of increase of the spread of the contagion. So if we don't do the right health response because we want to jumpstart economic activity too soon, it's going to be a nightmare. And by next winter, it's going to be another round of this virus mutated. And we're going to run out of policy bullets because we cannot run 10% of GDP this year, next year, another year, let alone other geopolitical risks that are looming over the horizon. That's why I worry about a greater depression, not a greater recession. The greater recession is baked in for the world. You have to start to worry about the greater depression.
All right, Nouriel, hold that right there. We're going to have more with Nouriel Roubini as we go to break. Just want to let you know that at this point, the Dow, the S&P 500, and Nasdaq are all in positive territory. The Dow now up almost 1,400 points, S&P 500 up 152 points. Also want to let you know, breaking news from the governor of New York, who says the rate of new infections is now doubling every 3 days. The governor, that would be Andrew Cuomo, also says they expect cases to reach their peak within 14 to 21 days in New York State. We're going to have much more for you on Yahoo Finance when we come back. Welcome back to Yahoo Finance. The Dow, S&P 500, and Nasdaq all in positive territory. The Dow is up more than 7% as we continue our discussion with Nouriel Roubini, the professor of economics from the NYU Stern School. And Brian Chung has a question for you, Nouriel.
Hi, Nouriel. Brian Chung here. So I was listening to your earlier point about the worries about debt increasing. Obviously, this stimulus package, whenever it's passed, is going to be a pretty large package. But I'm just wondering, how big should Congress be going in terms of, creating something big here? I mean, if it's going to add substantially to the national debt, how do you worry about the inflationary pressures, even though despite the Donald Trump administration continuing to increase the debt, inflation really hasn't been a huge issue over the post-crisis period?
Well, the entire budget deficit, about $2 trillion, is going to be fully monetized by the Fed. The Fed yesterday announced unlimited QE. So every single piece of Treasury bills, notes, and bonds issued by the Treasury is going to be bought by the Fed. Now, in the short run, that's the right thing to do. It's what people call a helicopter drop of money or modern monetary theory, and now it's become mainstream. Used to be a leftist radical idea, but now people like Stan Fisher or Ben Bernanke or Ray Dalio are saying that's what's needed. And it's needed because if you have a $2 trillion budget deficit and the Fed doesn't buy all of it, long-term interest rates are going to sharply increase, and that's going to crowd out the recovery. So we have to monetize the fiscal deficit. That's necessary. The problem, however, is that this is not a demand shock like the global financial crisis. There is a supply shock. Global supply chains are going to be affected. Soon enough, we're not going to have even workers in California to pick up the fruits and vegetables. And that's going to be a negative supply shock. It's going to increase food prices. We're going to have more deglobalization, more balkanization, more decoupling between US and China, more fragmentation of the global economy, more inward-oriented policy, protecting your country, your firms, your workers, more protectionism, more tariffs. All these things are negative supply shock. They're going to increase cost over time, and they're going to reduce potential growth. Now, you throw massive fiscal stimulus and you monetize it into an economy that has negative supply shock. In the short run, you have a recession and deflation. But over time, like the 70s, when we had this negative supply shock, oil, 73, 79, what did we do? Budget deficits and monetize them. What we ended up with stagflation, recession, and high inflation. So in the short run, we have to worry about deflation, but these policies cannot be run all the time. Otherwise, we end up like Zimbabwe. We end up like Venezuela. You end up like Argentina. You can end up with high inflation, if not hyperinflation. So you cannot fool all of the people all of the time. For the time being, we can do massive stimulus this year, 10% of GDP, fully monetized by the Fed, and we're not going to get inflation. Once we have supply bottlenecks, and it's going to get worse because we are in a world in which you'll have a whole series of negative supply shocks. You cannot fight negative supply shocks with deficits and debt and money. If you do that, you end up into stagflation, recession, inflation like the 1970s. And in the next couple of years, we could be there. That's why at some point you have to absorb the shock. You cannot kick the can down the road.
Nouriel, I want to get back to a point you made earlier about this, the need for a complete shutdown, whether that is 1 month or 2 months. And of course, you've sounds like you're strongly opposed to this idea the president has floated that, maybe in a week or two, we start testing and then some workers return. Can you help us understand from an economic standpoint, how that kind of approach the president is floating would complicate the overall recovery, sort of a stop and go approach?
Well, the experience with China has been you shut down everything for 2-3 months, the number of cases goes to zero, and then you start and restore economic activity gradually. And that's the right thing to do. The other example, the extreme, is Italy, that did not take the problem seriously, and then now is exploding. You have 8% mortality, you have 40,000 cases and increasing by 20% every day. And too little, too late, they reached what China did. But when the genie was out of the bottle, now they have an economic nightmare, 8% mortality rate, still 20% increase. And we're having a situation is out of control. And as you pointed out, Cuomo, governor of New York, just said the numbers are increasing 30% per day. That is doubling in 3 days. It's not just in New York State. All over the US, the numbers are 30% increase. As I said, in a month from now, we're going to have 500,000 cases. In China, you had only 80,000. Think about what's going to happen. This economy, if you don't shut down everything for a month or two, whatever it takes to stop this contagion. If you restart economic activity, you get a short-term benefit, and then you have to shut it down for 6 months rather than for 2 months. So this idea that we're going to restart everything soon enough in a week or so is totally nuts. Look at what happened in Italy and compare it to what happened in China. Be the worst thing you can do. It's going to be a nightmare. It's going to imply that we're going to end up into a depression.
Noriel, it's Julia again. I just want to get your reaction to some recent investor comments that have even been made on our air. Some folks see the market right now, what's happening, as a buying opportunity for a bargain of a lifetime. We've seen that characterization. I'd like to get your reaction there. Do you see further downside? And then separately, someone wants to know your thoughts on Bitcoin. So can you answer those two quickly? Thank you.
Well, I have a kind of a proprietary tool that is a boom bust kind of signal of the stock market that was showing already in beginning of February that the market was totally overbought and a massive correction would occur. And that signal then has led to a correction of 35% down. That signal today tells you that the market may be close to a bottom, but conditional on the macro and the health response. And I think that what's going to happen is that today the market can go down, can go up another 5, 7, 8%, pricing in the monetary and the fiscal stimulus. But then all the policy good news are gone. And think about what's going to happen in the next few weeks. You'll have terrible news that every 3 days the number of cases is increasing in US. The number of deaths are doubling every 3 days. And the economy is going to keep on surprising on the downside, because even the consensus forecast right now is not pricing in output falling in the second quarter at the annual rate of at least 40%. That's the number we're facing right now, 40% fall in GDP. So the economic news are going to be worse than otherwise. The health news are going to be worse than otherwise. The market need to know, and they have to be able to price in when the contagion is stopped. And unless you do massive testing, massive tracing, massive quarantines, massive lockdown, not voluntary, they have to be compulsory. You get out of your home, you end up in jail, like they did in China and now in Italy. If you don't do that, then the market cannot price something that is not risk, but is what's called uncertainty. You have no idea when this is going to end. And therefore, those bad news are going to push the market lower and lower. So all the good news as of today are going to be already priced in. Monetary and fiscal bazooka. Okay, done. Trillions of dollars of stimulus on the monetary and fiscal. What's going to be the economic news? Worse. What's going to be the health news? Worse. What's going to be the contagion news? Worse. So the market from now, after today, can go only south until we take seriously the issue of locking down the country for as long as it takes. The market is not going to bottom until we do that. We might do it too late, like in Italy. That's going to be a nightmare.
Nouriel Roubini is a professor of economics at the NYU Stern School of Business. We appreciate your being here with us on Yahoo Finance. Just want to let you know as we go to break that the Dow, S&P 500, and the Nasdaq are in positive territory, and the Dow is back above right now 20,000. Going to last too long, in his opinion. When we come back, we're going to be talking more about the impact from coronavirus on the airlines and the potential for a $252 billion loss worldwide in revenue for all of the airlines. It's a little after 11:30 here in New York City. Welcome back to Yahoo Finance. And as we go into the next half hour of the trading session, the Dow is back above 20,000 to discuss the impact of coronavirus on the world's airlines. We are joined now by Brian Pierce. He is the chief economist at the International Air Transport Association. And Brian, I think everybody gasped when we saw the prediction that revenue will fall $252 billion this year, according to IATA, for the world's airlines. Is that an underestimate, or could it be even worse?
Well, it's been getting worse as countries have closed their borders and put travel restrictions on. Particularly in Europe, international aviation is almost at a halt. I mean, it is unprecedented. That 200 billion sounds a large number. Obviously, it's a big industry. This is an $800 billion industry, but we are in unprecedented circumstances.
Brian, you mentioned on the call today that when you look at the airlines globally, a lot of them did not go into this outbreak in a good position. You said on average, the balance sheets, typical airline had just 2 months of cash left. When you look at where we are right now, the potential of this in terms of a lockdown lasting 1 to 2 months, what do you see the industry looking like on the other end? Because it sounds like you think there's going to be a lot of consolidation and a lot of airlines that just aren't going to make it to the other side.
I think that's correct. Obviously it depends where you are. The U.S. industry is already fairly consolidated. Many airlines there have got strong balance sheets that put them in a good position. But certainly in Europe and in Asia, there are a lot of airlines with a very weak financial position. I should expect to see that we come out of the other side of this with a much more consolidated industry in those regions.
And Brian, as you say, we have seen the U.S. industry going into this already having made a lot of changes over the past few years. There's been consolidation. There's been more capacity constraints. Is there more? The airline industry has been vulnerable to these types of shocks in the past, although obviously this is an unprecedented shock. Is there anything else that it can do in terms of defensive changes coming out of this to perhaps help weather these storms better?
Well, I'm not sure that any firm is in a great shape to weather this sort of economic shock. It's as your previous guest pointed out, this is really an unprecedented supply shock and turning into a demand shock. Even if you're a very solvent firm, you'll be challenged if your market disappears and your revenue falls away. And particularly airlines have got fixed costs around the aircraft they own, which need to be paid.
Brian, I'm curious, what does global air travel look like after this crisis passes? Will we see new restrictions on the ease of movement globally?
Interestingly, air travel is normally really resilient to the sort of shocks. This is unprecedented, but we're an industry which faces all sorts of shocks, from pandemics, from terrorist attacks to global recessions. In the past, passengers and air travelers always bounced back pretty quickly afterwards. I think this time it's going to be a lot slower because of the global recession, which is certainly going to see a delay of a return to air travel. But it's a pretty resilient industry, and even if markets are fairly mature in the advanced economies, there's a lot of growth that is expected in the emerging economies.
Brian, one of the things that you pointed out that has changed from last week to this week is the activity you're starting to see pick up out of China. I don't know if we can call that a silver lining, but can you walk us through specific numbers that you're seeing on the uptick and how quickly that has come, or whether that has come slower than you anticipated?
Yeah, so China's probably in the third month of since the start of the crisis, since the start of the outbreak there, and we're actually seeing the domestic travel market stabilizing. So flights are probably at 50% of what they had been planned at, and they were down, down 80%, down 90% a month or two ago. So so they're flying again, and seats are being filled. So load factors, the proportion of seats on the planes are up to about 60%. So we're nowhere near travel returning to pre-crisis levels, but it's stabilizing. It's starting to rise, and fares and yields are stabilizing. Airlines were having to discount at a rate of 25% of a year against a year ago to try to keep passengers traveling, and in March they seem to be stabilizing. So I think those are positive signs there. But on international markets, China is once more having to impose restrictions, because although it's got the COVID-19 cases under control domestically, it's now finding that it's importing cases as people travel from outside.
All right, Chief Economist at the International Air Transport Association, Brian Pierce, thank you for being here on Yahoo Finance. We know you're joining us from Geneva, Switzerland. We're going to stay in Europe because Oscar Williams-Groot has the latest for us from the UK, where Boris Johnson, a little bit slow to the game, is now calling for a lockdown. Oscar?
Well, Adam, he's done more than calling for a lockdown. He actually announced one late last night in a special address to the entire United Kingdom. There had been rumors circulating for almost 2 weeks now that we could see a partial lockdown across the UK, but the measures announced actually went further than most people expected. What had been rumored was a shutdown just in London, which is said to be 2 to 3 weeks ahead of the rest of the UK when it comes to the spread of COVID-19. However, last night, Boris Johnson and his counterparts in Wales and Scotland announced a full lockdown of the United Kingdom. That means that all non-essential businesses are now closed. Only things like groceries and pharmacies can remain open. All citizens have also been told to remain in their houses. They can only leave for a small number of reasons. For example, exercising once a day, going shopping infrequently, or to collect essential medicines. Groups of more than 2 people have also been banned on the streets, and police have new powers to enforce this. They can hand out fines to anybody found flouting these rules. Now, Boris Johnson said he recognized that these were incredibly tough measures, but said that they had to be done to slow the spread of the novel coronavirus. He used wartime language, saying that the population have been enlisted to help to try and flatten the curve against this virus and save the NHS. The big question now is, how effective will these measures actually be? Will people follow them? I live in central London here. I've been looking out the window and I've seen traffic wardens still on the street. You'd think of all people, they would be gone, and people still wandering around in groups of 2, not 2 meters apart. I just looked out the window before I came on air here and saw people sitting at the bus stop. So the measures have been announced. So far, I'm not sure they're taking effect.
Oscar, thank you for joining us. As we head to break, the Dow is now up more than 8%. We're going to have more for you here on Yahoo Finance. Welcome back to Yahoo Finance. The Dow is now up more than 1,530 points. The S&P 500 up more than 164 points, and the Nasdaq up 452 points, awaiting the news that a deal has been struck on Capitol Hill for a $2 trillion stimulus package. One of the other bits of good news today is that many companies are actually hiring. Julia LaRoche is in constant contact with Walmart, and they're just one of the companies that needs workers. Julia, can you tell us more about this?
Hey, that's right, Adam. Well, when you think about it, now that we've seen a lot of businesses closing up, a lot of localities, cities moving to a shelter-in-place regime, basically meaning that only essential businesses can be open. Well, a lot of that means the grocery stores are being open. And when you think about Walmart, it is within 90% of the U.S. population lives within 10 miles of one of these stores. I know my hometown back in Virginia, Walmart is one of 2 grocery stores, and people have been stocking up on those pantry staples, things like toilet paper and whatnot, and they're seeing constant demand. So CEO Doug McMillon came out recently and said that, look, they're hiring 150,000 workers. A lot of that will be temporary, though they hope to convert some to full-time to keep up with the demand and also provide a lifeline, that next paycheck for a lot of Americans who are struggling. Look at the hospitality industry, for example, or the restaurant industry. Those are industries that Walmart is going after to help those folks get by while we wait for the government to act. So you are seeing the private sector step up. Amazon is another one, hiring 100,000 workers. CVS, again, on the front lines when you think of the neighborhood pharmacy, the same kind of deal when you think of the location, looking for 50,000 people. Instacart, when you think about grocery delivery, 300,000 people. Albertsons, another grocery store. Dollar General, another area where a lot of people, I grew up in the country, another area where you would get your groceries. They're looking for 50,000. PepsiCo, you're talking about consumer packaged goods on the shelves. Papa John's, Pizza Hut, Domino's, they're all hiring. People are ordering their food. They're still going after their pizzas. And 7-Eleven hiring 20,000. So it's a bright spot because we need a bright spot right now. We are talking about millions who could be filing for unemployment insurance just this week alone.
And yet, Julie Hyman, we heard Nouriel Roubini say in the last half hour that if these kinds of people get ill, that could be a real shock to supply chains.
Not only to supply chains, but obviously to health and safety, right? Because yes, it's a lifeline financially for many of these people. The question is, are we seeing retailers, not just the large retailers, but smaller retailers, smaller grocery stores that are still open, take proper precautions, right? For example, I went to my local grocery store recently, no mask, no gloves on the part of the cashier, and you're definitely less than 6 feet away from that person. So that's something I've been wondering about, the policies of these grocery stores as we get further into this crisis.
All right. As we go to break, just want to let you know that if you are looking for work, the Yahoo Finance webpage Cache is covering how to apply for some of these jobs from all angles. Again, they will walk you through how to apply over at Cache, Cashay. So when we come back, we're going to watch this market rally, and we're going to talk also with the labor economist from ZipRecruiter. Welcome back to Yahoo Finance. We are joined now by the labor economist at ZipRecruiter, Julia Pollack, to talk about where we are seeing job losses. Also joining us is Alexis Keenan. And Alexis, I know you've been covering this, so I'm going to throw to you to ask this first question.
Hi, Julia. Thanks so much for being with us. I wanted to talk to you about some of ZipRecruiter's data showing that really steep slide in the number of small business starts that started to happen just after the last recession in 2008. And small businesses, according to your data, just never recovered from that. Looking at one of your tables, it shows that just 12 years out from 2007, that starts for these new small businesses in the US at fourth quarter 2019 down to about 115,000 starts. That's just half of what there were in 2007 at 230,000. So I want to hear from you about whether the coronavirus impact will really compound this problem.
Yes, one, it'll compound that problem, and two, because there were so few small business starts, because the labor market is so dominated by large players, we could see larger job losses than we would otherwise see, because large companies tend to lay off more workers in a recession than smaller companies do. Small companies are lean, they really don't have much fat to trim, but large companies can often lay off hundreds, sometimes thousands of workers at a time during a recession.
Where do we see some of these job losses? I mean, obviously, we know the airlines, tourism, right, Julia?
Yes. But really what I find quite alarming is that we're seeing declines in almost every industry. And the only major industry that showed an increase in job postings was the nonprofit sector over the past 4 weeks. Of course, if you drill down and look by job category or by job title, there are areas where there is growth. In some areas, there's explosive growth. So for example, with e-commerce jobs, typically on a regular day, there are about 4,000 e-commerce related jobs open. At the moment, there are more than 12,000, and they are just growing very, very quickly as existing stores and restaurants pivot and try to sell their goods online and forge partnerships with delivery drivers. There's another area where we're seeing a huge increase in delivery driving jobs and in warehousing positions. So, even in the worst kind of crisis, there are always companies hiring, and companies are innovating and trying to find ways to keep their factories humming, their stores producing, and revenue rolling in.
Julia, this is Julie here. Can you give us a little bit more granularity about large companies versus small companies? At a typical time, do you know the breakdown of who's listing on your site between large and small, what that looks like right now, and how much it's changed?
Yes, we do. We ask employers how many employees they have. I actually have a chart right in front of me, and among the smallest companies that have between 1 and 5 workers, job postings are only down 2%. Whereas among larger companies with 500 to 3,500 employees, job postings are down 11-12% over the past 4 weeks. Actually, that's over the past week. So we're seeing a huge decline, and it's happening very rapidly, particularly among large companies, whereas small companies are pretty reluctant to pull down their job postings. Chances are, if they were looking for someone, they still need that person. So there are still jobs, and job seekers shouldn't completely despair. There are areas where employers are hiring. I mean, just in the last week, more than 100,000 jobs were added to ZipRecruiter, and many of those say hiring immediately, desperate for candidates. So there are opportunities out there. But yes, this will be a tough time for workers and for businesses, for sure.
Julia, this is Alexis again. I wanted to ask you about the reports that we're seeing with Walmart, Amazon, CVS hiring hundreds of thousands of workers right now. Also Instacart saying that they are going to be hiring 300,000 more employees that will more than double their current workforce. Do you think that this time around that things could be a little bit different with those large companies coming in to pad employment temporarily until workers can go back to their regular jobs?
Right. So, those companies are really an exception, though, among large companies. We're seeing declines in many other areas. But that is definitely one bright spot. Many companies, for many companies, this is a breakout moment, right? Consumers are being forced to switch to online shopping, online entertainment, online learning, and working from home. And there are companies that stand to benefit from that and that can expand their market share. Once you download that delivery app and you become used to hiring buying your groceries through Instacart, that habit might stick. And so this is a great opportunity for companies, and many companies are seizing that opportunity. Another very encouraging story is how many large companies are pivoting to producing the goods that are needed to solve this health crisis. So GE, Tesla, General Motors, Ford, they're all pivoting their production facilities to produce medical equipment like ventilators. Razer, a video game company, is producing surgical masks. So there are some companies that, instead of sitting by as revenue falls to zero and closing their stores, are maintaining their productivity and using their capacity in a different way so that they don't need to lay off workers.
All right, Julia Pollack is joining us from ZipRecruiter. We appreciate your being here on Yahoo Finance as we go to break. The S&P 500 and the Dow, as well as the Nasdaq, all in positive territory. The Dow back above 20,000, expecting news of a deal in Congress for a $2 trillion stimulus package. We're awaiting word that that deal has actually been struck. We have more for you as we take you through the trading session here on Yahoo Finance. Dire news from the governor of New York about coronavirus and the number of cases. Welcome back to Yahoo Finance. Anjali Kamlani covers coronavirus for us here, and she has the latest on the numbers. Anjali?
Thanks, Adam. Yeah, so as you mentioned, Governor Cuomo really saying that this outbreak is set to hit the state within the next 2 weeks is when we're going to reach that peak of cases and when we are likely to need the makeshift hospitals as well as additional medical equipment. So really a point of concern right now. And we know that as the federal level, we're watching to see just how that works out in terms of where the allocation of resources goes. We've already seen, one naval hospital ship sent up here, as well as the additional medical equipment as well being directed here. So that should help with what the outbreak looks like in the area. But it is in addition looking at what will happen in the city. We know that the city was, getting some criticism for not practicing proper social distancing, and the governor was talking to Mayor Bill de Blasio about really ramping up those restrictions and making sure that people are in fact practicing that, so that we can in fact flatten the curve. Earlier, the governor said we are not flattening the curve. So waiting to see what that looks like. Meanwhile, we know Washington State also dealing with the fallout. The Centers for Medicare and Medicaid Services did recently release a report identifying some of the problems and hoping to implement some of the learnings nationwide with the 15,000 nursing homes there. California, as well, as we know, another stronghold of the virus. So as we watch the days go by, we know that testing has increased and that we will continue to see an increase in those cases, right now nearing 400,000 worldwide and more than 17,000 deaths. So that should be a number to keep an eye on. Meanwhile, almost 50,000 cases in the US. So we're definitely going to be seeing a little bit more of that this week, Adam.
Angelique Hamlani, thank you very much. As we head to break, I want to let you know the Dow is now up almost 9%. The S&P 500 and Nasdaq also in positive territory. We're getting ready to take you through the next 4 hours of trading here on Yahoo Finance. We'll be back right after this.
You're watching Yahoo Finance Live. I'm Julie Hyman, joining you as I have for the past several days from home, as are my colleagues and all of our guests for that matter. Just wanted to bring you some of the headlines that we are following at this hour. We have been hearing from New York Governor Andrew Cuomo, who issued a plea to the federal government to initiate the Defense Production Act to transfer production of other companies to make ventilators instead. He says the state is far short of the ventilators it needs as the cases continue to climb. Worldwide, we have now topped 392,000 cases of coronavirus and 17,000 deaths. Here in the United States, we've been getting some economic data that is giving us an idea of what is perhaps to come on the economic front. Among other things, we've got the IHS Market Services survey today for the month of March. It hit a record low of 39.1 as we have seen closures of so many different types of companies. All of this as Congress debates the stimulus package. We have heard various comments saying that now we are getting closer and closer to agreement on that package. We're going to keep you posted on all of that. I'm going to be joined over the next hour by my colleagues, Adam Shapiro, Rick Newman, Dan Halley, Melody Hom, as well as Julia LaRoche chiming in from time to time as well. First, I want to start with what's going on in the markets today, because we are seeing a pretty dramatic rally right now in the major averages of around 8%. Jared Blickery is with us right now for the latest on that. Jared?
That's right. We're seeing the Dow up over 1,600 points, good for that 18 or 8% that you were just mentioning there. And we can see the S&P 500, that's up 7.7%, the Nasdaq up 6.66%, and then the Russell 2000 up 7% as well. But we're going to take a look at a 2-month candlestick view of the S&P 500 here, and just kind of breaking out of this very steep downtrend that we have going on. So that's a little bit of that's some good news here. And we also have the Fed in the market this week buying $625 billion worth of bonds. And we did see the 10-year T-note yield sink yesterday, but it is up 11 basis points today. That's a pretty big jump. And then when you look inside the bond complex, you have the real yield and the break-evens. Break-evens are jumping. That means inflation expectations are increasing as well, and that bodes well for equities here. Not saying that we're not going to eventually sell off again, but we got the makings of a tradable bounce that could last several days, maybe even a week. So here's the VIX. We have it down from highs. It was over 80 just a few days ago, and we can see the VIX itself has been very volatile as people scrambled for protection, but now they're easing up on that a little bit. Also, US dollar index retreating from multi-year highs here. That's good news for emerging markets and the multinational current companies, and also for people who are just scrambling to get a hold of dollars any way they could. The Fed has opened those Fed liquidity lines. And then we have WTI crude. Now that is up just a little bit, 1.4%, but energy happens to be the leading sector today. And then I got to take a look at gold, because gold is having its best day since the financial crisis right after Lehman. And this 2-day spurt here worth, I don't know, about 11, 12%. We haven't seen anything like that since the Fed kicked off Bazooka QE1 in early 2009. So let's take a look at our heat map. We're going to be taking a look at the Dow. Lots of green here. We do see Walmart, a staple, is down 1%. Staples had been outperforming, now the reverse. But in the upper left, we see Microsoft is up 7%, as is Apple over that amount. Financials are doing well. JP Morgan up over 12%. But when you take a look in context, year to date, still down 36%. We're seeing a lot of outsized move by some of these stocks, but you got to put them in perspective. Julie?
Yes, indeed you do. And at least some of the rally that we're seeing overall today looks like it has to do with hopes for a stimulus package. Let's go to our Jessica Smith now, who is in Washington, D.C., which is also, by the way, just announced all non-essential businesses there will be closing. But Jess, what's the latest on the stimulus package? We keep getting football analogies. I think we're on the 2-yard line now?
Right. Minority Leader Chuck Schumer said that they are on the 2-yard line. Hours earlier, Mitch McConnell had said they were on the 5-yard line. So 3 yards of progress so far. But we are getting close to a deal, according to everyone who is involved in these negotiations. We heard from Mnuchin saying they were close. Speaker Pelosi also said she was optimistic something would get done today. Schumer and Mnuchin just left a meeting, and Schumer says that he does not see any outstanding issues that cannot be overcome in the next few hours. So we'll be looking for this final bill and any timing on when they could vote on it. We know one of the issues that Democrats have really been looking at is that $500 billion that is going to go to certain industries that have been hit hard by the virus. Democrats have been pushing for more oversight. Pelosi and Schumer says that they are working for an inspector general to oversee those funds, and then a congressional panel as well. So we'll be looking for more details on that. But Pelosi seemed to be optimistic about the changes that Senate Democrats have hoped for. And getting Pelosi support is really critical here, because the House is not in Washington, D.C. House members are spread across the country in their districts. And once the Senate passes this package, they could vote on it a couple ways. One way, the quickest, would be to do this by unanimous consent, but everyone would have to be on board. That would only require 2 people to actually be in the Capitol here in D.C., but everybody has to be on board. Otherwise, they'd have to come back to D.C., either look at the Senate package or take up the House bill that Speaker Pelosi announced yesterday. So we'll be sure to keep you updated on how this shakes out over the next couple of hours.
And of course, there is some urgency involved in all of this. Jess, thank you. I want to get to the oversight portion of what Jess was just discussing, that has been one of the sticking points here. For more on that, I'm joined by Neil Borofsky. He's a partner at Jenner and Block, the author of Bailout, and of course, the former Inspector General for TARP. So he knows a thing or two about government oversight and getting through these kinds of tough periods. Neil, it's great to see you. Thank you for joining us. You have written an op-ed for Bloomberg talking about the need for oversight here. What does that oversight need to look like?
Well, first of all, thank you for having me. And look, I think that what we just heard is a real sea change since I wrote that op-ed yesterday. Going into this, there was really no effective, dedicated, independent oversight. And now we're talking about some of the things that I encouraged, which is bringing back a special inspector general. That's an entity within the executive branch that has full law enforcement authority, as well as an ability to bring transparency, penetrate those executive privileges, and make sure information comes to the surface, along with a congressional oversight panel, which also existed during the TARP, which also provides a distinct but important element, again, transparency, the ability to bring accountability through congressional hearings and reporting. These are important first steps to get effective oversight. But I think that's really an important thing to remember. Putting the entities in place is a first step, but then there has to actually be real oversight, real transparency, and in order to achieve the goals of this bill, which is nothing short than to keep America running. So these are really large stakes, and we can't just let these achievements become just window dressing.
Neil, it's Julia LaRoche. Thank you so much again for joining us. It's really timely to have you on as well. I read your book, Bailout, and I think it's a great account into what went on when you were the Special Inspector General overseeing TARP. Give our viewers a sense of just the inner workings there and maybe even some advice for whoever might fill that role. How do we avoid, picking winners and losers or making it so it's just those with the political connections who win here? I think there's a lot of concern out there that, look, it's another bailout and you will inevitably have winners and losers. And how do we make sure that we take care of those who are even the most vulnerable?
I think that's an important point because there will be winners and losers because that's the very nature of bailouts. Bailouts are a perversion of capitalism, where we're taking the normal workings of a free market and we're throwing them out the window to save and preserve some companies that otherwise would not exist. And last time it was because of a financial crisis, the banks really, because of mistakes of their own doing, right, which brought about the crisis. Here, of course, a lot of these companies are not to blame for the coronavirus and the devastating impact. But nonetheless, there would be, without a bailout, some companies which would be well capitalized and smartly managed that survived nonetheless, and others that would not. And so we are picking winners and losers because we're taking a limited amount of taxpayer resources and distributing them not to all companies, but to those who make it through the process. So the key really important lesson from the last time, and oversight has such an important role in this, is transparency and fairness. So in other words, when the policymakers are making their decision as to who is going to be the quote unquote winner, who's going to get the money so that they can keep their business alive, so they can keep paying their employees and producing their widgets or providing their service, what is the criteria? And what we need to make sure that we have is objective criteria that is brightest sunshine, brightest light shined on that process imaginable. So originally it was contemplated it was going to be done in the back offices of the Treasury Department with 6-month delay before we even know who got the money and no oversight possible. That is a disaster. That is an invitation for corruption. And as I note in my piece, it is a corruption that will spread as quickly as the coronavirus itself if you don't have transparency over this process.
Hey, Neil, it's Adam Shapiro. You sent several people to jail because of the misuse of TARP funds. You wrote this morning that when you get this amount of money, the potential for fraud and scandal that always accompanies the distribution of so much money in such a short time is to be expected. I mean, we're talking $2 trillion. Do you see, clearly people are going to cheat. Do you see the government truly cracking down the way you did several years ago?
I certainly hope so. And I certainly encourage them to doing so. And again, this moving towards an inspector general is a good first step, because if you have a dedicated inspector general, that means a dedicated law enforcement agency. And you have some really experienced people, some smart people who are going to be able to hopefully do what we did, which is look at these programs, look at these efforts, identify the vulnerabilities for fraud, and start building the barriers. So there's two ways a law enforcement agency can help grapple with the inevitable fraud. $2 trillion is a lot of honey. That's going to draw a lot of criminal flies. There's no question about it. So the one thing you can do is you put in the tripwires, you put in the guardrails, you put in anti-fraud provisions and disclosures that any company that's trying to tap into this bailout well will have to provide. Two, you be very loud. We put together a specialized task force with the FBI, with the United States Postal Inspection Service, so that everyone knew that we were there and we're going to be keeping a close eye on it to deter criminals from coming. And then three, you got to follow through. And when those criminals come in, whether they get money or try to get money, you need to nail them. You need to investigate them, catch them, prosecute them, so that others understand that if they're going to roll the dice to try to profit off of a national crisis, we were going to be there and we were going to get them and we were going to string them up, figuratively, of course. But we're going to put them in jail. And you saw jail terms from some of our investigations in the decades, because we had it was important for us to get a conviction right off the bat, which we did. And so you're going to need to have a combination of that, and it's got to be supported and it's got to be communicated. We're going to have fraud. The second they announce this thing, your email box is going to be filled with people telling you that you're not going to get your government check unless you provide your social security number and email address and home number and all the other personal identifying information, some scammer located somewhere, right? We need an education program so people know, don't respond to those emails. We need a law enforcement effort to say, no, we're going to clamp down on that. And ideally, the inspector general should be at the top of this.
Neil, Rick Newman here on the other end of the internet. You know, one of the criticisms from 2008 and 2009 that they were Wall Street bailouts, but not Main Street bailouts. So how do you structure something like this to make it a Main Street bailout? And do you see that happening in the process unfolding on Capitol Hill right now?
You know, it's all going to be based, it's going to be really, really important that there are conditions that are attached to disbursement of money that fulfills the policy goals, the stated policy goals of government, of the administration and of Congress. So the disconnect we had last time, and that criticism is a fair one and is one that I've advanced many times, is that you had Congress and the administration coming out and saying, this is going to help restore lending and help homeowners. That was the last bailout. That's why we're bailing out the banks. But the reality was there were no conditions whatsoever to ensure that once the banks got that money, that they would do so. And we went to Treasury Department and said, hey, are you crazy? You need to have conditions. And they told us to, essentially go pound sand. And so all we could do at that point was to provide transparency. And so we did an audit and we tracked what the banks did with the money. Lo and behold, we found out that the one thing that they didn't do with it is increase lending or help homeowners, right? It just didn't happen without that type of conditions. And so whatever it is our policy goal, whether it's continued employment, whether it's consumer-facing support, it's got to be wired in to the statute and it's got to be wired into the agreements if we want to accomplish those goals. Otherwise, if the lesson that we learned from last time is you cannot cross your fingers and really hope that all the good things will happen, if that is your goal. So I think that's really important if we want to see those types of goals. On the other hand, if Treasury Department had said what was really in their hearts, we don't care about struggling homeowners, we don't care about increasing lendings, we just want to save the banks because we're totally freaked out and that's the only thing that matters. If they had taken that truth, then there would be less criticism, right? Because they executed a perfect policy to achieve that goal. So we need transparency up front about what we're really trying to do in here. And then we need to make sure that we just don't hope and pray, but have those conditions to make it happen.
So, given the scenario that you're outlining and what is needed, how much faith do you have in Congress, but probably more importantly in this particular administration, to be honest? I mean, let's just, to strip it all away, to be honest, to do what you're describing.
Look, I tend to go in all things with an assumption that people who are working and serving in government are doing so for good reasons, to serve the American people, because they believe in the policies that they work on. I come to it from that point. But the bottom line is, and we saw this, and again, very well-meaning with the Treasury Department, who are not truthful on a number of different things. They were misleading about the success of different programs. They distorted and frankly, at times just flat out lied. So you have to go in with your eyes wide open, and that's why there must be transparency. And that's why there must be oversight entities to hold their feet to the fire. Because even the best meaning, most well-intentioned people, under the pressure and the gaze, will tend towards prevarication. And so I assume the best in people, but you also have to presume some of the worst. And that's why complete unimpeded access by these oversight bodies to be able to bring the truth to the surface, because people will behave if they know that their lies will be exposed.
Neil, finally, before I let you go, if they do create this position again, an overseer for this, is that a position that you would take if offered it, given your experience in this area?
You know, I think that what's currently contemplated is to actually give that job to my successor at SIGTARP, Christy Romero. And, you know, that agency is now winding down, as you would imagine, given how many years have expired, but it is in place. She was my former chief of staff and deputy. And I think that she would be, if she wants the job, I think she's well positioned to continue to lead that agency and oversee it. And I, of course, am always happy to help in any way that I can. But I think I prefer doing that from my living room in New York than I still got some pretty deep scars from my time in Washington. And so it's a lot more fun being on this side than on that side, that's for sure.
I can imagine so. Neil, thank you so much for your time. We really appreciate it. Neil Borofsky is a partner at Jenner & Block, author of Bailout, and the former Inspector General for TARP. Hopefully your scars are almost fully healed, if not fully healed at this point. Neil, thanks again. And stay with us. Coming up next, we're going to talk more about what's going on in the markets as a result of all of this back and forth on stimulus and what's going on with the latest on coronavirus. Stay with us right here on Yahoo Finance. You're watching Yahoo Finance Live. I'm Julie Hyman, and we are seeing a rally in stocks today. That's as we hear murmurings that Congress is getting closer and closer to some kind of agreement on a stimulus bill right now. I want to bring in Simeon Hyman, no relation, as I always like to say. He is ProShares Global Investment Strategist. Simeon, it's good to see you. So as we see this rally today, obviously we have not seen very consistent movement to the upside. So as you're looking at the sort of day by day movements, what do you make of this big rally that we're seeing?
Well, look, today's rally makes total sense. I mean, what we're trying to evaluate right here is what will be the lingering and long-term impact of the coronavirus. You could just do any of these experiments in your mind if the world shut down for just even 6 months or even longer, but it sort of woke up unscathed, the impact would be modest. And the stimulus measure that we're all waiting for is one of the keys to limit the bankruptcies and the unemployments and the things that could take this from maybe not a V or a U, but even to an L. But if we get the big stimulus and the world is sort of kept in place to turn around whenever we politically decide it's time to go back to work, then that will really limit the downside. So it's a totally logical reaction to the positive possibility that the big stimulus is on its way.
Timmy, and it's Adam Shapiro. We had Dr. Doom, Nouriel Roubini was on with us, and he said that this is an overreaction essentially in the market because once we're past this first phase of coronavirus infection, we're going to have demand destruction and then a second wave of infection next year. So are the people coming into the market setting themselves up for a loss?
Well, look, I'm not a doctor, and I think there's an important, political policy, a public policy question here. We will all go back to work and stop streaming at some point when the risk is non-zero, and I think that's going to be a key element of what this recovery will ultimately look like. But what we do know historically is that the markets have rebounded relatively quickly from previous pandemics. Of course, we know this downturn has been swifter and bigger than those before. But I do think if you look a year from now, the markets are likely to be higher from where they are today. So look, you got to rebalance and you got to continue your systematic investment protocols and and really trust in the long term if your horizon is long term.
Simeon, on that front, with the various ProShares ETFs and products, are you seeing people do any consistent buying? If so, where are you seeing that? And just generally, what kind of flows are you seeing? What stands out to you as interesting?
Yeah, I mean, look, one thing that has been interesting in this sell-off. I mean, this is the curse of living in interesting times, if you will. But we have had sort of 2.25 phases of this sell-off. The first, we saw accompanied by a dramatic rally in treasuries, which initially drove the 10-year yield well below 1%, almost around 50 basis points or so. So in other words, in that first phase, bonds delivered their diversifying benefit. But then we had a phase where the second leg of this sell-off was accompanied actually by rising treasury yields. So if you look across the board, whether it's bonds, gold, various currencies, you haven't had dependable diversification in this period of intense volatility. So yes, we've seen folks look to the explicit side of hedging, for example, in an inverse ETF like SH, which is one of the ones in our stable of toolkits for investors, for the folks who really need to consider hedging in that near term and aren't looking 1 or 2 or 3 years out or further than that into the longer term.
Simeon, Rick Newman, I'm going to ask a dumb question on behalf of everybody trying to understand the manic moves in the market. The outcome with regard to what's going on in Congress is basically known. They are going to pass something, and it's probably going to happen within days, if not hours. That was known yesterday and the day before. Why are markets moving so much every day on these little changes in the outlook in Congress when we all basically know the general outcome?
I'm not as convinced that everybody thought this one was in the bag. I mean, we have had one of the most intense periods of partisan divide in this country that we've seen in a long, long time. So I'm not sure that people were so convinced that this will get done. It certainly looks like, I think I heard the 2-yard line in the previous segment. So, but I'm not as convinced as you that it was as obvious 2 days ago that this was going to happen. But I do think we're in for a lot of volatility, both from policy moves. I mean, we've seen other important policy moves. I mean, the Fed went in and started to buy fixed income ETFs yesterday. So there are unprecedented things going on. But just as the market moves have been quicker and larger and more volatile than in even the Great Recession, which took 18 months to get this kind of downturn, you're seeing policy move quickly. I mean, TARP took longer than this to get done. It was months after after we knew something had to be done, and we're talking about days and weeks at this point. So everything's moving a little quicker. I'm just not quite as convinced. I was watching TV last night and looking at the it's going through, it's not going through, and watching the various folks and looking at McConnell and Schumer stand at the podium. I'm not sure everybody was so convinced this was a slam dunk, but it certainly looks pretty close at this point.
Hey, Simeon, Dan Howley here. I guess when you start to see the retailers come back online, because that's something that really has been an issue. A lot of malls have closed. They've closed down walk-ins at places like the Apple Store, Nike, things along those lines. When do we start to see retail recover from this? There's so many people laid off from those positions. They're going to have to rehire, retrain folks. How does that whole industry get back up and running again?
Well, one part of this, of course, will be the policy piece. So we don't know exactly how the fiscal support will be spread around. Will it be dominated by which sectors of the economy will be getting bailed out? I mean, of course, the move from physical brick and mortar retail to online is a long-term trend, which is much larger than the impact of the coronavirus. So there may be some sort of short-term stopgaps there, but that's a trend that's going to continue for quite a long time.
Simeon Hyman is global investment strategist at ProShare. Simeon, it's always good to see you, even from afar. Thank you so much for
Appreciate your time. Thanks so much.
Well, as we have been going through this coronavirus crisis, we have been seeing a lot of governors really step up and be very proactive when it comes to this. And our editor-in-chief, Andy Serwer, talked to one of them, Connecticut Governor Ned Lamont, for his series Influencers with Andy Serwer. Let's listen to a bit of what the governor had to say about Washington's response.
Well, obviously, the feds were very slow off the draw. They didn't take it seriously early on. They sent mixed messages, hoax, business as usual. I will say we were on the phone yesterday with the president and vice president. I think they're taking it very seriously now.
Ned Lamont of Connecticut. We're joined now by Andy Serwer, who conducted that interview. Andy, one of the things that I have been sort of asking about as we are starting to hear some murmurings from President Trump and other members of the administration about contemplating opening back up parts of the economy is, are we going to see even increased tension between states and the federal government? Are we going to see states remain shut even as the government presses them to open up? What's your take, and did the governor have anything to say about that?
That's a great question, Julie. And I like that word tension between the federal government and the states. And, there's often tension between states and the federal government. That's part of our system. But if you think about it, this is actually particularly unusual in the sense that the states that are hardest hit by the coronavirus are actually blue states, right? You've got California with Governor Newsom, New York, Governor Cuomo, New Jersey, Governor Murphy, and Connecticut, Governor Lamont, who we just heard from. And it's not a conspiracy. It just happens to be that these states have the most dense population. So there's a natural tension that exists between those governors and President Trump to begin with. And of course, it hasn't been easy because of that tension for these two parties to sort of see eye to eye. And I think you're absolutely right. I mean, if President Trump and the federal government and the White House starts to say, hey, New York City, open up tomorrow, I think they're going to get a tremendous amount of pushback from Governor Cuomo, right?
Hey, Andy, I wanted to see whether or not, the relationship between the governor and the president seemed to kind of be put on hold as far as the partisan politics. If they seem to be more amicable when they're working together, or if they're taking the idea that the Fed took so long to get on this more personally than any other areas, considering how badly impacted the Northeast has been.
You know, Dan, you'd hope they would put partisan politics aside. And I think that, you know, he was just talking, Governor Lamont was talking about the fact that he spoke to the White House and the task force, and things seem to be a little bit better. So maybe kudos to the group for, you know, not trying to exacerbate the situation. And, you know, President Trump, I mean, the problem is, quite honestly, he's so mercurial. I mean, for instance, you know, on the one hand, it's the Chinese virus, Chinese virus, Chinese virus. And then today he's saying, you know, Asian Americans, boy, you know, you guys, people should not be prejudiced against them, et cetera, et cetera. So, you know, trying to find consistency, I think, is always difficult with President Trump. And, you know, this is not any exception to that point, I think.
Andy Serwer, thank you very much for that. And you can see that full episode of Influencers with Andy Serwer featuring Connecticut Governor Ned Lamont. That's brought to you by Verizon, and it will air in full at 5 p.m. this Thursday. Now, coming up next, we're going to talk more about how coronavirus is affecting the retail sector as well as the restaurant industry. Nike's coming out with its earnings tonight. We're going to preview those numbers and what to expect. Keep it here. You're watching Yahoo Finance Live. I'm Julie Hyman. And even as we are amidst the coronavirus and all of the headlines coming about it, we're also about to get into more earnings reports. So should be quite telling what we're hearing from companies. One of them is Nike. That company is actually scheduled to report after the close of trading today. Our Reggie Wade covers the sneaker companies for us, and he joins us now. Reggie, those Nike shares are rallying today along with the rest of the market. They're up about 11.5%. Of course, they have fallen along with the rest of the market too. What should we be expecting from the company?
Well, really, we don't know what to expect. And you talk to analyst after analyst, and they say, you know, one thing that investors are looking for is Nike to reassure them that they could put a floor underneath them. These earnings that come out, Nike's expected to pull in $9.87 billion in revenue and have an EPS of 58 cents. So if they could come out with numbers like that, I think that would ease investors. And the coronavirus impact is going to be felt a little bit on this report because they did close stores in February. So we'll see some of that, but it is into Q4 where we'll really get the tail of the tape on how Corona has impacted the stock. in the company.
Yeah, it should be quite interesting to see if people are buying sneakers at home or not, you know. Also, we got some news on Puma and what they're doing in terms of their stores and their employees. Tell us about that, Reggie.
Yes, Puma is allowing 1,400 workers to work reduced hours, and this is just, a call to action. Workers feel unsafe, and they don't know if they go to work, what state is the building in. So Puma's taking that proactive step, and it's really going to hurt Puma because Puma was on such a nice trajectory before the coronavirus pandemic. They were growing, they were coming out with a lot of different products that the market really likes. So I don't see how they can really survive at the rate that they were post this. It'll be interesting to see once this subsides what shape Puma's in because they needed this like they needed a hole in their head, to use the old saying.
Yeah, exactly. So we'll be watching to see if any more developments on that and also watching those Nike numbers after the close. Reggie Wade, thank you very much.
Thank you.
Let's turn to Melody Hom now. Melody, as we were just talking about regarding the Connecticut governor, Ned Lamont, we have seen really on the municipal and state level a lot of proaction, for lack of a better word, on the part of local leaders. We're seeing the same there in Los Angeles, where you are, on the part of Mayor Garcetti. Most recently, he is trying to stop evictions there. What's the latest?
Yeah, Julie, and to your point, there's been a lot more accolades being thrown out to the likes of folks like Governor Cuomo and Governor Newsom, and even mayors like Eric Garcetti, because to be honest, especially with a shelter in place or staying at home orders, a lot of the time you're really looking to those local leaders when there isn't necessarily national leadership for a lockdown or a quarantine. Coming off of news yesterday, actually, LA Mayor Eric Garcetti did expand what was originally that temporary ban on evictions during this period of coronavirus. He enacted an executive order called the Ellis Act, which is a state law that actually prevents landlords from removing tenants from rent stabilized apartments specifically for the purposes of filing bankruptcy and perhaps getting out of the rental business entirely and kind of reconverting a lot of these buildings into pricier condominiums often. In a really interesting quote, he said, "This is necessary to protect additional tenants from being displaced from their homes at the exact same moment we're asking them to stay at home." So this is more of a public health matter, perhaps, than a business decision. And then, of course, on a larger scale, Governor Gavin Newsom also said yesterday that he's ordering the immediate closure of all state parking lots, including 9 in LA County alone. And I have to tell you anecdotally, Julie, I was at one of those state parks over the weekend, and it was really way too infested with people. We saw a lot of those aerial shots in places like NOLA and Miami, and it's definitely the case here in LA. With warmer weather, a lot of people are trying to get outside, even if it means forgoing that 6 feet of safe distance from other people. So I do think, even though this seems very strict and stringent, it's a necessary move, unfortunately. And a lot of tennis courts, recreational places are fully closed. So that begs the question, right? We heard from Oscar Williams Group earlier as well, that daily exercise that you can get, it almost feels like a surveillance state at this point. And it's just a question of whether penalties will actually be implemented, even if you are going to be caught outside eventually. So I think this, there's a push and pull here where we do want a lot of guidance and leadership. But of course, Americans are used to getting the freedom and being able to act however we wish. And now we're seeing that there are some repercussions there, perhaps, because people are not following orders.
Yes, we've heard Governor Cuomo here in New York also scolding people for being too close together in Central Park. So as you say, we'll see if we see actually some consequences instead of just strong words. Melody, thank you. And I'm just hearing now that we have had another uptick in the number of global cases of coronavirus, 398,000 now, even as we see stocks rally today on the promise perhaps of stimulus coming through and Congress getting to some sort of agreement. Keep it here on Yahoo Finance. Coming up next, we'll be speaking to the CEO of Fat Brands about restaurant franchising right now and how that industry is coping. Yahoo Finance Live. I'm Julie Hyman. Thank you for being with us. We've been talking a lot about potential stimulus coming from Capitol Hill as Congress debates a package here. One of the industries that in some ways has done okay during this time because of takeout and delivery is the restaurant industry, but obviously people are not going out to eat right now. We're joined now by Andrew Wiederhorn. He is the CEO of Fat Brands, which is a franchisor with 8 brands, 400 restaurants under various banners like Fat Burger, Elevation Burger, Buffalo's Cafe, and he is joining us now. Hopefully between his dog and my kids, we won't get too much noise interruption as we speak. Andy, thank you for doing this. First of all, I do want to get to your suggestions for stimulus, but before that, talk to me about how all of this is affecting you. Have you seen restaurants close entirely or takeout only? How is this playing through your system?
Well, Fat Brands at corporate, we're fine because we're the franchisor, so we're not as affected as our franchise partners. But across different brands in different states with different regional issues, we're seeing closures. We're seeing brands go to delivery and takeout only, of course, which is important because it takes the pressure off grocery stores also. But for some of our businesses, they're more affected than others. The casual dining businesses that have bars that are closed, or the buffet business, the steakhouse business, where it's an all-you-can-eat buffet, those are all closed. So there's a big impact on labor there and on our franchise partners.
Hey, it's Adam Shapiro, and I was curious. You do suggest several things, and I was curious about, for instance, some kind of real estate assistance program in the form of rent deferral or application to the Small Business Administration for the franchisees to help cover rent. Are you hearing anything from trade associations if that's going to be included in the stimulus package that Congress is expected to pass?
So I think there's 2 angles that are really important that are out there today, and I haven't heard about the real estate one being passed. The first one is the SBA has their own disaster recovery assistance loan program up to $2 million per business if you have $8 million or less in revenue. So that works really well for our franchisees that own stores where they might do 1 or 2 million a year in sales each. And those are like 30-year loans at 3 3/4% interest. So everyone should be applying for that SBA disaster recovery loan. The second thing in the relief package that's in front of Congress today, and hopefully gets passed today, does involve additional loans equal to 2.5 times 1 month's payroll that will be forgiven after a period of time if you maintain your employees. So those are really important and available. And if it gets passed, I think it'll be a huge help to business owners who have employees they need to keep employed or rehire that they may have laid off already, like a number of people have had to do in the restaurant industry. With respect to the real estate, we've suggested that our franchisees negotiate with their landlords for a 3-month rent deferral, and also that the administration is going to have to give landlords some help because they all have mortgages to pay, so they're going to need some sort of assistance with their lenders. I haven't seen that as part of the package, but I'm hoping that people will pay attention to that.
Hey, Andy, Melody here. Just thinking about the employees and making sure to take care of them during this tumultuous time. There's been some backlash, right, from baristas, from cafe operators, from people who work at fast food restaurants, that they should not be considered essential workers during this time, that their health also matters, and they're kind of being pulled in many different directions. What is your response to that? How do you feel as though going forward, those folks can make sure to mitigate the virus actually hitting them and their families?
Well, so from a health perspective, you're absolutely right. Anybody who's sick should not be coming into any restaurant to work. In terms of contact with customers, having delivery and takeout only, I think really mitigates that factor and allows, look, the heroes right now are the employees working in the restaurants, the delivery service providers, and the franchisee owners who are keeping the restaurants open to service that segment of the market. And it's really important that everyone follows all of their cleanliness and safety and sanitation procedures, times 10 right now. But I don't think that there's exposure really to retail customer flow like normal using delivery and takeout. So I think that's a pretty good balance for now.
Hey, Andy, Dan Howley here. I just want to ask, what are you guys seeing as far as Uber Eats, Grubhub, Seamless, Caviar, the like? Are they helping these restaurants and businesses, hurting them? Are they a better partner now? I know there's some contentiousness between restaurants and those kinds of companies. What's the relationship like right now?
Yeah, I think the relationship is super strong right now because everyone's pitching in to do the best. What's critical here is that restaurants stay open that delivery service providers provide that to go and delivery service for customers, so they don't just have grocery as an option. We are seeing an uptick in delivery across our fast casual brand. So we normally do 40% of our business in to-go or delivery, and today it's up probably 10 points, which is strong. But in other brands that are more casual dining, they may have done 10 or 20% delivery, and converting to an only delivery model, they can't cash flow, they can't make it work. And so I think that the casual dining segment and anything heading off of a fast casual or QSR isn't going to be able to maintain pace very long. I think fast casual and QSR can maintain it longer, but there's only so much rope there, and they're going to need all the help they can get from the administration.
Andy, just quickly here, yesterday, Yahoo Finance spoke to Tom Colicchio, and obviously he's talking about restaurants that are typically higher end in terms of the ones that he is in charge of. But he said he doesn't even think restaurants should be open for takeout right now. He doesn't think that the safety risk that workers could be under are worth it. What's your take on that?
Well, again, I think on the fast casual and QSR side, like all of our packaging has tamper-proof labels and stickers and stuff. So the food is sealed. We know the virus doesn't travel in food. So if it's really the employees handing it off to a driver, or you can do with no contact, right? You can set it out, they can pick it up. I don't think that there's really that much exposure there, and I'm in favor of it for the fast casual and QSR brands. I think on the casual dining side of things, it's hard, and on fine dining, it's really hard to make it cash flow, meaning that you just lose so much money even participating. It's not worth it, and that's why they can only tolerate this so long.
Right. Andy, thank you so much for your time. Andy Wiederhorn is the CEO of Fat Brands. Appreciate your time. Coming up next, we continue to follow the rally that's going on in the markets, including in Europe, where we just saw the stock Europe 600 ending the day 8.4% higher. That is the biggest single day rally since November 2008. Keep it right here on Yahoo Finance. You're watching Yahoo Finance Live. I'm Julie Hyman. We have been covering all of the developments in the markets, which are seeing an outsized rally today, as well as the latest on coronavirus. We perhaps at long last got the news about the cancellation of the Tokyo Olympics. For more on that, we're joined by Dan Roberts, who's been covering that and the other cancellations we've been seeing in sports. Dan, they took a little while to get to this decision, but they finally got there.
Yeah, exactly right, Julie. And I would highlight the fact that maybe a silver lining for all the people involved, it's not a cancellation, right? It's a postponement. The official statement out from the IOC and from the Tokyo Organizing Committee specifies that it will now be held at a time beyond 2020, but not later than summer 2021. So I think you have to conclude that the likeliest scenario is it'll end up being exactly a year later than it would have been. It was supposed to start July 24 this summer. Maybe it ends up being right around that time, 2021. But boy, there's a lot of spillover effects, right? I mean, I recently wrote way back 3 weeks ago when we weren't sure what would happen about the many different small travel companies that, we're hearing from customers demanding 100% refunds, even customers who hadn't paid for the insurance option, so contractually weren't owed 100%. If they continue to demand it and threaten lawsuits, some of these small travel businesses are going to go out of business before they can actually get the Olympics a year later. There's also an interesting outcome maybe for the Tokyo economy. I mean, Tokyo was really anticipating this, excited, and it also had big implications politically for Shinzo Abe, who was kind of hanging his hat on this big 2020 Olympics. And interesting side note, by the way, even though it will end up being in 2021, if at all, the statement notes that it'll still be called the 2020 Summer Games, even if it's held in 2021. Kind of interesting there. But, Japan is holding its re-elections October 2021. So now that ends up being directly immediately after the Olympics, if the Olympics happen in summer 2021. So what does that mean for Prime Minister Shinzo Abe? And then, of course, what does it mean for athletes? For athletes who've been training for this for years, it's not as simple as saying, now it's going to be in a year, you have an extra year to train. I mean, if you were someone who was just going to make the cut, maybe you were 36 and this was going to be your last year you could do the Olympics. Well, can you still do it physically at 37? There are all kinds of implications, but a silver lining, at least as of now, it's postponed, not completely canceled.
All right. Well, we'll count on you to keep us posted about any further developments on that front. Thank you so much, Dan Roberts. One of the other industries that we've been watching that's been affected by all of this is the payment processing industry, right? The Wall Street Journal reporting today that we're seeing an uptick in traffic among many of the payment companies, as you might imagine. But there's the balance, right? Because there's also a lot of removal of payment traffic. Dan Halley's been watching that phenomenon for us because, Dan, you're talking about some of the tech companies, the newer companies like PayPal, but also Visa and MasterCard.
Yeah, these companies are really seeing an uptick in processing of these kinds of online payments. And it's similar to what you might see around Black Friday, the holidays, things along those lines. And it really has to do with the fact that people are in their homes, but still need to make purchases online. You've seen, obviously, Amazon hiring boatloads of new workers to ensure that they can keep up with demand. Ditto Walmart. So this is something that we're going to continue to see as lockdowns continue to go into place throughout the country and throughout the world, really. And kind of to put a point on how affected the internet infrastructure has been around the world, you just have to look at Europe and what they're having to contend with now as far as connectivity. We've seen YouTube, Amazon, Netflix, they're all slowing down their speeds to ensure that people can still get online without the pipes being clogged with bandwidth used by heavy videos such as those services. So it's really starting to hit hard. And these kinds of payment services are getting kind of overwhelmed as well. And if they do end up being overwhelmed, then there can be issues with transactions going through. So they're really going to have to boost up their capabilities, relying more heavily on cloud providers, perhaps even the public cloud in some instances, if they have such contracts. But it really is interesting to see how this kind of transition has affected these companies in ways you might not have expected prior to these lockdowns.
Thank you so much, Dan Halley. Appreciate it. And as we leave you for this hour, just wanted to note the S&P 500 is up 8.24%, the Dow up about 9%, the Nasdaq up 7%. So we continue to see a big rally as traders await more news about an agreement on a stimulus package in Congress. Keep it right here on Yahoo Finance Live.
Welcome back to Yahoo Finance live coverage here as the market continues its upswing with the Dow up more than 9%, tracking for its second largest daily point gain in history. Second only to the 2,000 point increase we saw earlier in the month. Right now, the Dow holding 9% higher, the S&P up by about 8%, just a little bit off the session highs that we saw about an hour ago. Going to keep pace and watching those moves for now. But right now, we're hearing updates out of Washington, D.C. regarding that stimulus bill that might get agreed to as early as today. House Speaker Nancy Pelosi saying that both sides are moving closer to agreement in terms of coming together and passing what could be a $1.5 trillion stimulus bill. Still waiting on the final number there. But want to get to Jessica Smith in Washington, D.C. with the latest as both sides say they're getting closer to agreement here. Jessica, what are you hearing?
Yeah, we're hearing positive comments from all of the major players involved in these negotiations. We've heard from Minority Leader Chuck Schumer saying that he thinks they're on the 2-yard line, and he doesn't think that the outstanding issues will hold things up for more than a few hours. He thinks those issues could be overcome. So we're waiting to see if they can work out some of those details that they're still trying to nail down. But we do know some of the things that they have really been pushing for. Democrats have wanted more money for hospitals. They have wanted more oversight on the $500 billion for industries that have been hit hard for the virus. Schumer and Pelosi say that they have secured some of those changes, including having an inspector general overseeing those funds, as well as a congressional panel. We also know that they have wanted enhanced unemployment insurance. They are now saying that this deal could include 4 months of full pay for workers who have lost their jobs in this. So we're waiting on those final details and waiting to see when the Senate could actually move on this. As you mentioned, it could be as early as today. Speaker Pelosi is also talking to her caucus this afternoon to figure out what to do in the House once this moves past the Senate. Her goal, what she's hoping to do, because this would be the quickest option, is to do this by unanimous consent. So that means lawmakers don't have to come back from their home districts to be in DC for that vote. Just 2 people have to be in the chamber. But it means everyone in the House has to be on board with this deal. Just one person could really throw it all off. So we'll have to see if that is actually a possibility. That's what they'd like to see. Otherwise, they would have to bring lawmakers back to Washington, either amend the Senate bill or work on the one that the House introduced yesterday. But unanimous consent is what they're shooting for now. We'll be sure to keep you updated on how things change in the next couple hours.
All right, Jessica Smith, tracking all of that. And of course, things could change quickly. We're already seeing the Dow move off of its session high. It's now up just 8.5%. We'll see if that changes as we get updates out of Washington, D.C. But meantime, we're hearing shifting language coming from the president and the White House overall regarding how quickly the economy might be able to come back online. Earlier today, the president was tweeting about this, saying that we can do 2 things together. The cure cannot be worse by far than the problem. Congress must act now. We will come back strong. We're still waiting to see if Congress will act now later on today. But I want to bring in Rick Newman for more on the shift in the president's thinking here. Rick, it does sound like he's pushing for a quicker return and shift away from these lockdown policies. We're seeing more and more coming from governors across the country. Now more than about 10 states in lockdown mode, or at least announced lockdown mode as those come into place. But what's the give and take when we're thinking about the hit to the economy overall as more businesses are shutting down and people are staying at home?
You can practically see President Trump pulling his orange hair out as he just watches the stock market tank and all the terrible economic news that's coming in. And we're getting terrible forecasts. We don't even know how bad the layoffs are going to be and the decline in GDP. So you're hearing Trump, and this is circulating in conservative circles at this point. Let's get the economy back to work. Maybe we're going to end up hurting more people with all of these stay-at-home orders than we're going to be helping by telling everybody to stay at home. I think we all kind of get the idea that you have to be able to take some risks in an economy, but frankly, I think this idea is going nowhere. And there's one big thing that is missing from this theory of President Trump's. We need massive, widespread testing for coronavirus. We need everybody to be able to be tested. That's the only way you can know who is safe, who does not have this virus and is therefore safe to move around, and who does have it and needs to be quarantined. Right now, in the states you're talking about where these stay-at-home orders are in effect, the basic assumption is everybody has it. Everybody is potentially a spreader because we can't tell who is and who is not a spreader. So, we can get widespread tests. I mean, we have tests and we are ramping up here in the United States, but we have been woefully behind on testing. And right now we need a moonshot for testing. Testing is the thing that is going to enable us to start getting back to regular economic activity. Trump is trying to let the private sector handle this. The private sector will get to it. It's just going to take time. So if the government can do anything here, figure out a way, no matter what it takes, to do more testing so we can figure out who can move around and who cannot move around. Right now, we just are saying nobody move around at all.
Yeah, I mean, when we look at the numbers too, 25,000, more than 25,000 in New York State, and a lot right now in New York City alone has more than 14,000 cases, approaching 15,000 when we look at it. So there is all that going on. It's different across state lines when we think about how many cases have been mounting there. And I think part of that is because New York State has been leading the way when we think about testing. So obviously they're going to have more numbers actually reported here. But the rate isn't slowing down either. When we hear Governor Cuomo talk about this, saying that the rate of new infections has been doubling every 3 days, that could be a function of just getting testing back online as well. But he says the apex isn't going to hit for another 14 to 21 days in terms of the stresses placed on the health system here too. So I don't know how you could have people going back and traveling again when there is that playing out in hospitals around the country.
And I'll tell you, there's also an urban-rural divide here. I mean, I've been writing about this, and I've been getting lots of emails back from people saying you're exaggerating it. Don't even have any cases here. Mario Cuomo, the New York governor, said today, basically, if you think you don't have any cases, you're going to have cases. We are an example here in New York of what's coming your way. I know in the medical community here in the New York City area, doctors assume that the actual infection rate is probably 10 times what the reported infection rate is. That's just because of all the people who may be asymptomatic and cannot get tests and so forth. And this spreads exponentially. I mean, we know that by now. So everybody who characterizes this as, oh, it's just like the flu, it's not just like the flu, because the infectiousness of it is considerably greater than for the regular flu. That means if you're one person who has it, you're going to infect more people than you would if you had the flu. And that just leads to these exponential spikes in cases. So, the breaking point here in any locality, in any municipality, is the healthcare system. And no governor or mayor is going to do what President Trump apparently wants, which is to say, okay, we encourage people to go back out again if that person knows that they're going to run out of ICU beds and they're going to run out of ventilators. So President Trump, if he gets to the point where he actually does this, he can try all he wants to encourage people to go back out and reopen restaurants and go to movies and things like that. Governors and mayors are not going to have it if they see that increasing the risk to the healthcare system in their area.
All right, Rick Newman bringing us that. For more on the actual front lines of this, though, I want to bring in someone with firsthand experience when it comes to treating those affected here. Dr. Cardinal Smith joins us now via Google Hangout. She's the Director of Quality for Cancer Services at Mount Sinai Hospital, Mount Sinai Healthcare System in New York City. And Cardinal Smith, Dr. Smith, I just want to ask you first about what you're seeing in regards to all this as we hear more from the president about maybe potentially not waiting months, but rather weeks to get back up here in terms of opening all these businesses. How would that impact the caseload that you're seeing in hospitals and the one you're working in right now on the front lines? Do you think we're anywhere near potentially getting back to normal here?
Yeah, I mean, I think just like before the shelter in place or the stay at home orders began, we were counseling our cancer patients to really stay at home and shelter in place and only leave if absolutely necessary. I think we would still follow that same guidance, even if all of a sudden things were to open up within the next 2 weeks, because we know that the risk is still very high.
And I mean, as you're talking about, I know your background's mostly in cancer, or when you're dealing with patients on that side, how is the rest of every other aspect of the hospital been shifted to kind of deal with this? Because we talk about the stresses and adding capacity across the country. How has it impacted maybe treating other patients that might not even have anything to do with coronavirus or COVID-19 here, and how it's kind of cascading into other areas of treatment?
Yeah. I mean, I would say thankfully we're still able to provide the same quality care that we've been able to provide to patients previously. We may be shifting them around in the hospital so that we don't have patients without COVID near patients who do have COVID. But for the most part, we've thankfully been able to care for them the same. I think probably the biggest impact has been with our visitor management policies in terms of limiting visitors into the hospital.
And we've heard that anecdotally too, even wives, women giving birth, and husbands not necessarily being able to be in the room to play a normal role in that. But when you look at the actual ventilator issue, we've heard Governor Cuomo addressing that quite a bit, asking for 30,000 ventilators. We heard from VP Mike Pence talking about FEMA sending 2,000 to the state. Still a massive shortage when we think about the gap there. How is that necessarily going to impact what should be the strategy around flattening the curve and making people to stay home for longer rather than the shorter period of time we're hearing out of the White House?
Yeah, I mean, I would say it's a big worry. I've gone on all of the websites myself and looked at all of the projections of, how long to stay in the house in order to really flatten the curve. I mean, I think it's a concern that we all have. I certainly think that for all of our parts, staying at home as much as we can to really flatten the curve and to prevent this from spreading even more so that we can offset the burden to our hospital systems will be really critical.
Hey, it's Ryan Chung here. So I wanted to ask just in terms of the amount of staff that you have, no hospital or facility could have been prepared for coronavirus and just the amount of stress that it puts on in terms of personnel. I'm wondering, has Mount Sinai, for example, tried to hire new people in the interim, maybe not necessarily in a nurse or a direct capacity, but just in other parts of the facility or in the hospital at large?
Yeah, I mean, I would say to my knowledge, we have not. I think from a physician standpoint, we have physicians who have volunteered to come out of retirement to come help in the way that they can in terms of doing telehealth visits and things like that.
In regards to treating other patients, though, and we talk about how this is going to be a lot more people, just the caseload that we're hearing from Governor Cuomo in New York does kind of right now, it is potentially the new epicenter. We heard the WHO talking about how the U.S. could become a new epicenter for this too as it moves across the globe. But here in New York, I mean, we're hearing so many instances of just scrambling right now to figure out how the hospital bed situation is going to be able to meet what could become the worst in about 2 weeks' time. So in your estimation, are we tracking to meet the demand that'll be there for hospital beds? And what are you seeing play out there on the front lines?
Yeah, I mean, I can only speak really to what I know in terms of my oncology and cancer population. I would say that as of right now, we're able to meet those needs. We're still able to admit those patients who need to be admitted either for acute chronic conditions or for elective chemotherapy. And right now we have processes and plans in place so that we can continue to do that. I think we are absolutely worried and we're really taking this day by day to see what happens as the situation evolves.
If you could say one thing to the Trump administration, just in terms of the number one thing that you as a doctor, that you've heard from your patients, that you've heard from your coworkers, that you need help with in addressing immediately within the next few hours, within the next day or two, what would that be?
I mean, I would say what I am hearing from people across the country and reading on Facebook and social media sites is the incredible need for PPE. And so I would say that if we needed anything within the next couple of hours, that I think healthcare workers everywhere need PPE and could benefit from having that protection.
Yeah, I mean, even when we think about the shortage of masks too on that front and the way that people have been going out to buy N95 masks and what that means for hospital workers dealing with cases here, obviously that's not a good situation when you have them getting sick, further stressing the amount of staff we have available in hospitals. But for now, Dr. Smith, really want to say I appreciate you taking your time to chat with us on this. Thank you so much.
Thank you.
Well, coming up after the break, we're looking at a rebound here in oil prices holding at about $23. What one man will say about that, because he called this fall in oil prices, calling it back when we were sitting at $40 a barrel, what he sees playing out in the weeks ahead next. Welcome back to Yahoo Finance. Right now, stocks are rallying as we see the Dow up more than 8%. As people begin to give into the optimism that we might get a stimulus bill out of Washington, D.C. We're waiting to hear the latest there. But in the meantime, we're seeing energy rally 12% right now. It's the best performing sector when you look at the S&P. And a lot of that might have to do with the idea that oil can't get any worse from here. Right now, trading around $23 a barrel. And if you watched us a couple weeks ago here on Yahoo Finance, you would have heard a man call for exactly that when we were trading back near $40 a barrel. And I want to bring him back in. That, of course, is Stephen Short. He is the editor at the Short Report. And Stephen, when we look at this, it's very interesting to see the drop in crude prices play out right now across the country. When you look at gasoline prices from AAA, we're looking at about $2.10 a gallon, the current average. That would compare to $2.62 a gallon just a year ago. So not a lot of people are going to be complaining about this if you're driving out there. But for the overall energy sector, the economy right now, it's hard to think that we could go lower than $22 a barrel. But what are you seeing play out as demand again is impacted by the outbreak of coronavirus around the globe right now as people shut down? How is the supply and demand kind of in flux here? And where do we go on the price of crude?
Hi, Zach. Well, certainly, I think it could get even uglier at this point. We did break below $20 a barrel at the end of last week. Look, we are killing the economy in every industrial country in the world. People are not driving. Yesterday, NYMEX gasoline traded as low as 38 cents. That is 38 cents away from zero. So clearly there is something wrong and it's going to get worse, I'm afraid. This is why we made the decision at the Short Group to make our research available to all market participants, because we are in this together and we need to get through this together. So at that standpoint, gasoline now for the summer, low RVP summer grade gasoline is now trading from April through September below the price of crude oil. So there's no telling how low we can go, but I am afraid it can get worse from here. I'm afraid we actually can make a run at the all-time low in oil prices, and that would be from April 1986 at $9.75 a barrel.
Wow. All right. $9 potentially if things get worse. And I guess the main question there would be the shift. We already talked about demand falling off a cliff, but on the supply side, we also heard about potential deals being made between OPEC and Russia. Nothing really coming to fruition there. But also shale producers here in the U.S. kind of caught as that swing producer and kind of question mark lingering, even if there was an agreement there. There were some reports that producers were talking to OPEC and the question of legality there in terms of we're obviously not allowed to enter into non-competitive agreements here. So how does that change the dynamic on the supply side when we think about how U.S. production has come up so high in recent years?
Yeah, and we have to keep in mind that there is a much ballyhooed price war that started with Saudi Arabia and Russia. But let's keep in mind that this is a proxy war between Saudi Arabia, Russia, and the United States. The United States is the catalyst for this price war. In February, the Trump administration sanctioned Russia's largest oil company and its trading arm, thereby hampering the potential impact of that country's market share on the market. Therefore, with U.S. production now at all-time highs at well over 13 million barrels a day, the United States' refusal to pull back production, Russia and Saudi Arabia really have no other option. They were painted into a corner, and now they're reacting. And now that we have reacted, all three countries have to work together to pull supply off the market because there's simply no demand out there.
Hey, Brian, it's Brian Chung here. So I was looking at the numbers from a consumer standpoint, right? Because you might think that lower gas prices will be good for the average American consumer. I'm just wondering on that front, what have you seen? It sounded like the national average was about $2.15, which was 44 cents cheaper than a year ago. Is that going to provide some sort of at least positive headwind for the gas and oil companies, despite the issues that you were just laying out before? Brian?
Yeah, I don't know. I think we might have lost Stephen Short's audio there right now. We're going to try and get that resolved. Another one of these. I'm seeing him, but I don't know if we're hearing him. So we're going to go ahead and try and dig into that. But I mean, one of these other things to you, Brian, before you were asking that question, was just kind of looking at what we're seeing right now. We kind of opened the segment with the idea that energy is enjoying quite a nice rally today, despite the fact that crude prices are down 0.5%, which is still one of those question marks, considering the fact that yesterday we heard a guest, bankruptcy expert and NYU professor Ed Altman, talking about how these energy producers would be the first ones to go in bankruptcy. And yet we're kind of seeing energy catching a bid today. So that's the real question here.
Yeah, Zach. Well, I think the concern here is that a lot of these oil and gas companies are very debt-laden companies, right? The idea is that they're so capital intensive that you're always kind of flying by the seat of your pants and really operating on quite tight margins, especially depending on what your production looks like. So if you have a large shock like this, a large exogenous economic shock like the coronavirus, where you basically have revenues taking an immediate hit, you're really wondering if your creditors are going to, be willing to take on your debt. And if you cannot finance to last through the next week because it's so capital intensive, where are you going to get your financing from? That's why we've seen the Federal Reserve do what it's done to try to step in and say, hey, we're going to try and support liquidity here and backstop the credit market so that these companies won't go bankrupt. Because the concern is that if you have these companies that already have maybe poorly rated corporate debt, if they start to fail, maybe that triggers a domino effect in the market where you have these bankruptcies then rippling up to high unemployment because people are getting laid off. We know that in Texas and in Oklahoma, those crude oil producers are huge employers of people. So that's a major concern from a macro scale that you want to try to contain if you can, as these oil prices continue to provide pressure on these companies.
Yeah, I mean, we just heard from the Port of LA yesterday as well, is that there is a question of safety for the workers too here, because you could have all these people working together in close proximity. And that's something that you also need to worry about, especially as we keep hearing from governors across the country talk about shutting down for longer. We also heard that from the governor of Connecticut in a recent interview with our own editor-in-chief here, Andy Serwer, talking to him. I want to play what we heard out of the governor from Connecticut in regards to shutting down, calling on the president to go ahead and issue a nationwide order similar to what we're seeing play out on a state level. Here's what Governor Ned Lamont had to say.
Well, obviously, the feds were very slow off the draw. They didn't take it seriously early on. They sent mixed messages, hoax, business as usual. I will say we were on the phone yesterday with the president and vice president. I think they're taking it very seriously now.
And you can watch the full interview with Governor Lamont right here on Yahoo Finance coming up on Thursday later this week. You won't want to miss that. Coming up, though, we're seeing stocks give back a little bit of the gains as we move along in the afternoon session. Next, we'll be chatting with an analyst who just slashed his price target for Apple and why he says more pain could be coming to the tech sector moving forward. More on that right after this. Welcome back to live coverage here on Yahoo Finance. Right now, we have the Dow up by about 9% in the afternoon trade. Still waiting for updates out of Washington, D.C. regarding what stimulus measures, an agreement between Republicans and Democrats. We've been hearing that both sides are getting closer to a deal, but no vote yet to report. We'll wait and see what happens there. Meantime, President Trump has been discussing his policy proposals and what he sees playing out in response to the spreading of coronavirus cases across the U.S. He just said a little bit ago that he would love to see everything open back up by Easter. That would be mid-April, which would be a lot quicker than some of the estimates we're hearing from governors across the country. Of course, Governor Andrew Cuomo saying that just in about 2 weeks to 3 weeks will be the peak for cases here in New York State. So differing viewpoints coming out of the White House and governor offices across the country. We want to bring in a man who's watching this play out and how it's impacting the betting markets and odds to see who will win the election in 2020. That man is Lee Price, friend of the show, Patty Powers, head of PR, who's been tracking all of the odds for us from abroad. And Lee, when we look at this, we had seen fluctuations in regards to President Trump's reelection chances. Right now, the presumptive nominee on the Democratic side, Joe Biden, had surpassed him for a little bit. We saw President Trump catch back up. What are you seeing now as all of this plays out and people watch his response to the coronavirus pandemic?
Yeah, the drama's gone 180 for us in terms of the presidential election. Trump's back in front. He's got a 52.4% shot, which is still low for him. And bear in mind, I don't know, 3 months ago, it would have been 68%. We were really confident about Trump. He's now back to 52%. Biden's 50%. I know it's up to 100. That's the weird maths. But we put Trump in pole position again, but still room for some wiggling, I think.
Yeah, what is interesting is just the way that we've seen that fluctuate, because a lot of people were talking about maybe the wartime response. Of course, you think back to then President George W. Bush and the response he had around 9/11. He had his approval rating soar by about 30% as the country kind of rallied around what he was doing. We haven't necessarily seen that with President Trump right now, still split, according to the latest polling out of Monmouth University. When you look at about a 50-50% split in terms of people saying that he's done a good job versus a bad job. Of course, digging deeper into that, you see Republicans overwhelmingly approving, about 90% versus 20% we're seeing on the Democrat side there. So that kind of speaks to the polarization right now of the country, even though this is an event that is supposed to kind of bring us all together as we stay home to try and flatten the curve here. But when you're looking at that play out, how is that maybe impacting things moving forward as this kind of melts away? I guess it's hard to predict, but based on the swings that you've seen before, if Trump did have odds of above 60% to kind of win the election back then, what does that mean as we're seeing this all fluctuate in real time?
Yeah, we think it's still early days, right? So that's why there's that uncertainty about Trump. Is he doing a good job? Is he doing a bad job? As soon as coronavirus starts to die away, there'll be this relief, this positivity, and Trump will get more and more credit. So if he does navigate America through this, he'll be more popular. And we're seeing exactly the same thing here in the UK. Our Prime Minister, very divisive. But as things seem to progress, he gets more positive reactions and more backing. And we expect the same thing to happen to Trump. I expect in a week's time and in 2 weeks' time, I'll be saying to you, hey, Trump's more of a favorite again.
Yeah, or depending on how things shake out on the Democratic side as well. I know we've been watching the odds for right now. Joe Biden has yet to name a VP, a running mate here. But the odds there have pretty much stayed where they've been since the open, as he's opened his lead over Senator Bernie Sanders. Not sure if you've seen anything change on the betting odds in terms of his VP nominee.
Yeah, we're kind of sitting on the fence. We're not sure is the honest truth. We make Kamala Harris the favorite. She's got a 34.8% chance, and that is increasing. It was 30% last week, so there is progress there. Amy Klobuchar is second favorite, and she's drifted slightly. She's 25%. And then Stacey Abrams has stayed the same since Biden emerged as a favorite, around 20%. So you've got three really strong candidates there. We're leaning towards Harris. And the reason we are is because the stories we get over here in the UK and Ireland are hand-picked. There's only select stories we hear, right, from you guys. And it's Kamala Harris talking about the prisoners and what seems like a logical, sensible policy there. That might be controversial. Or we hear that Klobuchar talking emotively about her husband and whatnot. So we're hearing these stories and they're really influencing people emotively. And that's, we're betting with our hearts over here because We're not US policy experts, sadly, but our partners are favouring Harris for now, but it's very much a three-horse race, unlike the Democratic nominee.
Yeah, no, I mean, when you talk about Amy Klobuchar's husband testing positive for coronavirus, she's talking about that actively on Twitter as well, just kind of speaking to how this is impacting everybody and what it might mean in the 2020 election as we move forward, and how President Trump's handling of this will be watched closely as we move forward. Interesting, though, out of that same Monmouth poll, when we look at the governor's approval rating as well, a very different story than Trump's 50-50 rating. 72% of the public saying that they agree with the job done by their current state governors versus just 18% saying that they've done a bad job. So not necessarily the same case. We're seeing Trump's score versus governor's scores. It'd be interesting to see if Joe Biden might give a little bit of a tour to go ahead and have some photo ops with some of those more favorable governors around the country, but we'll see if that happens. For now, Lee Price bringing us the latest on the betting market in regards to the election. Thank you very much, and stay safe out there, my friend.
Nice one.
All right, well, coming up after the break, more on that price cut to Apple's price target from Citi's Jim Suva. We'll chat with him about why it's not just Apple that could potentially see pain on the other side of everything coming back to normal, what he's saying about tech stocks right after this. Welcome back to live coverage here on Yahoo Finance. We're seeing stocks rebound today, though we are just off our session highs. The Dow up by about 9% right now as we await updates out of Washington, D.C. regarding what stimulus bills might come through and how workers might be made whole as the economy continues to shut down across multiple states here in response to the spreading of coronavirus cases. Meantime, though, that's spilling over into the way analysts are looking at a lot of companies in regards to how business might be impacted moving forward. Some of those big names we've heard from: Apple closing stores across the globe, reopening stores in China after it made its way through the worst of coronavirus cases over there. And one analyst just slashed his price target on Apple down to $310 a share, down from about $375 a share. I want to bring him on, Jim Suva from Citi Research, analyst and managing director. And Jim, when we look at this, Apple is not alone, but we'll start with them in the way that they might be impacted months, years down the line when we think about coming back. Why do you think that it might be the case they don't see everything come back completely when we think about lost demand for a lot of their tech products here?
Well, Zach, that's a great question. And you are correct. We did change our target price and remove it and take it down to 310 with still a buy rating. But importantly, originally we thought that the demand would just be pushed out a few weeks or months. And now we're actually seeing that the demand and people are using their smartphones even longer. They're learning to work from home, work remotely, and kind of do with what they have. Now, we still believe long-term Apple is a good buy stock here, but we do believe some of this demand is being destroyed because the coronavirus is causing these store closures to be much, much longer than expected. People, when they go into an Apple store, have a great purchasing experience. Often they say, well, hey, your friends and your family and loved ones are so beautiful. Don't you want to buy more memory in your smartphone? They're so beautiful. Don't you want to take more videos of them? And people leave the store typically spending more money than what they intended, and importantly, feeling very good about that purchase. We believe that demand for Apple will improve in the second half of the year, but near term, with these store closures now going global, we believe expectations are still too high, and that's why, Zach, we removed our higher target price and took it lower to $310, but we think long-term Apple is a buy here. Simply across all of technology, technology is a problem solver for the coronavirus as far as the way people work and communicate, and it's not being completely destroyed or set aside.
Yeah, but that's the other interesting thing too, though, because it's it's one thing to cut your price target, but it's another to cut your earnings per share estimates, not just in 2020, 21, but also 2022. When you look at how long this might last, even below current consensus levels on that front. So, why do you think it might last that long? I understand the destruction of demand in the short term, but you're kind of spilling this out over the course of 2 more years here. So, what's the reasoning behind why it could last so long? And also, I guess, as an extension, we've heard them talking so much about services being so important, but I guess it is still hardware that matters when you think about just sheer amount of revenue for Apple.
Yeah, you're right. For Apple, it's still very much about an iPhone story, and the services, which are now getting closer to 20%, are important. But what we do believe also is this coronavirus, with people working directly from home, whether it be yourself, your viewers here on Yahoo Finance, or myself being, a work from home environment, that is going to slow down research and development. The innovation where the smart people get together and innovate and figure out these newer iPhones, 5G iPhones, AirPods, all these new things that are coming out, it's going to take longer than expected now. Anyone who says that, it's just business as usual, I think that they aren't realizing the full truth and magnitude. Working from home takes more effort, more cooperation, more communication, and it does slow down the process of how things are developed. So we believe that Apple's products, they'll still have a 5G phone coming out in September of this year, but we believe just overall technology is going to see a slowdown slightly in innovation as everybody works from home. That's why we see this being pushed out longer. We believe that the supply chain is going to have to be restocked and refilled, and companies are going to sit back and say, is it good to have a full concentration in China, or should we spread our manufacturing footprint to other places like India, Vietnam, South America, other parts of Europe to help mitigate whether there be a future virus breakout or political geo uncertainty, or also simply earthquakes, typhoons and weather, or political worker unions and unrest with workers. We believe that all this is going to cause technology still to be important, but slow down some of the innovation, and this will have a long-term impact on Apple of simply reducing expectations of the hyper. We don't see a hyper supercycle phone coming back again.
Hey, Jim, it's Heidi Chung here. So I want to get your thoughts on Apple TV Plus, because the company already had a very small content library, but with production essentially at a standstill here, what's the future for that, especially as we have Disney Plus launching in a key European markets today?
Well, hey, Heidi, thanks for the question. And for a father, myself, of twins that are 8 years old, there's no shortage of them wanting to watch TV. And yes, our family are subscribers to that, as well as all the other streaming services out there. And right now, to be honest, my family is overwhelmed with the amount of content that's on TV. That being said, with the coronavirus, actors, actresses, the people that really entertain our lives from some of these movie production things, they don't want to go back to work. They want to risk their livelihood and their health on this coronavirus right now. So the slowdown in production of content is not going to be a positive for Apple TV Plus. Remember that everybody who's buying a new iPhone right now, the newest phones, not used or refurbished ones, are getting Apple TV Plus for 1 free year. In about 6 months from now, we'll learn, are those people now in love with it and subscribing to pay for it, or do they just simply use it because it's free? It's a big decision when you get it free for a year to then are you going to start paying up for it. And right now, I don't believe the content is enough to really draw in new users to it. But they do have some time, but the coronavirus is going to slow things down. And so far, Apple's TV program and progress that has rolled out hasn't been as great as some of the hardware. Now, their app store with games and purchasing and stuff like that has been fantastic, but their TV showing has not been great so far, and the coronavirus is a negative on that front also.
All right, there you go. The latest on Apple from Jim Suva, Citi Research Analyst and Managing Director. Thank you so much for taking the time, Jim. Appreciate it.
Great to hear from you. Thank you.
All right, well, coming up, we're digging into the numbers on the airline front, why an industry group says that the losses airliners are now slated to take a hit on has just doubled in a matter of weeks. More on that right after this. Welcome back to Yahoo Finance. We are still just off the session high as we've been seeing today, with the Dow pacing to add about 9% today. Of course, that could change rather quickly as we get updates out of Washington, D.C. regarding whether or not Republicans and Democrats can come together to pass the stimulus measures in response to the coronavirus slowdown here. We'll bring you those updates as we hear more. Meantime, tied to that, we're seeing an update to the amount of pain that airline companies are set to withstand here in regards to Americans and people all over the globe really traveling less. We got an update to the number out of the International Air Transport Association, which had estimated about $110 billion impact to airlines across the globe, now estimating a loss more than double that size, totaling $252 billion, or 44% below the actual revenues that we saw per passenger back in 2019. So I think it's kind of fueling the idea that these airline companies are going to need some help here, at least in the U.S. Still waiting to see what kind of package might be put for airline companies here. But Heidi, when we look at it, it's kind of crazy to think that the industry could more than double that number in terms of the revenue hit here in just a matter of weeks. They say it's because slowdown in travel is not just happening in the U.S. and some of these other other countries, but rather totally across the globe.
Yeah, Zach, I mean, take a look at the airliners today, though, just on the hopes that we might potentially get a bailout package from the government. We're seeing airlines completely take off. We have American up more than 30% just in today's session. Now, whether or not they'll hold those levels is a whole other question. But that being said, there are some talks out there that these airlines could potentially completely close down operations. But what we do know right now is that they are completely bleeding cash. So at this point, I don't know about you, but when I take a look at social media, I see a ton of videos of people that are taking flights, and they're perhaps one of a few people that are on these giant Boeing or Airbus airplanes. And if you think about it, you're putting your employees at risk. You're also not even making that much money. So is the ROI even there? I think that's a really big question. But I think consensus for now is leaning towards the fact that these airlines will in fact be bailed out by the government. And as we know, transports are extremely important to the market. If we cannot get a rally in transports, then no sustainable rally in the Dow is expected, according to the classic theory. So they are being very closely watched right now, Zach.
Yeah, and I think on Heidi's point, I just wanted to point out that Delta Airlines had a number of other headlines also across today. Actually, just about 20 minutes ago, S&P Global Ratings took their bond rating into junk territory. So they actually cut their rating from BB to a triple B minus. That's the lowest investment grade rating. That is junk territory. And the concern here is that these large airliners are really going to see a huge effect on their corporate debt as people say, hey, with these companies facing this much disruption from the coronavirus, who's going to want to buy their corporate debt? So I think that the bailouts thesis that Heidi was just laying out, that Wall Street is expecting something like that, is expecting that these airliners will get bailed out, is definitely underscored by the fact that their credit ratings are already taking a hit here, and that Wall Street investors are expecting them to eventually get a bailout, whether or not you think that is the right move. So Delta, again, the latest story here, but largely across the board, you're wondering if that's going to be the story with a number of other domestic airliners. There was the report from the Wall Street Journal, which hasn't been substantiated by the White House yet, rumoring that there would be a stoppage on domestic airline travel entirely. We don't know if that's going to be the case, but you could imagine a scenario in which that does happen. That would be a huge hit to the domestic airliners as well.
And you wonder who might follow there too. And S&P downgrading Delta to BB from triple B minus. What other airlines will be following that credit cut? As also, I mean, we were watching the fact that Chad Sweet just a week ago, a former DHS chief of staff, was telling us that there was not technically a 0% chance, quite actually a high chance that you could see some of these states restricted in travel in terms of shutting down flights that would be coming out of more hard-hit states like New York or California, but we haven't seen that just yet. Meantime, though, we're going to take a quick break, come back on the other side, chat Disney's turbulent launch with Disney Plus in Europe. More on that right after this. Welcome back to Yahoo Finance. Right now, we are watching the stock market. Right now, the Dow giving back a little bit of its gains off its session high, now up just about 8%. We'll see what happens as we get updates out of Washington, D.C. But meantime, we're also watching individual stocks as well. Disney moving closer to about $100 a share, right now sitting at 95, despite problems it's having in its launch with Disney Plus moving into European markets across the pond. I want to bring in Heidi Chung to get us the latest there. Heidi, what are the problems we're seeing right now?
Zach, well, we saw this kind of the same thing play out when Disney Plus launched here in the US. There were some reports that some people couldn't sign up and the streaming wasn't working in the first couple of days. But at the end of the day, everything worked out fine, and Disney Plus was a very successful launch here in the US. Now, Disney Plus is launching today in key European markets, 7 of those countries: the UK, Ireland, Germany, Italy, Spain, Austria, and Switzerland. The launch in France has been delayed until April 7th. And much like the big streaming players that we've heard from just this past week and late last week, Disney will also be temporarily cutting its bandwidth usage by 25% so that the internet traffic isn't too congested over in Europe. But like you mentioned, there have been some glitches that have been reported that people in the UK have not been able to sign up for Disney Plus. Regardless of that situation, though, I think there have been a lot of questions as to the timing of this launch, whether or not they're going to actually see a big boost because folks are staying at home due to the COVID-19 outbreak. But on the flip side, you have a situation where production has been halted. So Disney Plus isn't able to really release any new content. So whether or not that'll weigh on this launch will be something very closely monitored by a lot of people out there, Zach.
Yeah, no doubt. Potentially worthwhile to keep your eyes on Disney shares. Of course, we're going to be keeping our eyes on the overall market as we await any updates out of Washington, D.C. on the stimulus bill front as Republicans and Democrats continue to debate what should be included. But stay with us right here on Yahoo Finance. After the break, we're going to be chatting with the former director of the Consumer Financial Protection Bureau on how it's best to protect consumers as coronavirus cases continue to spread across the country. More on that. Stay tuned. Yahoo Finance after the break.
Welcome back to Yahoo Finance Live. I'm Shauna Smith. We have stocks rallying today on hopes that we will get a stimulus deal within the next couple of hours. Taking a look at the Dow now back above 20,000. The biggest leaders in the Dow so far today, or biggest gainers, I should say, Chevron, American Express, and Boeing. Those 3 stocks leading the Dow higher. All 11 S&P sectors are in the green right now. But the big story, of course, is that stimulus bill that we are expected to get from Capitol Hill. Let's go down to Jess, who's live in DC with the latest. And Jess, what can we expect in terms of timing on this?
Yeah, we're still waiting to find that out. Minority Leader Schumer said a little bit ago that he had hoped to nail down this deal in the next few hours. So that would put us at some point this afternoon to have a deal, but then we'd still have to wait to see what vote timing would look like. All of the negotiators really have had optimistic comments throughout the day, saying that they are very close to getting this done. Democrats have been fighting for expanded unemployment insurance. They've wanted to see more oversight of the $500 billion going to industries that are hard hit by the virus. And Speaker Pelosi said earlier today that she feels like Senate Democrats have secured some of those changes. So we'll be waiting to see if and when the Senate can vote at some point today, possibly. And then there are a lot of questions about what is going to happen in the House. We know Speaker Pelosi was talking to her caucus about this afternoon. We'll wait to see any word on how exactly this would work because House members are back in their home districts. She is shooting for unanimous consent, which means only 2 people would have to be here in DC to actually pass this through, but it would have to be unanimous. Everyone in the House would have to be on board. And when you have a potentially $2 trillion package here, that could get tricky, but that would be the quickest way to get this done. We'll see how that works out, and we'll look for any updates from Speaker Pelosi on that front.
All right, thanks, Jess. I want to bring in Michael Cox, former chief economist for the Federal Reserve Bank of Dallas. And Mr. Cox, we just heard what Jess was saying just in terms of the timing of a stimulus package. That is one thing that many investors are focusing on right now, just in terms of what it could entail. There are reports that it's believed to contain around $2 trillion in aid for workers and for businesses. How big of a help do you expect this to be for investors, and how big of a help do you expect it to be for the economy overall?
Well, I think it'd be a very substantial help to the economy, especially if spent right. And looking at the details of the bill, it does seem like they're mainly spending it right. We understand that this virus effect is not affecting everybody equally. If you're on a salary, for example, you're a little bit more exempt than someone who's working on hourly wage rates. And so many of America's grassroots workers are being affected a lot harder than others. And so the unemployment insurance compensation for them is important. The extended package for that's important. The money spent for small business is important. I just don't want to see this turn into an opportunity for politicians to, spend $2 trillion, which is 1/9 of the entire national debt.
Michael, what do you think about the monetary policies that have been put in place by the Fed? They have done a number of things to try and help stabilize the markets. Sometimes it's worked in the short term. Other times we've seen markets actually sell off because of so much fear that still remains out there. What do you think about those measures that are in place right now?
I think that the wording of the Fed is the most important thing right now to try to deal with, the fears. Listen, the economy, this is probably hard for people to believe at this point, but the economy has always recovered on its own, and it can recover on its own. Not that we shouldn't have a stimulus package, not that we can't have monetary policy to help. However, we've been through recession after recession, each caused by a different thing. We've always recovered. We've always come back more strongly. And that will happen this time as well. There's some sectors of the economy that are not only not hurt, they're seeing an increase in demand. I expect the sales of computer equipment and things that people can get their home office set up with are flying out the window. Yes, this is hurting some parts of the economy, but people are pretty quick about moving from maybe being a restaurant worker over to delivering pizza for Domino's. People are smart. They want to make their lives or their families better off. Every one of them is thinking about how they can adjust to this.
Michael, what do you think about the potential impact in terms of the labor market? Because there's lots of talk about that. Some of the measures that were put forward or have been talked about, some tied, I guess, back to the stimulus bill, is just encouraging, especially small businesses, to retain their workers, do not lay them off, and then they will get compensated just in terms of potential loan forgiveness. Do you think that will have a big impact, a positive impact here for many small businesses?
I think that's really important. Let's keep in mind the unemployment rate, we're fortunate it was down to 3.5%. So there's a lot of room to run before we get up to the 10% we reached in the Great Recession. So I think that will help a lot. But you know what? There's more that people could do than what government can do. In my own case, what I've done is to make sure that I think about the people who you know, I take the people who say, for example, my maid can't come into my house now, so I just sent her money. And people of means need to take care of the people around them who are less fortunate than us. And there's a whole lot of that charity going on, I'm sure, as well. I certainly hope it is, to help people who are in need. That's important. That people who have been successful show others that they care about them.
And my biggest question and concern, and I think I share it with a lot of legislators actually, is if we put through this nearly $2 trillion fiscal stimulus package, are we going to see echoes of 2008 or possibly the tax reform or the tax legislation that President Trump passed, which is basically that these companies got billions of dollars in aid and they used it to buy back their own stock and let American workers stay out in the cold? Do you think that this new stimulus plan is going to protect workers from a scenario like that?
It won't protect them, but it would be foolish for a company to do that. It's all in the public eye, right? What you do with the money, and they'll be ridiculed for doing so, for taking advantage of it. I would trust the CEOs and the boards of those companies to be a lot more prudent, lest they themselves be the victim of their own decisions. So, and you know, America has become, over the past 30, 40 years, more and more of an oligopoly. A few firms in an industry dominating the industry. The main benefit of that has been those big businesses have a lot of cash on hand now, and they're better able to weather a storm than are the small businesses. So I would prefer to see the funds go to small businesses, to the little guy, than to the big corporations. Certainly some big corporations need it. The airlines need it. You know, the travel industry needs it. But on balance, who needs it, of course, is the lower income segment of the population.
All right, Michael Cox, former chief economist for the Federal Reserve Bank of Dallas. Thanks so much for joining us today.
Thank you, Sean.
Well, this week on Influencers, we had Yahoo Finance editor-in-chief Andy Storber. He sat down with the governor of Connecticut, and the two discussed everything from Washington's response so far to the coronavirus to also shelter in place. But they also talked about the impact that the virus could have on the employment, on the labor market. We just heard Michael Cox talking about that. Let's hear what Governor Ned Lamont had to say.
During the last recession, which is a bad recession, 08, 09, let's say 5,000 people a week applied for unemployment compensation. Yesterday, 12,000 people in one day applied for unemployment compensation. So the economy is dropping off a cliff, especially when it comes to those small businesses, those Main Street merchants.
Well, you can get your full episode on Yahoo Finance this Thursday at 5 p.m. Eastern Time. Well, coming up next, we're going to discuss how to best protect you, the consumer, in a time of uncertainty. We know that as the market begins to drop, a lot of people are starting to panic. And there's also a rising number of scams related to the coronavirus. So we're going to dig into all of that right after this break. Welcome back to Yahoo Finance Live. We've been talking about the impact the coronavirus is having across all aspects of the economy, but we want to focus on you, the consumer. So we know that the coronavirus has triggered a number of job losses already. It's impacting the labor market, and this comes as business activity across many states almost comes to a screeching halt. And we know that when people lose some of their jobs, and people also tend to lose some healthcare, it could also impact the real estate market. So to discuss all this, I want to bring in Richard Cordray. He's a former director of the Consumer Financial Protection Bureau. And we also have our very own RT Swaminathan joining the conversation as well. And Richard, let me just start with you just in terms of, in this time of uncertainty, when people are faced with mounting losses, they look at the fact that we are expected to see much slower growth, at least in the short term. What's the best way to help people try and navigate through this crisis?
Well, first of all, people who suffer job loss, as you say, will often lose health care as well. They may also be unable to afford rent or their mortgage, so they could lose their housing. So there's a lot of talk about some sort of facility to try to help people who are going to miss rent or mortgage payments. At the same time, consumers will find that the different things put out for them to try to help them will often be very complicated. They won't be easy. They won't be something that they can just slide into. So it's going to be important to help them navigate those new paths. Also, there will be a lot of scams and frauds that will grow up and shadow these government programs and government assistance. And people are going to need to be on the lookout for those. We're going to need to provide a lot of warnings for people so that they don't get scammed. They don't have money taken out of their pocket when they can least afford it.
So Richard, because of this coronavirus, we're seeing a lot more uncertainty, and obviously we're going to see a little more desperation on the consumer's part, right? From your experience from the global financial crisis, what are some things that we can do differently now that we have a little bit of hindsight?
Well, I think certainly trying to get money directly in the hands of people. There was some of that done during the last financial crisis, but a lot of the money flowed to the banks, and it wasn't lent on in turn or made available to Main Street businesses or to people in the communities, and they suffered. And there was a lot of resentment about that, and I think it helped fuel the rise of the Tea Party and a lot of the polarized politics that we've seen over the last decade. These economic consequences will in turn have political consequences for people, because they're going to feel resentment. They're going to feel that others got something that I didn't get. They're going to feel that people weren't really thinking about my situation. I'm particularly concerned about the hourly workers, the people who are part-time, the people who can't count on a certain number of hours per week. If they don't have money coming in, it's going to be harder to feed their children. It's going to be harder to meet their payments. And a lot of people are not able to work from home. If you're able to work from home, that's great. But if you have to work face-to-face to do your job, you're either exposed to the virus or you're not going to be paid. And that's going to be very difficult for people.
Richard, what about the fact that we've been hearing reports just in terms of the fact that the coronavirus outbreak is leading to new scams or targeting vulnerable consumers? I mean, it can be anything from, I guess I was just reading a report just about people having a scam where they call your house and they say that they have a test kit for you and they can mail it to you if you just give them a certain information that they need. What do you think from your perspective needs to be done more so than what we're seeing done right now to protect these vulnerable consumers?
Yeah, there needs to be real vigilance and monitoring by government officials, and they need to provide very clear, dependable information about that. People are going to be misled. There are some people, I hate to say it, they're the bottom of the barrel in our society, but they will take advantage of any crisis, whether it's trying to sell you a test kit or trying to sell you medicine if you think you may be sick. And people are going to have to be very careful that they don't get conned by these kind of ripoffs. At the same time, once money starts flowing to people with these checks that are going to go out in the mail or however this money is going to be distributed, there will be ripoff artists looking to lift that off of people and intercept it, or say, you can get it faster if you pay me 25% of it. There will be those kind of scams and frauds. They happen every time, and government officials are going to have to provide very clear information, dependable information to help lead people on the right path, or they're going to go astray and they're going to hurt themselves and their families.
Yeah, it's interesting because New York actually stopped debt collection, and I thought that was an interesting action, that a proactive action that they took. But in your book that just came out, you mentioned that there was an uprooting of what it meant to be middle class. You know, income and wealth inequality grows. Does this coronavirus actually even divide this inequality even further? Are we going to see this even worsen?
I think it does. I mean, you have the divide that we all know between the 1% and the 99%, and that's very real in our society these days. Economic inequality has grown to be its worst, as I talk about in the book Watchdog, since the Great Depression and before. But at the same time, we're going to start to see a divide between government employees who maintain their health care and their pension benefits and the like, and other people. We've seen that divide before. We're now going to see a divide between people who can stay at home and work and maintain their full salary. And for them, it's just an inconvenience, right? They just have to have the right computer equipment and they can do an interview like we're doing now, or they can handle aspects of their jobs, or if they're writers or whatever it may be. But people who have to work face to face are going to be upended. They're already being upended. These are the ones who are having to file for unemployment. Their businesses are closing down. Many of those businesses may not reopen. Small businesses live on a very thin margin. They don't have a lot of capital set aside. They just can't afford it. And so they're going to be hurt if this drags on weeks or months, and many of them will end up not being able to restart again. It's easy to say, we'll just stop the economy, flip the switch, and then flip it again and turn it back on. That is not the practical reality for most people.
Richard, from your perspective, have you seen anything to this scale before, just in terms of relating it back? And Archie was asking you just in terms of the policies that we're seeing now compared to what we saw in the financial crisis, but in terms of people at risk, in terms of people that could lose their job, that could have their financial situation disrupted in some way. Have you seen a scale of anything like this before?
I don't think we've seen anything that happened this fast. I mean, it's been lightning speed. It's just been a matter of weeks, and the entire economy, as you said earlier, has screeched to a halt. That is the reality. It will start to show up in the statistics. They're trying to defer some of the statistics, but it is already happening. Now, the Great Depression endured for years, and we hope and expect this will not be like that. But it will be like the financial crisis, because it is a very sharp drop, a very significant drop, and it will not come back immediately, and it will take time for the economy to adjust. It doesn't just stop and start, as I said, like a light switch. It is a much more complicated, cumbersome marketplace that we have in America. It is much more complicated than people realize. You can't just throw the weight of the federal government at it and think that it's going to be enough. The economy is much greater than the resources of the federal government.
Richard, where are people going to feel the most pain? Is it with their mortgages? Is it with their student debt? Is it with their auto loans? Where do you think the biggest pain point is going to be as we move through this crisis and eventually get over it?
It will be, and again, as I talk about in my book, it will be all the places where people are financially vulnerable. If they lose health care, that is going to upset families, because then a health problem means that your finances can be ruined. If they lose their jobs for a period of time, they're going to get behind on their housing. They're going to get behind on rent if they're renters, or their mortgages if they're owners. And if they aren't given relief, if it's not made available to them, many of them will lose their homes, lose their housing. Some will end up homeless. Many will end up disrupted. Their children's school disrupted. You know, it's already disrupted by having to stay at home, but they'll have to move, and the transience of that. At the same time, people will be defaulting on credit card payments. They'll be defaulting and getting behind on auto loan payments. You know, there's a tremendous amount of credit. Again, in my book, I talk about the fact that consumer credit has expanded and become so widely available that the average consumer debt per person in America is approaching now $40,000 per person. And if people can't sustain the ability to make those payments, many of them will fall into bankruptcy. They will fall into ruin that be difficult for them to come out of. They will deplete all their savings. And this could happen fairly fast for a lot of Americans. You know, the statistics are that it's between a third and a half of Americans who don't have $400 set aside for a rainy day emergency. And right now it is pouring on a lot of these consumers.
Hey, Richard Cordray, former director of the Consumer Financial Protection Bureau. Thanks for joining us today.
My pleasure.
Well, coming up on Yahoo Finance, we will get the latest case numbers related to the coronavirus outbreak. And we'll also talk to the CEO of one company that's supplying test kits to doctors and healthcare workers. We'll have more on that after the break.
Hi, Julia.
Hi, Melody. How are you?
Welcome back to Yahoo Finance Live. We are tracking the latest developments as related to the coronavirus. The World Health Organization warning today that the coronavirus pandemic is accelerating and will get worse from here. Taking a look at some of the most recent numbers that we've gotten, there are now more than 400,000 cases confirmed worldwide. There's more than 17,000 deaths worldwide. Here in the US, the number of cases has now topped 46,000, where several states are now urging residents to stay home. For more on the latest on this, I want to bring in Anjali Kemlani. And Anjali, you've been tracking this story so well for everyone here at Yahoo Finance. What's the latest information you have?
Thanks, Shauna. Yeah, as you just said, really the numbers just continue to climb and really reflect the increase in testing capacity as well in the country. We know that we have seen more than 300,000 tests, I believe, is what Dr. Deborah Birx was saying earlier, and that is a really important number. She did mention also that that is within 8 days, so the ramp up that we were expecting to see, we did in fact see and will continue to. And we know that a number of experts are saying that this week is the week where we'll start to really get a much clearer picture of where the outbreak is. And it does appear right now that New York City is in fact the center of this outbreak for the US. Really with those numbers just continues to increase. There are going to be stricter measures in and around New York City, the New York metro area really at large with the largest impact. We know that there's also a discussion yesterday, Gilead, which, as we know, the remdesivir drug that they are using in clinical trials was designated, could be designated an orphan drug, which would then really roll out the ramp up to the market for that. So really a lot of interesting news as it surrounds the response to the outbreak. Meanwhile, we know that New York is ramping up its focus, whether you're talking about hospital beds or ventilators. Governor Cuomo saying we have not flattened the curve in the state as should have been. So really need to watch out and see what happens. Meanwhile, we know Washington State and California also disproportionately affected by this outbreak. Shauna.
Anjali, I want you to stay with us here. We've been talking about the fact that healthcare workers around the country are facing severe shortages when it comes to masks, but also in diagnostic kits. Everlywell, they are one company. They are looking to help supply those diagnostic kits. They are sending their first batch of kits to hospitals and healthcare systems. I want to bring in Julia Cheek, the CEO of Everlywell. We also still have Anjali Kamlani with us, and we are also joined by Melody Ham. And Julia, just walk us through just in terms of what exactly, I guess, how your kit works and who you are supplying your kit to at this point.
Absolutely. Thanks for having me. So it's really not so much you think of a kit like a rapid test kit, right? This is a packing piece that has the nasopharyngeal swab. It has instructions. It has shipping materials for biohazard samples, and it has a saliva tube in it. And this is being packaged and sent out in bulk orders now. We've received over 450 bulk orders from healthcare organizations on the front lines, and started fulfilling this morning directly to these frontline workers from their employers, for physicians themselves, for their patients, for home health agencies with homebound individuals that are high risk, and for nursing homes. And so that is really where our focus is now. We shifted focus for a few reasons, away from broad consumer access to allocating as much of our initial inventory as possible to frontline workers.
Hey, Julia. So to that pivot, especially with the communication and dialogue coming out of the FDA, to be honest, kind of confusing consumers, and I'm sure startup founders like yourself. Can you explain to us what that communication has been like? Because we know initially there was that incentivization and really kind of spearheading with the Silicon Valley community in particular, saying, hey, provide us with those solutions and options. And then on Friday, we heard from the FDA saying none of these have been FDA approved. So walk us through that timeline and where you are right now in communication with them.
Yeah, absolutely. So on March 8th, we laid out a development incentive program after the FDA's EUA guidelines were published for CLIA certified labs. And our goal was to, with no recourse for us, just to grant $1 million to labs that were able to meet the EUA guidelines demonstrated by the FDA, such that we were incentivizing more labs to get involved in the problem. And there's 250,000 CLIA certified labs. A portion of those meet infectious disease requirements. And it was important to bring to market a number of labs to aggregate capacity beyond just LabCorp and Quest. So we did that independently, and then ultimately had such an overwhelming response that we knew our platform could help bring these labs to market so that their tests could be able to be used for COVID testing. And so decided to be able to launch a product. Now, our model, which is normally regulated by CMS and CLIA, relies on at-home sample collection, as is fairly common for a variety of different sectors, Medicare, et cetera, not obviously for this particular test. And so a number of companies who have the same model as we do actually launched before us after we announced, I think prompting the FDA to then say, hey, wait a minute, you might have thought you were following guidance, but we actually didn't have guidance on this. And now we're going to say in a statement that the EUA does not cover at-home sample collection, although we are potentially exploring what that looks like. And so for us, as soon as we saw that guidance, it was important to us that we reach out and work directly with them. That plus the overwhelming response we had seen from healthcare workers, plus the White House's priority testing cohorts announced on Saturday, caused us to overall decide to make a shift. And I fundamentally believe it was absolutely the right thing to do. And we're in active communications now with the FDA on what does the process look like for a self-collected sample at home. Could we work with you on that? What do we need to provide from a study standpoint? And I'm hopeful to have an update soon.
Hey, it's Angela here. So really quickly, first of all, is this covered by insurance if it gets to the consumer, if it gets to the point of the consumer? And then secondly, with that process, with the FDA looking at possibly allowing consumers access to this, it seems like part of the concern is that it's a very complicated situation already with the swabs right now. There are concerns about false results. So could you address that?
Absolutely. So on the cost side, this was something we had received feedback on and was yet another point that made sense to shift towards healthcare organizations. The cost to us is $135 end to end for the process and for the testing. We priced this at $135 at no profit to us. Ultimately, we are a private company. We do believe all testing should be free, but we can't offer it for free without reimbursement. And so now in this way, this is in working with the organizations we're working with, they have guaranteed that the patients will not pay. And much of this will also be facilitated to their frontline staff. So that is the cost for us. Overall, the cost of testing, as you've heard, involves a number of things. It's running the assay, it's the components, it's the transport, it's everything involved in the process. And so it can run anywhere from $50 to over $200. And it's a wide range that labs are pricing this at. So I think overall, we need a really great federal aid bill that can sponsor all that testing. And the government is committed to that. On the results side, it's a great question. So you saw last night that the FDA actually updated guidance allowing for self-swabbing in certain situations, which is drive-through clinics and a clinical setting, drive-through testing in a clinical setting. But they actually did something interesting, which is they changed the swab type. So the swab type is the mid-nasal swab type, which means it's much easier for an individual to correctly sample. And so that is something we're watching closely. We would love to be able to offer either a saliva or a different type of kit to the consumer, because then you are able to much better guarantee a well-collected sample.
And when you talk about those guarantees, can you kind of quantify the accuracy we're talking about here, even as it's getting into the hands of medical professionals who are using this in hospitals and private practices? What is the efficacy here?
Yeah, so we work with a number of labs that have submitted data and are under the FDA EUA. So when we talk about that data, it all complies with what the FDA has required for validation data, but it spans different laboratories, although it is all RT-PCR testing at this point. So, I don't want to make a statement about one specific lab, that's their data, but all of it is under review by the FDA and will be updated regularly to the FDA in order for them to issue that EUA. And many of them are either getting granted the EUA now because there's the 2-week waiting period, or are imminently going to be getting that.
All right, Julia Chica, CEO of Everlywell, thanks so much for joining us today.
Thanks for having me.
Well, coming up next on Yahoo Finance, we've heard a number of companies pulling their guidance because of the coronavirus. Twitter is the latest to do so. We're going to dig into that story. And we'll also talk about the economic impact Japan could suffer from delaying the 2020 Olympics. Stay with us. Welcome back to Yahoo Finance Lab, where we see stocks are surging today with the Dow holding above 20,000 in terms of leadership. Energy continues to outperform this afternoon as a top performing sector. We're also seeing some gains in industrials and financials. So, of course, we've been talking about the coronavirus, how that's impacting a number of companies. Twitter was out with news after the bell last night. They actually pulled their first quarter guidance because of the coronavirus. They're saying that there's so much uncertainty out there. We have Yahoo Finance's Emily McCormick joining us. And Emily, you have been tracking this story just in terms of what Twitter is expecting to see, how the coronavirus could potentially impact their business. What are they saying?
Well, what Twitter actually put out with its guidance withdrawal after the bell yesterday, it was actually pretty similar to what we've heard analysts saying about other social media and internet companies that do rely heavily on advertising revenue. So Twitter said that it's withdrawing its guidance due to the growing impact of COVID-19 on the global operating and economic environment and their effect on advertiser demand. So of course, as we see events like sporting events, like other sorts of live theatrical events that usually would be relied on for Twitter advertising get actually halted or put off because of the coronavirus outbreak, that's lost sales for Twitter overall. So originally the company had predicted between $825 million and $885 million for first quarter revenue. That's all out the window now. The company did say that it will provide another update on its earnings call scheduled for April 30th. So hopefully we'll get another update there. But for now, we don't have that visibility heading into the first quarter, which is a bit disappointing considering that Twitter had been on a pretty strong trajectory coming out of the fourth quarter of 2019. They'd seen year over year, quarter over quarter growth in their monetizable daily active users. And that's something that Twitter said is continuing now, even with the coronavirus. So they actually said that their quarter to date average total monetizable daily active users reached about 164 million in the current quarter. So that's up 23% year over year and 8% quarter over quarter. So with people social distancing, with people inside and trying to get news updates, there are more users on the platform. They're just not being monetized and creating as much revenue as they would previously because of the impact on advertisers. So that's kind of the duality of the impact of COVID-19 on Twitter to date.
Emily, how are analysts reading this? Because like you mentioned, Twitter was actually doing relatively well before this. A lot of analysts who were bearish or who were a little bit skeptical on the stock started to turn a corner and become a little bit more positive. Is that no longer the case?
Well, actually, interestingly, even with this guidance withdrawal, we haven't seen any major Wall Street shops withdraw or change their outlook on Twitter. So no ratings changes overall. We do have a number of analysts that were reiterating, as you said, that they came out of the fourth quarter out of 2019 on such strong momentum that it's something that could come back once COVID-19, that outbreak starts to wane in the US particularly. This is what one analyst, Doug Anmuth of JP Morgan, had to say, though. He said, quote, importantly, the fall off in Twitter's back half first quarter revenue suggests that our recently revised estimates for other ad driven companies are likely too optimistic. So some analysts are taking Twitter as sort of a harbinger of potentially more negative impacts on other internet giants, on other social media giants as well when it comes to monetization.
All right, thanks, Emily. Let's turn to another big story that is in sports. We have Japan and the International Olympic Committee announcing today that they will be postponing the 2020 Olympics. It is expected to be delayed by around a year. We have Sabile Marcellus still with us. And Sabile, you've been tracking this story and just looking into what this could mean from an economic perspective to the country of Japan. What are we expected to see, or how, I guess, could this impact Japan from an economic point of view?
Yeah, Shauna, this is another major blow to Japan's economy. They'd been struggling recently, and they were really hoping to have the Summer Olympics, to have people from around the world come watch the games, sit in the stands, buy tickets, get the tourism, get all that money and revenue. And now, because of the coronavirus epidemic, now we just have to cancel the event. So that's what Japanese officials have said. That's what the International Olympic Committee has said. And when we look at the impact it's going to have on Japan, it's expected that it will shave off reportedly 1.1 trillion yen, which is the equivalent of about $10 billion. Now, Japan has already spent billions of dollars preparing for the Olympics. The economic impact is also going to be felt here in the US for all the advertisers who over the past 4 years had been planning to be sponsors of the Olympics. This takes many years to figure out. They were also going to have stars and star athletes and celebrities featured in those ads. So some of the companies that had already signed up to be official sponsors include GE, Coca-Cola, Airbnb, Procter & Gamble, and Visa. So now all these companies have to figure out what their backup plan is because now the Olympics aren't going to be happening for Japan.
At least, well, within the next year because they are postponing it, right? Correct. So it's expected to happen
Right, not in 2020
from now. So just want to make sure we are all clear with that. All right, Sabine, thanks so much. Well, coming up here on Yahoo Finance, we have smart thermometers. They could help detect coronavirus hotbeds. At least that's according to one company. And this could be happening ahead of what the CDC is finding. We are going to talk to the CEO of Kinza after the break. Welcome back to Yahoo Finance Live. It's no secret that it has been difficult to contain the coronavirus and tracking the number of cases in the face of a shortage of kits here, not only nationwide, but also worldwide. We have one company that's looking into using internet-connected thermometers. They've used it to predict the spread of the flu. They're now saying that it could be used to track coronavirus in real time. So I want to bring in Inder Singh, a CEO of Kinza, along with our very own Akiko Fujita. Thank you both for being here. Inder, just explain to us exactly how this works, how a smart thermometer could potentially track the spread of the coronavirus at this point.
I think you painted the picture well, right? We have a shortage of tests. We have a shortage of personal protective equipment. We have a shortage of beds. We need to know in real time where to triage, where to send the resources in so that we can respond effectively. So we're using our nationwide network of about 1 million smart thermometers to know where fever spikes, an early indicator of any outbreak and certainly of COVID-19, are occurring in the community. We have changed, we've reconfigured that tool over the last several weeks to detect anomalous fever spikes that you wouldn't expect from normal cold and flu season. And those are hotspots, right? Those are where we're seeing massive rises in clusters of people having fever. You know, community spread is occurring, right? I cannot definitively tell you that it's COVID-19 versus some odd strain of the flu, but it's unexpected. It's not the normal stuff that you'd expect, and it's growing rapidly. And one of the challenges is that there's all these delays in the system. There's delays in testing. There's delays in people getting symptomatic. But in those areas that have implemented aggressive social distancing activities, you can see it right in the data. You're seeing those fever clusters level off and start to diminish. The Bay Area shows that very clearly. Florida is now showing that, although for a long time you saw a massive rise in anomalous fever, which means that potentially we're going to see a large number of cases come down the pipe there.
So, Inder, if we are seeing that lag right now, what does your real-time data tell you about how it's different from the data we're getting right now? I mean, you assume the testing that's coming down, the results are a week behind. How has the picture shifted for you?
The testing is not a week behind. The testing is weeks behind. There's so limited testing being done right now, and people are getting, they're contracting the virus, and that's a problem, right? Again, they may or may not show symptoms for up to 14 days. But what our data is showing is that we're clearly breaking the chain of infection. The number of people that have a fever in communities that have implemented aggressive social distancing activities, stay at home, shelter in place, we're clearly seeing that the number of people that have a fever is diminishing and dropping fast, meaning that we're breaking the chain of infection, meaning that we're flattening the curve. And that's important. Have we flattened the curve enough? I don't know. I don't have the answer to that, but we're clearly breaking the chain of infection as we see it. And we're going from this dotted line that's going up, and you're getting into the red zone of anomalous, atypical fever clusters that should not be there in normal cold and flu season. And suddenly it's starting to drop. So that's what we know today.
Inder, what are you seeing just in terms of your data? I know that you guys are a little bit ahead of what the CDC is pointing out, just in terms of hotspots or areas where the coronavirus has broken out that we are not aware of yet. What are you seeing?
Yeah, we saw about a week and a half ago that we were already seeing increases in anomalous and atypical illness in Florida and the Northeast. In fact, we got on to a call with a number of public health colleagues. At that particular time, there was not a lot of case reporting in those areas. And they said, your methods are sound, that looks all good, but you're showing me that there's a large, growing level of community spread in Florida and the Northeast. We don't really know that. Lo and behold, 4 days later, the reports started coming out. And so that just gives you a sense for how much earlier a real-time system. This is a very simple idea. It's being able to collect and aggregate medically accurate data, on a county by county basis across the U.S. to know where and when symptoms are occurring, right? And how many people have those symptoms. In public health speak, this is a syndromic early warning system, right? And it's obvious, right? If you know where and when illness is spreading, well, that's where the light bulb goes off and says, go investigate. There's an outbreak of some sort. Send the virologists in, send the test kits in. And, the way that we've been to date trying to hotspot for COVID is, I just read an article the other day about how the government's using surveys now to hotspot. It seems like we're using 19th century technology when we have a 21st century real-time network of products out there that literally can tell you where and when people are getting ill and where and when community spread is occurring.
So Inder, having said that, what have the conversations been like for you in partnering with the CDC? And I have to wonder, this is just one technology you're talking about. There's a lot of companies in the US. I mean, do you think that the federal government is doing enough to tap into the kind of innovation we're seeing in the private sector in trying to get real-time data that's just not available through normal ways of testing right now?
I do not believe federal government is doing enough to do that. We remain available and excited to partner with federal, state, and local officials to provide access to whatever kinds of analytics you need. We think that there's other products out there, there's other technologies out there that provide valuable real-time data. We have to analyze them, right? The benefit that we've had is we've been doing this for years. We've been predicting flu for the last 5 years accurately and much ahead of others on a local basis, not just on a national basis, but being able to get down to resolution at the county level. And so we have a body of literature that we've created, but there's other products and there's other technologies out there that need to be integrated so that we can do real-time analysis of where and when outbreaks are occurring and real-time analysis of how interventions or how effective interventions are, right? When you see that all of a sudden there's a breakup of there's a decrease in the number of people that have a fever in a location, again, you know that you're starting to break the chain of infection. Did you do it early enough? We don't know, but we're definitely seeing that that's happening, and that's important in this context.
Inder, I want to ask you real quick, just in terms of demand. I was reading about the fact that your company is now selling around 10,000 smart thermometers a day. Can you keep up with this type of demand?
We stocked out. We launched healthweather.us, which is where we're displaying all of our data, and we stocked out within the first hour. We were selling 10,000 units a day before that, which was way higher than we expected. I'm excited to say that our manufacturing partners and us have stepped up. We're going to have nearly 100,000 units coming in every week, starting in about a week and a half here. We're working our tails off to sort of make sure that we can actually meet demand. And more importantly, the more sensors we have out there, the more smart thermometers that are out there, the better the data is, and the more fine the resolution is. You can start hotspotting within a city if you get enough smart thermometers. Which parts of the city are having community spread? Which parts are not? So we think it's really important. I started the company 8 years ago with this vision. We've been doing this the whole time. It was not about a smart thermometer to begin with. It was about creating an early warning system. And now it's proven to be valuable. Now we need to roll it out and make sure there's infrastructure in the United States so that when COVID rears its head again in the fall, and many believe that it's going to, we need to be prepared to deploy resources to where and when they need to go.
Certainly is proving to be valuable at this time. Inder Singh, CEO of Kinsa, thanks so much for joining us today.
Thank you. I appreciate it.
Well, coming up on Yahoo Finance, we're going to talk about the surge that Uber Eats is seeing as demand for delivery continues to grow as the outbreak of coronavirus continues to spread. We'll have more on that after the break. Welcome back to Yahoo Finance Live. Uber is one company that is seeing a surge in demand, at least for its Uber Eats division. So restaurants are scrambling to offer takeout. And of course, they need to deliver their takeout to some of their consumers. And that's where Uber Eats comes in. We have Dan Howley on the line with us. And Dan, you are digging into this story. How big of an increase has Uber seen just in terms of demand for Uber Eats?
Well, they're seeing a large increase, obviously, from consumers because a lot of states that are locked down now only allow takeout or delivery orders. And that's really become the lifeblood of a lot of restaurants. So as far as the numbers go, Uber said or rather an analyst has said that Uber has seen 10 times the number of self signups that restaurants do for Uber Eats. And that's JMP's analyst Ronald Josie. Basically, what self sign up is a restaurant going up into Uber's own website and then signing itself up so that it can be part of the Uber Eats community. Then Uber on its own, their own small and medium business side, has signed up 2 times more restaurants and bars than they normally do in a day. So they're obviously doing a lot of business here. And you could tell as restaurants start to close, we have some data from OpenTable, how much that's impacting the industry. According to OpenTable's data, we've seen a decrease from 10 to 15%, 10 to 19% of eat-ins. That's people that call up or walk into restaurants or set up reservations online, to minus 100% and 95% year over year. So it's really devastating the industry on a large scale. And these companies, Uber Eats, DoorDash, the like, are really trying to kind of be the only vehicle that these restaurants and bars have.
Hey, Dan, I know another story that you're digging into. So obviously Uber Eats is seeing a surge in demand. We've also, I think a lot of our viewers may have seen on social media, people using Zoom or other types of apps to have kind of their stay-at-home parties right now, since people aren't supposed to be outdoors. You're actually looking into the best apps for those stay-at-home parties. I mean, enlighten us just in terms of what we should be using right now.
Yeah, I mean, there's Zoom if you have a corporate account, because if you don't, then it's only 40 minutes limited, but you can get up to 100 people on a call at once. We were using that over the weekend to hang out virtually with friends and play video games. Then there's the popular House Party that gives you 8 people online at once and has built-in games. WhatsApp, you can do up to 4 people video chatting at once. And Google Hangouts, the old standby, that's up to 10 people at once online. So there's plenty of options out there, plenty of ways to stay connected virtually. You don't have to be alone by yourself during this lockdown.
That's nice. I know everyone loves to be around some other people during this time. Dan Halley, thanks so much. We'll keep it right here on Yahoo Finance. We have the Dow moving back above 20,000. We'll take you through the last hour of trading next.
Right now, on track for the second biggest point gain for the Dow right now. Nasdaq and S&P also up pretty well here. S&P closing in on up right now. I'm also joined by my co-host, Miles Edlin. He's live in New York City. And joining us on the phone, billionaire investor Howard Marks. He's the co-founder and co-chairman of Oak Tree Capital Management. So Howard, I want to start big picture here with where you think we are right now, where we find ourselves in America in terms of the economy and the labor market and the stock market. Do you have a sense that there is opportunity right now here?
Well, where we are in terms of the things you mentioned, obviously, first of all, I don't make forecasts. I only regurgitate other people's forecasts. New jobless claims were 211,000 2 weeks ago, 281,000 last week for a major increase. At least one brokerage firm is saying 2.5 million for next week. So obviously we're heading into an enormous unemployment challenge. The economy, likewise, most forecasters are saying that GDP will decline by 15, 20, 25% in the second quarter, which I imagine would be the worst quarter in history. So these things are not going well at the present time. Obviously, there's a lot of optimism around the Fed's actions, and certainly the Fed and the government are throwing everything at this financially that they can, and I don't believe that anything is off the table. Where will it go? How fast will it trickle down? How fast will it work? These are the questions. Millions of small businesses have had to close now for a couple of weeks. They'll probably be closed for another couple of weeks. That people will lose their jobs in the millions. And how fast will the economy come back? These are all economic questions. On top of that, we have the challenge of the coronavirus disease itself, and we shouldn't lose track of the fact that that's the problem. I don't think you can buy the virus off. So the point is, the economy will stay closed for some period of time. Exactly how long, we don't know. But if we attempt to bring it back too fast, I believe we'll have an echo, a rebound in cases. The U.S. has not taken the draconian actions that Singapore, Korea, China, and maybe Italy have taken. People are still socializing. I still shudder at those pictures of college kids on the beach. What happens when they go home from the beach to their home communities, where until now there haven't been outbreaks. So, I think the outlook for the economy is weak. The outlook for the disease is bad. On the other hand, there's good value in the markets. I liked them before they went up 9% today, more than I do now. But there is good value, and I put out a memo Thursday saying that there's no argument for spending all your money now, but in my opinion, there's also no argument for not spending any.
Howard, you've written a lot about cycles and the shape that they take over time. And, you mentioned that you don't make forecasts, you just regurgitate what others make. But, you rattled off some of those GDP numbers, and those were revised 3, 4, 5 times by some strategists just in the span of a week. And when you see people on the street, people in this business scrambling to throw bigger and broader numbers out there to get a sense of what might happen, does that say anything to you about what part psychologically of this cycle Wall Street might be in?
Well, look, first of all, as you probably know, I put out a memo a couple of weeks ago, and the title was Nobody Knows. So nobody knows what's going to happen with the disease, or I don't think what's going to happen with the economy. And if anybody has a strong position, they should get in touch with me, because I'll bet them they're wrong, whatever it is. There's just no justification for having a confident view at the present time, in my opinion. And Wall Street's takes it as its job to fill the void with forecasts or information. I was talking to one of the major investment houses last week, and at that time they had cut their earnings estimate for the S&P 500 for the year from 173 to 158, which was a decline of about 15%. And when I next caught up with them, their estimate was 115. So the question in my mind is, do these estimates do any good? On the one hand, people like to have information, but what good is it to have information if its probability of being correct is low, as in my opinion it usually is. The point is, nobody knows. You can decide to be optimistic today. You can decide to pessimistic. I don't think you should rely on so-called data, because there is no data with regard to the future. And you know, in the face of uncertainty, my approach is to hedge my bets, not to go all in or stay all out. Even now.
Can we talk about that a little bit more? I guess, I mean, you are known as managing risk, and that's what everyone's trying to figure out right now, is how to manage risk given all the unknowns that are out there that you're talking about right now. Does that mean just keeping your powder dry? Does it mean trying to find some of the values that exist today? How do you manage risk in this environment?
I think that your question is indicative of the challenge. And when most people say manage risk, what they mean is avoid the potential for loss. But there's another risk, which is the risk of missing out on gains. So, you know, let's say that you and I are talking and we say, well, there's a 60% probability that the market will be down 3 weeks from now. Let's say you and I agree. So the question number one is, what do we do in our portfolios about the 60% probability of a decline? But we mustn't lose track of the fact that we also should deal explicitly with the 40% probability that it's up. And what do you do about that? So, you know, if you say to somebody there's a 60% probability of a decline, it's easy to say, well, then you should get out of the market. But what do you do about the 40% probability that it goes up? And if you're out of the market and that's what happens, then you really will have missed out on something and will regret it. So, you know, I prefer to think of risk as the probability of having undesirable outcomes, not just losses, but also gains that you miss out on, and you have to balance the two. And I think that the fundamental outlook, as I said, for the disease and for the economy is poor. But on the other hand, you know, stocks are on sale relative to where they were a month ago, and I think that those sale prices cover a lot of the carnage. So, as I said before, I don't think there's a good case for investing all your cash today, but I also don't think there's a good case for not investing any.
Howard, I want to ask you about what you called some illogicalities in your letter a couple of weeks back. One of them was the not specific. I mean, you made the mention that some people compared this to 9/11, and you mentioned that that's a one-day event.
Oh, can you hold on 1 second, please? Just a whole second.
Hey, Miles, I'm still here.
Hello. Yeah, I mean, I think challenging time and interesting comments so far from Howard. We'll see if we get him back here.
Yeah, I mean, the idea of keeping some powder dry, I think, resonates with a lot of people.
I'm sorry to have jumped away.
Oh, no worries, Howard. I just wanted to ask you about comparisons from this moment to any prior points in your career. I think a lot of people in the investing world right now are really struggling to find any decent analogs to the past. One that you mentioned in your letter that didn't make much sense to you was 9/11. That hasn't really been mentioned quite as often, but it certainly was in the beginning of this phase something people compared it to. Are any pockets of this market that you're looking at reminding you of anything from the past, or are we just across the board in uncharted waters here?
Well, I do think that it has a lot of similarities to the global financial crisis, because that was a sweeping crisis. It began in the financial markets, and the biggest culprit was leverage. There was chaos. There were major markdowns across most asset classes. Of course, it started with subprime mortgages and their defaults, but it spread rapidly. And when assets are marked down rapidly in price, anybody who owns them, either on margin, that is using leverage, or more than they should be holding, let's say, intestinally, more than they have the intestinal fortitude to hold in tough times, anybody who's holding assets in either of those circumstances it may be forced to sell. And then, declines produce sales. Sales produce further declines, so you have a downward spiral. And we had a bunch of that in global financial crisis. It turned out to be a crisis of leverage and liquidity. And this one is as well, although not to the same extent. The good news, but there are also differences. That was a financial crisis. This starts off as a health crisis. That time our lives were not in danger as they are now. That's one. Number two, that time the banks were levered 33 times their equity, 32 times their equity. And so, there were rumors of bank meltdowns. And of course, even some real cases. This time they're levered 1/3 of that, so nobody's talking about problems at the banks themselves. So differences but similarities, and I think it's a relevant comparison. But let's remember what Mark Twain said: history doesn't repeat, although it rhymes.
So we've got a little bit of rhyming going on, and of course there are the liquidity issues that you mentioned. What about the solvency concerns? As somebody who has a lot of experience in distressed assets, what do you think we're going to be seeing here in the next few months?
Well, part of it depends on how fast they bring the economy back, and part of it depends on how broadly they distribute these let's say bailout programs. But if they can't bring the economy back, let's say, I've seen a lot of forecasts that had the economy up in the third quarter. I think that's very optimistic. And if the economy goes 6 months from now in negative territory and starts off down, let's say 15 to 20% in the second quarter, then I think you're going to have a lot of defaults. Now, on the one hand, most debts today don't have covenants, which means you can't be forced into default because you have too little net worth or too little cash or what have you. The only way in this climate, the main way in this climate to have a default on outstanding debt is to not be able to pay interest or principal. So that's good news. That means fewer defaults. On the other hand, in the last 5 years, lending standards have been low, and companies that shouldn't have got loans have gotten loans. And when your business goes to zero, so a bunch of those will default on their interest payments. So I think we'll have substantial defaults, in the next year.
Howard Marks, so great to talk with you. Oaktree Capital. I wish it were under different circumstances, but getting your thoughts on a day like this, we really appreciate it.
I'll come back to discuss the good news in the future.
Fantastic.
Thank you.
I'll hold you to it. Hopefully it'll be sooner rather than later.
Good. Okay. Bye-bye.
Again, Howard Marks with Oaktree Capital. We're watching the market here, still in a rally phase. We'll be back right after this. Back to Yahoo Finance Live. We are watching markets rally here, turnaround Tuesday. We've got the Dow up nearly 10% right now, adding on to gains. The S&P trying to catch up there, up a little bit over 8%, and Nasdaq up close to 7%. Even have crude oil to the upside here as well. Let's bring in Miles Edlin, my co-host. Miles, just looking at some of the moves here, there are some huge outsized gains in certain names that have been so beaten down. L Brands right now is up more than 30%. MGM and American Airlines both making moves up over 30% as well. Are we seeing this rally concentrated in some of our least favored sectors?
Yeah, I mean, I don't think a lot of people are looking at today's rally or looking at what happened yesterday and saying, yep, that was it. There's the bottom. We're all off to the races. You look at just I was looking at the same thing just inside of the Dow. The biggest gainer right now, American Express, that's a stock that had been down some 50% from its high. Chevron is the second best performer in the Dow. That stock had been more than cut in half ahead of today's action. And then the one of the top 5 best performers is Boeing, our old friend, that is a couple $100 off its high, $120 a share right now, but it's traded at $398 within the last year. And so this is a stock that's been under considerable pressure. And look, I mean, I don't think anybody loves the analysis of, oh, well, this rally is just short covering, or that sell-off is, everybody taking profits. But clearly, when you look at what's performing today sector-wise, energy and financials, I mean, those have really been the hotspots of a lot of the pressure. That's, energy, obviously, because the price of oil, and then financials, what's the old line? They're a leveraged play on the economy. The economy right now is in a bad space. So financials have really taken a big brunt or taken the brunt, I think, of a lot of selling. And you look at that forced liquidation we've discussed so often. So, we'll kind of see what happens in the days ahead. No one likes to see any market move 6, 7, 8% on a daily basis, regardless of the direction. But it certainly doesn't seem, based on the names and the sectors that are doing a lot of the work today, like it's the highest quality rally you've ever seen in your life.
And some of the names that had been doing a lot of work for us are not in the green today. Walmart right now is off. Verizon, our parent company, is off. And Amazon, which has been up, holding its own recently, is up only 1% today, not keeping up with the general sentiment that we're seeing here on the street right now. Well, we're going to be back with more on Yahoo Finance Live. We've got Sarah Friar coming up. She is the CEO of Nextdoor. That's right after this break. time of social distancing, we are also being drawn closer together. And one company that is really seeing that is Nextdoor. Nextdoor was built to bring neighbors together. And I want to bring in CEO Sarah Friar. So Sarah, can you just tell us what you've been seeing at Nextdoor since the coronavirus outbreak really started to take hold in this country?
Sure. Thanks, Jen. Thanks, team, for having me. It's been a wild time at Nextdoor. In a way, this is what we were built for. So for anyone who doesn't know us, we are the neighborhood hub. Nextdoor is all trusted connections. So real neighbors at real addresses. And man, oh man, do people really need their neighbors right now. On top of those trusted connections, we're a platform all about utility. Now, in good times, that might be help me find a plumber, help me find a great restaurant, help me know what to do this weekend in my neighborhood. But right now, it's about neighbors coming together to be that front line of support. So if I'm elderly, it might be help me find someone to go to the grocery store for me or go to the pharmacy for me. I see people reaching out right now asking for tech help, help me figure out how to work from home. We see parents coming together, giving great ideas on how to homeschool. So all around us right now, we see incredible engagement on the platform. It's up almost 80% just on a month-over-month basis.
Hey, Sarah, when you think about the 2 new product offerings that you launched kind of in light of this, I don't know if those were already in the works, but of course, COVID-19 probably expedited it. When you think about the Maps feature, which is basically like any young able-bodied person raising their hand saying, I can help out, are you seeing a certain use case in particular that is the most in demand, perhaps from those elderly folks who are living alone?
Yeah, so thanks for mentioning those 2 features. They were definitely on the roadmap, but at times like this, you've got to go for it. And I'm super proud that the team is just working 24/7 right now. So Help Map and then Groups, and I'll talk about both because they solve slightly different use cases. So the Help Map is really all about this power of proximity. So you can drop a pin on that map and effectively put your hand up to say, I'm here to help. Now, what happens is then someone on the other side who might be a little bit more vulnerable can now directly message you through that pin to say, I'd love to take you up on that offer. And so what we see a lot happening right now is food and food deliveries. As we know, seniors are being asked to really self-isolate and really make sure they're staying home. So even though supermarkets are opening, for example, early to allow the elderly to come in, many don't want to leave their home. So we see people picking up groceries, but even just cooking a homemade meal and setting it on the doorstep. It is amazing. In my local area, so on the group side, we have a help group around COVID-19. There are now almost 500 people in the group, and just the matching that has gone on person to person is just incredibly inspiring. And it comes back to something we say a lot on Nextdoor, that in the tough times, we definitely need our public agencies, right? The folks like the fire department, or in this case, the hospital. But when it really comes down to it, it's your neighbors who save you. It's literally the people who live nearby. And I think that's what people are discovering on Nextdoor right now.
Well, it's so interesting you say that, because you have also partnered with Governor Newsom here in California in creating new awareness campaigns, right? So when you think about the leadership from not only the federal level, but the state level, how would you assess some of these people's performance as you're working closely with them?
Yeah, so we have a pretty long history of working with public agencies. Nextdoor kind of came into its own, frankly, during Hurricane Harvey. And that was a time when we were working very closely with the mayor of Houston. And so we find many mayor's offices, governor's offices, health and human services, and so on. Right now, our number one thing is to get the most accurate real-time information in front of neighbors. So we really are leaning on the CDC and the WHO for that, and also all of the local health and human services departments. But you mentioned Governor Newsom, and I felt really proud to be a Californian last week when he announced what the state was going to do. We know that self-isolation is key right now to flatten the curve, or at least to give our emergency services a chance to prepare and hopefully manage what's coming at them. He launched a partnership with Nextdoor, particularly around this idea of neighbors being the front line of support. And you know, it's all sorts of things. Like there's tremendous food insecurity, we know, across the United States. For many kids, without going to school, they don't have access to that school lunch program, for example. And so we see that as being another place where Governor Newsom, along with his whole effectively the whole administration, is doing things like how do we make sure children, for example, are getting the food that they need day to day. These are just the little things that I think many of us don't think about, in daily life when we're just hard at it. But now that people are having to shelter at home, we're being forced to kind of think about the vulnerable in our society.
Sarah, Dan Roberts here. Good to have you on. We've been talking about Nextdoor, obviously, but I'm glad you mentioned California, the state. While we have you, I'd love to hear what you are hearing from other CEOs in tech, because we hear a lot. We already were hearing long before coronavirus about various issues in San Francisco and Silicon Valley, but now amid coronavirus, you hear a lot about the way it's hitting tech and small startups' ability to raise VC money right now. What are you hearing from your fellow peers, fellow tech CEOs and leaders?
Sure. So, I think first off, everyone is just trying to make sure we do the right thing, keep our employees safe, keep our customers safe, and our partners, and think about all those supply chains. And it's interesting to see there's definitely tech platforms that are coming into their own on that front. Aside from Nextdoor, Slack is another company near and dear to me, and being able to see what Slack can do from a work from home perspective has been incredible in terms of helping people keep business flowing. I actually find that the conversation is way more focused around SMBs. So forget about tech for a moment, right? The businesses that are really hurting are those small mom and pop local businesses. They employ about half of all the employees in the US. And so I think many of us are rallying around how do we help those local businesses. At Nextdoor, you'll see us roll out in the next couple of days, really 3 things, and something I think everyone listening should think about. The first is gift cards. Like, how do you help bridge cash flow for businesses that just can't even open at the moment, like a hair salon, for example? Second is delivery, right? If you're in the food area, many of those mom and pop shops are now switching gears to how do I do a pickup or how do I do a delivery, but how do I get the message out that I'm actually still open for some business? And then I think the third thing we're going to do is partner with GoFundMe, which is a good example of a tech platform in action right now. Because in many cases, neighbors will actually fund a local business, because on the other side of this, we want them to survive. A big part of a strong community is thriving local businesses.
Sarah, one of the arguments that's being made is in light of these small and medium-sized businesses suffering, one of the real winners here perhaps are those big box stores, whether it's the Walmarts, Costco's of the world, and of course, Amazon.com. I know you're on the board of Walmart, and they've been really at the forefront of a lot of these initiatives, hiring 150,000 workers, raising base pay, and even though that 1 hour dedicated to senior citizens on every Tuesday until the end of April. Just thinking about those initiatives, are you planning to kind of incorporate job listings, these sorts of offerings in light of a lot of layoffs and furloughed workers, to your point that perhaps even a gift card or a GoFundMe won't save that business?
Yeah, it's a great point. And you asked me earlier about the sorts of actions I see neighbors taking. The other thing I'm seeing a lot just personally in my feed, and we see it across the platform, is those hourly workers putting up their hands and saying, I lost my job. Does anyone know where there's jobs available? And I think that's where you can steer them to someone like Walmart that obviously is out there hiring at the moment. Walmart's #1 focus has been the health and safety of their employees. They don't have the privilege that we all have to sit in self-isolation but still do our job. So that's rule #1. And then the second is to keep the supply chain humming, because so many millions of Americans depend on them for getting essentials like groceries. But I think in a local way, we can really help those hourly workers by making sure that we're thinking of them during this crisis, so orienting them to the places that are hiring, but remembering them as we come out of this crisis. There's a lot of stuff that happens around your home that all the time people get matched on the platform, from neighbor for hire things like a dog walking service or a babysitting service, all the way through to those totally favored local businesses like the local plumber. And I think just remembering the shop local, act local, think about that, bringing that to the forefront is a huge part of what the Nextdoor platform can do.
And I know you don't disclose full usership, but I know you mentioned that daily active users have gone up. You're in 260,000 neighborhoods across 11 countries. Can you share whether you're opening and launching in new markets as we speak? I'm sure there's a lot of inbound interest, given this is a good way to galvanize the community.
Yeah, I think it's, in some ways it's the hardest thing because you want to do more and more. So as you point out, we're in 11 countries. Right now, we're really trying to go deep in the countries we're in. So Italy, for example, is one of our younger countries, clearly a country that's needed as much neighborliness and neighbor-to-neighbor help as anywhere else in the world in a way. In the UK, we've been leaning into the public agencies that we talked about earlier. So folks like the National Health Service and making sure that they can get their accurate real-time information out. So while we're not launching a new country per se at the moment, we absolutely see this need globally. And to your point, I've had so many inbounds from countries all over the world of people saying, how do we get Nextdoor going here? So we know that we have more to do, and it's great to see the demand. But I think at times like this, we're just trying to go faster and harder on the things in the countries that we're in, like a help map, like a help group, and some of the stuff that you'll see coming for local businesses over the next couple of days.
Sarah Fryer, the CEO of Nextdoor, Melody Hom in California. Hey, both of you guys are in California.
But isolated from each other.
Not in California. Sarah Fryer, thank you so much for your time. Coming up, we have more on the rally. Right now, the Dow 30 getting close to being up 10% on the day. We're watching this rally. We're also going to be getting an update on what's happening with COVID-19 and the Olympics and media. More coming in just 2 minutes. Welcome back to Yahoo Finance Live, where we continue to add on gains here to the rally that is underway right now. The Dow adding on nearly 1,900 points. It's now up more than 10%. Miles, I want to bring you in here. Just, we've been having some big moves lately on a percentage basis right now. Our biggest move back on the 13th, March 13th, was almost 2,000 point move, up about 9.3%. We could eclipse that, and then this would really be our biggest move since 2008 that we've seen.
Yeah, I mean, I guess I'll steal the Andy Serwer line that I'm expecting to come up in the 4 o'clock hour, which is we're back to the point where 1,800 points on the Dow actually means something, right? We've seen the Dow, kind of come from 27,000 or so. We were in the 18s yesterday. So certainly a volatile market, but I think, again, as we have said so many times, you don't ever really want to see the stock market moving this large, the moves this large on a percentage basis at any point in time, because if the stock market theoretically is discounting all future growth that U.S. companies can feasibly return back to their shareholders, well, why would that change by 8% over any one day? So certainly not a stable situation. You and I talked earlier, Jen, just about some of the names that have been doing a lot of the work. And I wanted to look at the FANGs a little bit more closely, quickly, if we could, because Netflix right now is the lone laggard, or the lone stock that is lower among that group. The stock is down about 0.8%. We've seen Netflix obviously do quite well as part of the at-home trade. Amazon also lagging the market, up just 1.2% today. Facebook up about 8%, Apple up over 8%, Google up some 6%. And I think that the trend is probably, or the fact is probably going to remain true when we're through the other side of this and looking for how does the market durably bounce. I think a lot of that action is going to have to come from these names. And the character of today's rally certainly showing itself by, leaving Amazon and leaving Netflix behind. Those stocks have done quite all right amid all this volatility. But it is, I guess if I just said the rally is kind of soft, I guess it's a little bit encouraging to see Alphabet, Apple, and Facebook participating as this market goes higher. But I think anytime you see energy as the big leader here, a sector that's gotten so beaten down, a sector that's so heavily shorted, hard to be too enthusiastic about today's action.
Energy and some financial names just making gangbuster moves here. American Express is up 20%. Morgan Stanley is up nearly 18%. As Miles just said, a durable bounce. Let's bring in Jared Blickery to see if he can put any chart action on this bounce to let us know if indeed, I don't know, is this durable? What do you see here?
What's your definition of durable? I think this lasts for a few days, maybe a week or two, maybe into the end of the quarter here, and we do have some headwinds. So everybody knows about the fiscal stimulus that's supposed to come, the central bank stimulus that's underway, and the Fed is printing $625 billion per week, at least in this week right here, and that's just unprecedented. QE3 was $85 billion. But we'll take a look at the S&P 500 here, and we can see it's up 8.5%. Dow is up nearly 10%, and it is going to be a nice day. How long can this continue? Well, yesterday after the close, I said I was encouraged. I was just a tiny bit more bullish than I was Friday, and we're starting to see things fall in place now. Now, this line I'm just drawing, we're seeing the S&P 500 just break out of this really steep downtrend. This had to happen sometime. Are we going to get a 2 consecutive closes in a row, which hasn't happened since, I think, the second week of February? It's quite possible here. And as I've been mentioning, we have pension fund rebalancing, which begins to take effect tomorrow. So that would be Wednesday into the end of the month, into the end of the quarter. Pension funds have to buy equities and they have to get rid of bonds. And so that could help these movements that we're just beginning to see get underway here. We'll take a look at some other markets here. The volatility index, the VIX, is down. It's down for about 20 points from its high, so it's not quite as elevated as it was, but still extremely elevated. 10-year T-note yield. Now, this is up today. It's up only 5 basis points, was up a little bit more. And this is kind of reminding me of March of 2009, or maybe December of 2009, because December was kind of that period where people thought, okay, we got the bottom in here, we're going to launch from here. But of course, we went down, took another leg down, and then it took the Fed launching bazooka QE in March to really get things started. So we'll have to see which one of those it might be. I think it's going to be the former, because I think we got some more pain to take. But just in line with the Fed being in the market right now, just check out, I pulled up gasoline. I was looking for gold here. Look at what gold is doing. It's having its best day since just after Lehman Brothers. And I think this is reminiscent of all the stimulus the Fed has thrown at the market here. I think gold has legs from here. And we'll just check out the action in the Dow Jones Industrial Heat Map. And we can see just a little bit of red here. Those are, and Walmart just turned green. Those are the staples and the defensive plays. Whenever you have a rally from these really depressed levels, you tend to get a junk off the bottom. So anything that has been depressed and really sold hard tends to lift off more. And we see that. Look at JP Morgan. It's up 12.5%. Miles was just talking about energies and financials kind of leading here. That's not the healthiest sign, but usually that is how these things get underway. So I'm a little bit encouraged. And again, I think this could have legs to last a few days, maybe into the end of the quarter. But I think we're going to revisit the current lows and maybe exceed them at some point. So here are the sectors. We see energy up 13%, financials up 12%. These are some of the best days they've had since the financial crisis, and that's not necessarily the company you want to be in. And then to the downside, in the lower right, we see staples, communication services, healthcare, real estate. Real estate has just been obliterated. Some of those funds have been, they've had to close because of so much carnage in there. But the bottom line is I'm a little bit encouraged, and I think we got some legs here, but only time is going to tell.
So a lot of green out there, Jared. Interesting to see the VIX there at 60. That's good. Given, I don't know. I mean, I know it's good to be down from 80, but it just shows you how things have changed. And another story that reminds me how everything has changed, and let's bring in Dan Roberts for this, is the Olympics. So Dan, when the coronavirus outbreak was sort of just starting to hit the US, the Olympics was a big story for us of what was going to happen. Now we seem to have more clarity on that, right?
Yeah, we do, Jen. Now, officially today, the IOC, as well as the organizing committee in Japan, coming out and saying, okay, it's postponed for probably about a year. The official wording saying that it will be later or beyond 2020, but no later than summer 2021. So if I had to guess, I think it's likely it ends up being maybe exactly a year later than it would have been. And just an interesting, fun side note, it mentions in the statement that even though it'll be held in 2021, it will still retain the name of the 2020 Summer Games, which is kind of interesting. I think that this was inevitable. And as you mentioned, we've been talking about this for weeks and anticipating something here. And in fact, many had begun to loudly criticize Tokyo for not having done this yet. I think when history looks back on this, no one's going to remember that, you know, Japan dragged its heels and maybe took longer to announce it than was necessary, dragged its heels. That's fine. What matters now is it did what most people are calling the right thing. I mean, Canada was really lit a match in a sense here by pulling out, saying that even if it's happening, well, we're not participating this July. So I think that was a big part of it, kind of like how Duke and Kansas did the same before the NCAA had officially canceled March Madness. I do think it's a silver lining that it's not canceled. You know, I'm seeing headlines saying cancellation. It's a postponement. It's going to happen. I mean, barring some terrible situation or this thing lasts a year, I just don't know. But as of now, it's going to happen in 2021. That's good. But what does this mean for athletes? I mean, if you've been training under the thinking that this is happening in July 2020, it's not as simple as, okay, I have an extra year to train. I mean, a lot of these people, you know, Justin Gatlin, for example, had said he was shooting to be at the Olympics again. This would clearly be his final Olympics. You know, he's in his late 30s, I believe. Well, can he still do it being 1 year older? I think about questions like that. But at least it looks likely to happen in summer 2021 rather than not happen at all. But now it is official. Interesting from Shinzo Abe too, because politically he had made a lot of hay with the Olympics. You know, that was kind of something he was going to hang his hat on. He still will do that, but you know, Japan has elections October 2021. So how will this year-long delay of the Olympics affect Shinzo Abe's political standing?
Dan Roberts, and of course, there's a lot of other knock-on effects for media companies and broadcasters and sportswear makers who tailor these whole ad campaigns around that. Do they just put all of that on hold? I'm sure there'll be a lot more to come on that front. We also have more coming up. We've got Jack Manley of JP Morgan Asset Management on the other side of this break. We're going to be talking more about the markets here, what he's looking at, and I don't know, what he thinks about this rally. We're back in 2 minutes. Welcome back to Yahoo Finance Live. We are about 13 minutes away from the closing bell. We are a little bit off the highs for the session, but still a big bounce here for equities. Investors betting on a coronavirus rescue bill from Washington to help here. Let's bring in Jack Manley, JP Morgan Asset Management. So, Jack, you're watching this market along with us. Is this for real? Is this a bounce that's going to have some legs? What do you think?
Is this for real? I mean, I certainly don't think so. I mean, it seems like yet another day of markets overreacting to news, good or bad. It's something that clearly we've been seeing over the last couple of weeks. It's something, frankly, we've been seeing for the last several months, just with all the anxiety built into really the last innings of this expansion. I think the single largest short-term risk, which was the absence of meaningful fiscal policy, has been removed, or at least it seems to be very close to being removed. But the fundamental underlying problem still exists, which is that new cases continue to develop. The mortality rate seems to be a little bit higher than we'd like it to be. And this very clearly isn't going away in the next week or two. I would expect markets to sell off at some point this week, perhaps even tomorrow. And I think, as was mentioned earlier, it could be possible to achieve new lows even after today's such strong performance.
Jack, I'm wondering if you could just kind of set the scene for us and what your conversations with clients have been like, because things have changed so dramatically, so quickly. I mean, by the hour they change, and it certainly doesn't feel like that pace has let up at all. But last week seems to be the week, from my reading, that you started to see the forecasts go from pretty bad to downright apocalyptic by the end of the week. So what are those conversations like as your clients are getting, research from across your group and things are getting bleaker by the day?
Sure. Well, just as the information is changing so rapidly, so too are those client conversations. I know the tone has shifted quite a bit every single day when we are talking about these things. I think that generally what's going on here is that this is taking everybody by surprise, even though it probably shouldn't, given the experiences that we've seen sort of across the pond over in Europe, in parts of Asia. We knew that this was extremely contagious. We knew that we would have to take drastic measures to combat it. And those things are now coming true here in the United States. They're coming true on our own home turf. And I think that is shocking some people. I'll say that the tone is not so fearful as you may anticipate, given everything that's going on. But I think people are out there just really looking for some clarity. When can we see a bottom? What will policy actually do? Those are the questions that we're getting asked right now.
I mean, everybody wants clarity, but we just had Howard Marks on from Oaktree, and he's like, nobody knows. That's the problem right now. There is a real lack of clarity, and it doesn't seem like it's coming anytime soon. Mm-hmm. So when you think about what people should be doing right now, is it about keeping powder dry? Is it about getting into some pockets of value now? Is it about sitting on your hands? What do you do?
Well, I think diversification, as always, is going to be your friend in this situation. I think all asset classes play a role in portfolio construction even right now. The roles may have changed, though, a little bit. Fixed income, I think, with the Fed moving rates lower, with the credit market under some pressure thanks to what's going on in oil, is not really going to be a source of income. But it is, I think, a source of ballast, especially with Treasury yields moving higher today on some of this risk-off sentiment. There is room for that duration trade. On the equity side of things, we are approaching, and I think we'll get there, to very, very low multiples. Stocks are looking pretty cheap relative to history. And if we are indeed long-term investors, then maybe it is time to start thinking about re-risking those portfolios. What's happened over the last couple of weeks is that even if we took no steps in protecting ourselves, our portfolios have already de-risked because of the moves in both stocks and bonds. I think we can afford to perhaps look to risk a little bit more, but look to it intelligently. Look to quality, look to larger cap names, those more stable names. Look for names that can provide you income while maintaining a fixed income allocation, more for that ballast.
Jack Manley, JP Morgan Asset Management, Global Market Strategist. Great to see you. Thanks so much for your time.
Thank you. Take care.
Coming up, much more on the markets. We're heading to the closing bell, just about 8 minutes away, with a big rally underway on the street. We'll be back right after this. We are getting close to the closing bell here. We've got the S&P up just about 9%, the Dow up 10.5%. Miles, I wanted to check out the Bork portfolio, the old movers here. And interesting to note, really the only thing that's down is Zoom, which is off almost 15% today. Kind of interesting, this dichotomy of the old winners of the last few weeks being down.
Yeah, I think it fits perfectly with the theme we've really hit on here, which is that all the names that had been getting absolutely smashed in the last month are seeing some decent bids today. Obviously, exceptions all over the place. And I think that really gets to where this market could be headed longer term. And I know we haven't talked about it yet. We'll get it after the bell with Jared, but very quickly, look at the VIX right now. We had the VIX under 60. And I just think that we continue to see the VIX coming off of its highs. And the more we see volatility come under a little bit of pressure, the more I think you're able to get slightly more constructive on where the market could be headed over the weeks and months ahead.
Right now, we are heading to the closing bell coming up in just a few minutes. The Dow getting close to being up 11%. Looks like its best move since 2008. We'll be back right after this.
All right, good afternoon, everybody. Welcome back to Yahoo Finance Live. Miles Othen with you here in New York. We've got about 90 seconds to go in today's trading session. Let's take a quick look at where the major averages stand right now as we head towards the closing bell. The Dow is now up some 11 percentage points, up over 2,000 points. You'll recall yesterday we saw the Dow in 18,000 territory for quite a while. And here, obviously, a huge rally on our hands. The S&P 500 is up some 9%. The Nasdaq, the relative laggard here, up just under 8% with the tech index. As we've talked about over the last hour, you kind of look across the board today. You look at the stocks that are outperforming, the stocks that are underperforming, and it really seems to be a lot of the names that had been under the most pressure getting a huge bid today. I do want to call out financials here as we get towards the closing bell. KBW Bank Index is up some 12%. You go through some of the major money center banks right now. Bank of America is up 15.8%. Shares of Citigroup are up 14%. JP Morgan up 12%. You go into the investment banking space. Morgan Stanley shares are up nearly 20% in today's session alone. Obviously, these stocks had gotten hammered, but a huge bid here on one of the market's best days in quite some time. Got about 10 seconds here to the closing bell on Wall Street, and we'll have that for you live in just a few seconds. right, and that was the second straight closing bell with no one down on the floor of the New York Stock Exchange. We'll have to see how long that trend holds in place. Of course, yesterday, the first day that we saw no one down on the floor for the first time in a couple of centuries. I want to bring in my co-host here, Jen Rogers, for more on today's market action and just kind of what stands out, Jen, after a rally all day. And I guess the news out of DC, and we'll hear from Jess Smith in a little bit, incrementally more positive. But it's not like we had the votes during the day, and it's not like we know exactly where this thing is headed, but the market kind of front running the anticipated response out of DC.
And people wanted to get on that train, and they got on at the end and really pushed us over the finish line strong here. I'm going to have to wait for the final settlement. Jared will probably have that. It's looking like we will actually surpass the move that we saw in October 2008. That is the fifth largest percentage move for the Dow ever. Really, only in modern times, you got to get rid of 1929 and 1933 when we moved up 11.1%. So again, just settling out right now. Looks like we will eclipse that. And it's a 2,000-point move here. This now becomes the biggest point move for the Dow ever, looking like the fifth largest on a percentage basis. Miles, as you were noting, some of the big banks having large outsized gains here. I also want to note what we've seen in Boeing shares today. Boeing, of course, a big laggard even before the coronavirus outbreak started to hit. Boeing up nearly 20% today, right as we were heading into the close, also getting some hits on the Reuters wire that President Trump said on Fox News that he will not let Boeing go out of business, and Boeing added on to gains after that hit.
Yeah, Boeing, you look at the Dow today, that stock was the third best performer, up 19.9% just in today's session alone. Let's bring in Yahoo Finance Editor-in-Chief Andy Serwer for a little bit more on today's market action. And Andy, I guess I've been of the mind that anytime you have the market moving this much, it doesn't actually mean good things. And we actually went around the horn here last week, and it seemed like everybody was hearing from everybody else who wanted to know when to buy. And I don't know if sentiment really justifies the bottom quite yet. What do you make of this kind of action?
Yeah, Miles, you read my mind. You know exactly where I'm going with this, baby. And I hate to be the party pooper, but Jen Rogers herself said, not since fall of 2008. And then she named it another year, 1929. And let's just stick to 2008, because in October of 2008, the fall of 2008, yeah, you did get these huge gyrations. The market did go up a lot. And this, I believe, was after Congress finally got its act together, which apparently is happening right now. And apparently that's the reason, at least in good part, because why the market's up today. But let's not forget what happened after that. The market went down a lot more, and in fact bottomed, as we all know, in March of 2009. So here's the way I look at it. I mean, first, there's 2 points. Number one, in this type of environment with this volatility, it is like death to go in and out. I mean, you're just crazy. I know someone who got out of the market yesterday, and they're literally freaked out and bummed out, number one. Number two, if you really think that yesterday was the bottom, I will send you a check for $100. I don't know what I'll do, but I just do not believe that we are off to the races from here, that it is all clear. And there is just so much more to flesh out, to be worked out, to pan out, to figure out. There's so much more pain, quite frankly, coming to the economy. And I don't want to be a doomsayer, but I think there's more pain to come. And so today's just one of those days, Miles and Jen.
Yeah, and I think, Andy, we're going to have a lot more of those days, one way and the other, right? I think we're going to continue to see big days up, big days down. And as we've discussed so often, trying to, definitively say the market did this because of that in this sort of environment can end up being a little bit of a futile attempt at times. All right, let's go down to DC for Jess Smith, where Jess Smith is standing by with the latest on where things stand in the Senate. Because Jess, I think it's been about 5 hours since I heard Chuck Schumer say this thing was on the 2-yard line. Clearly, we're taking our time down there.
Yeah, we've heard positive comments from leadership all day long, but nothing official at this point. According to a Fox News reporter on the Hill, Treasury Secretary Mnuchin said he still hopes it's tonight. He said that they were trying to finalize documents and they are making progress on a lot of complicated issues. Now, Minority Leader Chuck Schumer did have a call with Senate Democrats, and there are several reports that he told members on that call that he was able to secure $150 billion for state and local stimulus and $130 billion for hospitals. That was a big deal for a lot of Democratic lawmakers. They wanted to see more state and local funding, more money for hospitals to deal with this. We also know oversight has been a big issue for them. And now it looks like increased SNAP funding is an issue that they are trying to work through at this point. So we'll be looking for any details on those provisions. We don't know the timing here. They are hoping to get this deal done tonight, but we still don't know how the votes are going to play out. We're looking for details on that. And that's all happening in the Senate. And then we have the House. Members are away from the Capitol right now. They would have to vote by unanimous consent if they didn't want to bring all those lawmakers back. Speaker Pelosi has said that she is trying to push for unanimous consent, but that requires everybody in the House to be on board with this. And as negotiators are just trying to come to a deal on this phase 3 relief, there are already rumblings of a phase 4 or potentially a phase 5, that there may be more legislation that needs to get done after this potentially $2 trillion package. We do now know also in the past 30 minutes or so, the White House has scheduled a press briefing with the coronavirus task force. So we'll be looking for any more details from the administration at that time. Miles.
All right, Jeff Smith live in DC with the latest on where the Senate stands in their negotiations. For more on the coronavirus outbreak, how many cases we have confirmed here in the U.S. and abroad, let's go to Anjali Kemlani standing by with the latest. Anjali.
Thanks, Miles. Yep, absolutely. The number is 2 milestones in one day, more than 400,000 cases worldwide and more than 50,000 in the U.S. now. And half of those alone are in New York. As we know, New York has been ramping up their testing and really ramping up preparation for that burden, that overflow that might actually hit the hospital systems in the area. So New York City, especially being, a major site for those cases, Dr. Deborah Birx earlier saying that possibly because there's so much interaction, it's such a dense area of interaction that, especially on surfaces like subways, really that's where it was probably quietly spreading for a very long time before we caught it with the testing. So now that testing is really ramping up, we're expecting to see even more of that and get a much clearer picture this week of exactly where that virus is. Meanwhile, as just mentioned, waiting to hear more from the coronavirus task force later today. We also know that with the testing, we've also brought on even more insight into what the states are going to need to ramp up for. Washington State, as we know, was really hard hit, especially in the nursing homes. We saw CMS, the Centers for Medicaid and Medicare Services, come out with a report recently identifying exactly what went wrong and really rolling out some priorities and targeted inspections in nursing homes for the course of the outbreak to make sure that we don't have a repeat of that. And also, as we know, California, another hard hit area, also ramping up, receiving one of the hospital naval ships as well. So still have to wait. We're still sort of a wait and see mode and just waiting to see where this outbreak pans out, Miles.
All right, Anjali Kemlani with the latest on the coronavirus outbreak. Of course, over the last month, I think one of the biggest trends we've seen across the world in various parts of our lives is events being canceled and kind of the future getting put on hold here. Let's bring in Yahoo Finance editor-in-chief Andy Serwer for the latest, I think, Andy, on a shoe we knew was going to drop, but now has officially dropped. That's the postponement of the Olympics until next year. We hear they'll be called the 2020 Olympics, though they're set to take place in 2021. And we discussed this story a couple of weeks ago, that it seemed inevitable this was going to have to happen. I guess just what's your view on now that it has taken place on how we proceed with the rest of this year? Because a lot of people do look at things and is it an Olympic year, an election year, and the Olympic year has now been redefined kind of on the fly here.
Yeah, Miles. Well, of course, relating the Olympics, strictly speaking, this was one we saw coming, and I was, gallows humor joking that if this was a stock, you would short it. It was just so readily apparent. And now it's taken place, and it's going to be another big hit to the Japanese economy. I think someone said $30 billion was probably low, but that's, the costs that our societies are actually, having to bear right now. But I think it speaks to a bigger tension, which is, when do we reopen? And that has been front and center today with President Trump saying he wants to reopen the U.S. economy on Easter, April 12th. And the scientific community is saying, whoa, that's way too soon. I know that Mark Penn, the pollster, came out and said he has a 60-day plan. So this trying to decide when to reopen. And, it's not all places are going to be equal. So in other words, maybe some place in North Dakota is never closed. And I think that that is going to have a huge impact on, the economy, obviously, and trying to reopen. Some things will, like cruise ships and airlines are going to take a very, very long time. And so that is something that we have to, separate from the political process, because I think some people have been complaining that it's connected a little bit too much to that. So you have scientists on the one hand, politicians on the other, business people probably in the middle, and we really need to be safe before we move forward.
Yeah, and I think, Andy, part of that challenge too is defining what is the economy, right? There's, what we're obviously all feeling right now is that we look outside our window and people aren't outside, and all of our favorite restaurants are closed. But, when you think about the bigger stuff, the long-term supply chains, the international trade, we continue to see the president and others emphasize that trade is still happening. And I think on the other side of this, we expect some kind of a bounce back. We're starting to see some flashes of recovery happening in China. For more on just kind of where the global supply chain goes from here, let's bring in Akiko Fujita, because Akiko, I think there's a lot of anxiety in the U.S. looking both to Italy on what happens on the health side, and then looking to, I think, what's happening in China right now. Maybe that's a hopeful sign, but they were shut down for 2 months. And okay, if they're back at 80% capacity right now, that's all good and well, but this thing just started for us. So does that mean it's going to be mid-June before we're looking at the U.S. economy getting into gear?
Yeah, Miles, and I think there is an argument to be made here that, we shouldn't necessarily be looking to the Chinese timeline per se to say, well, that's how long it's going to take for the U.S. to bounce back. I've been reaching out to some contacts to get a sense of what this all means for the supply chain. And I have to say, it feels a bit like deja vu, given that we spent the last year talking about supply chain disruptions stemming from the U.S.-China trade war. One person I did speak to, the executive director of the Center for Global Supply Chain Management over at USC, he has been consulting with a lot of these companies, including the big hospitals, about where they can source their equipment from, their medical equipment from, and all fingers point back to China. And what I think is interesting in that conversation I had with him is that, he's saying essentially the bounce back that we're seeing in China right now is fueled by the outbreak that we're seeing globally. In other words, where you look at Italy, whether you look at the US, there is a huge need for medical supplies, as Anjali has been noting every day. And all of that production, a majority of it is still coming out of China. He puts the manufacturing capacity in China right now at 60 to 65%, which is much higher than what we heard from the executive director over at the Port of LA yesterday, who said, based on port activity, he puts that at just above 50%. Either way you see it, I do think it's interesting that a virus that originated in China, now a pandemic, is starting to help the Chinese economy bounce back, because they still have the capacity to manufacture a lot of this equipment in a very short amount of time. And so while long term, a lot of these companies are going to be looking at diversifying their supply chains, not putting all their eggs in China, so to speak, right now they're having to go back to China because that's where the capacity is.
Hey guys, just to make sure we're not overlooking a couple of really important things. Markets are obviously ecstatic that the stimulus bill seems close to passing. The stimulus bill is not going to get the economy back on track. It will only help later. The thing that gets the economy back on track is getting testing, widespread testing. It must be everywhere. We probably need to test everybody in the country more than once. We need to have that much capacity, and we're nowhere near that. And just on President Trump's idea that we're somehow just going to get everything back started up again around April 12th, that is never going to happen. This is a decision that governors and mayors make. So President Trump can issue recommendations, and he can urge people to now disregard the social distancing guidelines that he put in place about 10 days ago. But polls are now showing that just about everybody in the country is waking up to this, even if they don't have it where they are. And when cases start popping up in cities and states that have been pretty lucky so far and have avoided this, they have no choice but to react the same way for the same reason that we've been doing it here in New York and in other places, which is the healthcare system will get overwhelmed if you just let everybody go out and conduct business as normal. So I think there is absolutely no chance we start getting back to anything like normal around April 12th.
Yeah, Rick, that Easter headline certainly stuck out to quite a lot of people. I know we'll talk about that in just a little bit here, more on kind of what all went down in Trump land today. And I guess we'll be hearing from the president in about an hour and 15 minutes from right now. All right, we're still awaiting earnings out of Nike. Companies are still reporting their results. We'll see what the international apparel giant has to say about their end markets, what's happening in China. We expect those results out any minute, hopefully on the other side of this break. But first, we'll take a short break. We're back in just 2 minutes. All right, welcome back to Yahoo Finance Live. Miles Udland with you here in New York. We're joined now by Stephen Agron. He's a managing director at Karl Marx Advisors. And Stephen, let's just start with I think a topic that we haven't touched a lot in the last couple of weeks, which is what's happening right now with higher education and where the educational system as a whole goes from here. If we go back in time just a couple of weeks here in the U.S., I think we saw a lot of the large-scale shutdowns happen at the university level, and then we saw it at the public school level. States and municipalities across the country moved quickly. As you see the landscape right now for these institutions, where do they go from here to try to finish out this school year and then kind of pick the pieces up and figure out how to proceed when September rolls around?
Well, Miles, this is kind of the important part of the year. You've got your seniors who are graduating, and they're going to be integral into your future emissaries and your people who are going to talk about the schools. We're not talking necessarily about the well-known, highly branded universities. There's over 5,000 schools in the United States. The majority of them are small regional schools. So they're dealing right now with the seniors who are graduating. At the same time, they're sending out acceptance letters for their new admits. So they're kind of at a major crossroads right now in the school year. So if we look at this, we'll take the seniors first. So the seniors are coming back from spring break, or in this case, they're not coming back from spring break. A lot of them were looking forward towards this time of year. I know when I was in college, this was kind of the best part of the 4 years. It was that last term, you were able to hang with your friends and do that. That's what a lot of the students want to do. At the same time, they're also looking for jobs. Well, they're coming back from spring break and they're going home. They're not hanging with their friends. And all the job fairs that were scheduled are now not happening. So you've got a lot of anxiety with some of these students. So some of the recommendations we're making to university presidents and the administrations is to make sure you're keeping very good outreach and working with those students who are seniors. You can't do anything trying to recreate their senior year and that last term, but you can help them making sure that they're getting in contact with potential employers. You're keeping in contact with them. You're making sure that their resumes are right so they can look back at the end of the year and say, okay, at least I had a positive experience when I finished off my college experience. It's not what I expected, but they helped me through. They kept communication and all that good stuff. The other side of it is your incoming students. Again, a lot of high school students were expecting to go on their revisit days. They were expecting to do their college tours with their parents, trying to make final decisions about where they may want to go. Well, if that's still out there, and now you're asking students to make final decisions without being able to do that last touch of the university. And as a matter of fact, they can't even talk to really anybody there because all those people are home. So this is a really anxious time for the new incoming students and for the graduating students. It is key for the administrations to make sure they're doing correct outreach to reach both of these very critical constituencies for the future. They really need to make sure that the graduating students who will be future donors and the incoming students who are going to make up their classes for the next 4 years are involved in the process and feel like they're wanted by those schools.
We've been talking a lot about the balance sheets and the solvency of companies, public and mom and pop companies. For schools, obviously large, well-endowed schools are going to be able to handle the shutdown. But should we be expecting that there are smaller schools that aren't on the bubble that actually won't make it through this crisis?
I think that's absolutely going to happen. It was already happening as it was now. There's been a lot of schools, smaller schools, that are having challenges. I think one of the things that people have been, or schools have been against, is kind of merging programs with other smaller schools in their area. The big schools have kind of forced the smaller schools to offer everything to everybody, and they just don't have those resources. So while you may have a couple of schools in the area, maybe one's going to give all the business courses and one will be a science, but the other schools will be able to latch on and send some of their students to take a class or two there, so they don't feel like they have to have everything for everyone. So I think you're going to see a massive, consolidation again in the smaller school space. It's been happening. These schools, as you said, are not well endowed. They're having some challenges, and they actually lived semester to semester. And right now, it's really challenging because a lot of them rely on that summer term. Well, I don't think you're going to find a lot of students right now signing up for the summer term.
Hey, Stephen, I have a college senior, so I feel a little pain there through her, and I'm also on the board of a college. So I've been watching this sort of unfold real time from various perspectives. It's been very, very difficult, and some are rising to the occasion and some are not, as you indicate. What are some of the things that the schools are looking at in terms of making the decisions about getting people back to class, about graduation, summer programs, and then let's talk about something we haven't even mentioned, which is the fall semester. I mean, is that even under question?
Well, all of those are challenges. What I've been telling most people I'm dealing with is right now the horizon and the information out there is so much changing on a regular daily basis that trying to cancel graduation right now, or even say we're definitely going to have graduation right now, is almost impossible. So you've got time. I mean, there are schools that have early May graduations. They're going to have to make a decision pretty soon. But the ones who are late May or June, you still have some time. And while we all are expecting the worst right now, given what the situation is and how long China took to get through this, for parents, this is their opportunity to go enjoy their graduating seniors' time in limelight. It's really going to be kind of harsh for them and for the graduating students. As far as the fall goes, again, I think we're probably pretty good for fall. The question is, you've done your acceptances now. You've sent out your acceptances in the next couple of weeks if they haven't been done already. You're trying to predict who's going to accept you. And one of the challenges you have is you don't know. Are people going to hesitate going to a city school because There's been extensive outbreaks more in the city schools. Are people going to want to stay around locally and go more to schools in their area because of the concern that this whole outbreak has begun and created things that you never thought about, like, hey, I've got to pick up my seniors or my students' belongings from their dorm room within the week. And I live in Florida, and they are in Miami of Ohio University. I have a friend who was dealing with that. They have to get in a car, drive out there, pick up the stuff. And they were never expecting that. I think those are challenges. But as I said earlier, the summer term is really the one right now that is going to have a major issue, because I don't think they're going to have very strong registrations for summer. The fall term, it's going to be what it's going to be. I think the students are going to be very excited when they get to their schools, that's for sure, after dealing with this. I mean, I've got a senior in high school right now, and they're kind of upset. They're not going to have potentially graduation. They're not going to have a senior prom potentially. They're not going to have that last couple of weeks and months hanging out in the nice weather here. But that's the reality of what we're living through now. It's not going to end immediately. We're hoping to get to graduation. That's kind of the key of what people are focusing right now. Maybe you get back the middle to end of April, but what we were just talking about looks that's going to be kind of challenging.
Hey, Stephen, one of the things that struck me about the closures with the universities is how little investments were being made towards online learning. It sounds like it was single digits. I mean, it seems like a lot of these bigger universities were well prepared for that. But I'm wondering if the lasting impact of what's happened or played out over the last few weeks is the fact that universities are going to invest a lot more and move a lot more classes online.
Online learning has been huge, or a huge opportunity for a lot of universities, but there's been a lot of pushback. The administrations that have on-site campus learning kind of feel that this could impact them a little bit, which it can. Also, it's not really simple. It takes potentially years to set up a curriculum, and a lot of effort goes into every single class that goes from on-site, on-campus learning to virtual learning. So it's not a very easy that I'm teaching a class at the campus level, I'm just going to convert it very quickly to an online learning experience. It's a very, very large investment and a very time-consuming investment. And you really have to create a administration and a learning group that is geared to that learning, which is very, very different, especially for the younger students, the 18, 19, 20-year-old students. Online learning, while they live their life online these days, our kids trying to learn and deal with that could be something different. I mean, I've got my daughter right now who's doing online learning, and you're asking them to watch a computer screen basically for 7 to 8 hours a day. There's a little challenge in that. It's a little different on the college level, but from any kid who's going through this right now, it is a definitely different experience than what they were expecting from an on-campus situation.
All right, Stephen Agron is is a managing director at Karl Marx Advisors. Really appreciate the time today, and talk to you soon.
My pleasure. Thank you.
All right, Nike earnings are out. Shauna Smith has the numbers for us live. Shauna Smith.
Hey there, Miles. So digging through these numbers, revenue coming in at $10.1 billion. That was slightly better than what the street was expecting. Earnings per share coming in pretty much in line with expectations at 53 cents. Digital sales increasing 36% year over year. That's across the board. Gross margin slightly better than expected at 44.3%. That was versus the estimate of 44.2%. Over in China, we know that was where we were going to see the first impact of the coronavirus. China's digital sales rose more than 30%, but they did see that slowdown in brick and mortar stores. We didn't get that specific number there, but digging into their overall revenue in Greater China at $1.51 billion, that was a decline of just around 5% from a year ago. Revenue in North America increasing just around 4% at $3.98 billion, and revenue in Europe, Middle East, and Africa, revenue there coming in at $2.71 billion. And Miles, digging through this release, they did discuss the disruption a little bit further, just in terms of what they saw in China in regards to the coronavirus. They were saying that at the peak in February, roughly 75% of Nike owned and partner doors in Greater China were closed, with others operating on reduced hours. They also went on to currently nearly 80% of doors are open in Greater China, with an even higher rate in key cities. Now, we do know that beginning March 16th, all Nike owned stores outside of Greater China, Japan, and Korea were closed to help curb the spread of coronavirus. They didn't really detail any specifics in this release. They did, though, mention that they will dig a little bit deeper into what we could be expecting in the slowdown and the potential slowdown in the current quarter. They will detail that on their earnings call in just a little bit. But overall, it looks like the street is relatively pleased with these numbers. We're seeing the stock up just around 6% in after hours.
All right, Shauna Smith with the latest on Nike. And, Jen, Shauna mentioned it in the release, Nike going through the impacts that they felt as a result of store shutdowns in China because of the coronavirus. And I don't know, I kind of look at this and I think it's probably going to be worse in the rest of the world. I know we had all looked at what happened in China in February and said, boy, that's real serious. That's a tough lockdown. Going to be hard to bounce back from that. But if you look at, what'd they say? 75% of their stores were closed in Greater China. Well, they got pretty much 100% of them closed here in the US and in Europe. And I think the impacts in the quarters ahead are probably going to be sharper than what we've seen.
Yeah, the numbers are not great. I'm finding it a little bit more appealing to look at some of the commentary inside the release from John Donahue, saying that we know in times like these that strong brands get stronger. And I think that's something that resonates with what we've heard from people like Kathy Wood from ARK Invest, or what people are talking about with big tech, being able to kind of capitalize in this environment. Nike reported that their brick and mortar retail sales were impacted, but their Greater China social digital sales were up more than 30%. So I know, again, the numbers aren't great, but I kind of am keying in on this idea of Nike as this strong brand. They think we've already gone through this one time now in China. We are well positioned right now to navigate, they say, the current climate here in the US.
All right, Nike shares again up about 6% right now after the company reported its latest quarterly report. And we'll be back here on Yahoo Finance Live in just a couple of minutes. All right, welcome back to Yahoo Finance Live. Miles Ellen with you here in New York. Let's take another look at where this market closed with Jared Blickery. And Jared, as the market was closing, you threw a bunch of superlatives into our Slack channel here. We've got the best day for the S&P in 12 years, the Nasdaq's best day in 7 years, the Russell 2000's best day ever. What stood out to you during this rally?
Well, Dow best day since 1933, and you see it right there on your screen, up over 11%. We do say this a lot, and it bears repeating one more time. We see the flashiest rallies during bear markets, and we are definitely in a bear market right now. The question is, does this have legs? And I said before, I think this has legs to go on, perhaps through the end of the week, maybe through the end of the month, which it gets into next week. But I don't think we've seen the worst just yet. So let's just take a look again at the S&P 500 here. And this is let's see, this is a 2-month chart. And we did manage to break out of this downward sloping, and it was a very steep downward sloping trend channel that we have here. So take that with a grain of salt. But here's the Nasdaq. It looks pretty similar here. What's notable is that we just barely undercut the low from a few days ago yesterday. And you look at the Russell 2000 and didn't even manage to take out that low. So that's why yesterday, 24 hours ago, I was saying I'm a little bit more bullish than I was on Friday. We were just starting to see some signs of life, and we're seeing that again here. Looking at the VIX, closed at 61. Is that high? Yes, it is, but not as high as it was even last week when it was in the 80s. And then the 10-year T-note yield, finally an up day again, up 5 basis points, but we'll take it. The break evens, the inflation expectation component of the 10-year yield has been up 3 days in a row now. So that is just pointing to the fact that I think the markets are seeing the Fed stimulus as it actually is right now, which is stimulus. And we're also seeing that reflected in gold prices. I did the same thing. RBOB gasoline, guess what? 44 cents. Not going to pay that at the pump, but that is the cheapest it's been since at least 2001. So here we have gold, best day since 2008. And I think that is pricing in the Fed right now. You can see these 2 huge candles here really stand out. And I think we'll see more of that as the Fed continues to pump a $625 billion a week. At least that's what it's doing this week. And then we take a look at the Dow heat map. Only one loser, which is a defensive play, our parent company Verizon right there in the red, down 0.64%. But you look at the Nasdaq, and this kind of plays into what you were saying before. The losers stay, and we're going to sort by performance. The losers in the bottom, Mylan, Activision Blizzard, Regeneron, Electronic Arts, Netflix, Costco, these were the staples. And it's funny to think that Netflix is now a staples play, but it kind of is if you think about it. And then you look in the upper left, American Airlines up 35.8%. We're going to see a lot of these big numbers because they are just coming off of some incredibly downtrodden levels. United right next to it up 25%, Ulta Beauty up 24%. This is a day trader's market. This is an algo-driven market. If you can stand the whipsaw, and you're a trader and you're an active trader, maybe participate in this. If you're a long-term investor, you got to be careful about these moves. You don't want to be selling the lows and buying the highs, and that's typically what retail does. And we'll just take a quick look at the sectors today. Energy up 16%. I think that's the best since the financial crisis. Industrials, that's the best ever, up 12.65%. And then financials. So cyclicals and values definitely outperforming here to the downside in the lower right. We got staples up 5%. Communication services have been doing fairly well. Those are underperforming today. And then healthcare. So, take it for what it's worth. I really can't say too much about this market. Then you got to take it day by day.
All right, Jared Blicker with the latest on how this market is looking after a historic rally here on Wall Street. Coming up after this break, we're going to talk to Andy Silver about his conversation with Connecticut Governor Ned Lamont. That's coming up right after this. All right, welcome back to Yahoo Finance Live. Miles Southern with you here in New York. Let's take a quick look at where the market settled on this Tuesday. Huge rally on Wall Street. We saw the S&P up some 9.4%, the Nasdaq up about 8%. Most of the action coming in the Dow, the blue chip index, up some 11.4%. As we heard earlier, its best rally in some 87 years, gaining 2112 on a points basis. Little nugget there for you Rush fans out there who might remember that one. But let's go now to Yahoo Finance Editor-in-Chief Andy Serwer to talk a little bit about his latest episode of Influencers. And Andy, your conversation with Connecticut Governor Ned Lamont. What can you tell us about that?
Yeah, I talked to him, of course, about coronavirus and the response on a state-by-state basis, and then also how states were responding vis-a-vis federal regulations and the tension that exists between what the federal government is saying and what states are trying to do. So here's what Connecticut Governor Ned Lamont had to say about that.
I think we need federal direction on this. And if your community, your state is less infected now, most experienced are, this contagion is spreading fast. And it comes across borders very quickly. Don't think in terms of states, think in terms of regions. So yes, I'd like the federal government to set a clear direction on the rules of the road there, and having everybody stay at home for the next few weeks when this thing is raging, when it's most contagious, makes very good sense.
I think the point there is that, the coronavirus, of course, doesn't know the difference between Connecticut and New York and New Jersey. And so he was working in concert with Governor Cuomo and with Governor Murphy, trying to get sort of a regional understanding as to what makes most sense when it comes to the health of the constituents in the region. And that's why, in fact, he was looking for, some understanding on a federal level. And, we're seeing these state by state things, crop up that, for instance, I think liquor stores in New York and New Jersey are considered essential and maybe not so in Pennsylvania. So people are driving across the border. Kind of reminds me of the old, age that you could drink back in, several decades ago. So interesting times, right?
Reminds me of my time at the University of Connecticut on a Sunday, having to drive to Massachusetts to buy alcohol because it was banned for sale in Connecticut on Sundays. But, it's something, Andy, that Governor Cuomo here in New York has talked a lot about, which is if I, pass a certain law or say something has to happen and New Jersey doesn't, I'm going to have people coming between the two states to get whatever it is they want. And it certainly seems that, given how the federal government has in many ways said, here, states, you guys do it. There has to be coordination, kind of on a regional, a sectional basis, if you will.
Yeah, and it sort of speaks to this, timeless tension we have in our system between the federal government and the power of the states. And it's so interesting to me that time and time again we come back to this issue, and this just brings it into sharp relief yet again. Fortunately, it hasn't gotten too bad, but it has the potential to be problematic as we move forward from here, Miles.
Yeah, you can feel the tension, at least here in the city, watching Cuomo's pressers every day. You can feel the tension, certainly from this particular state down towards Washington, D.C. All right, coming up in just a couple of minutes, we're going to have more here on Yahoo Finance Live. We are back right after a short break. All right, welcome back to Yahoo Finance Live. Miles Ludlam with you here in New York. We're joined now by Patrick Corcoran. He is the National Association, or he is with the National Association of Theater Owners. Patrick, thanks for joining us. And I want to talk to you about kind of high level here, the economics of running a movie theater. We've seen this business, among many others, come under pressure as the economy has frozen here as a result of the coronavirus. And we've talked to a number of folks in the restaurant industry. They usually have a couple of weeks of cash on hand. So really tight tolerances there for this kind of a shutdown. What are your members usually working with in terms of working capital, and how acute are their needs right now, given that most theaters around the country have been forced to close?
Well, it's such a diverse industry that it's really hard to sort of nail down what the cash reserves are for any particular company. We have billion-dollar companies, and we have mom and pops with 2 screens in a small town. But it's a very cash-intensive business. It requires the turnover of customers to keep that cash going through, to pay off loans, to pay off landlords, to pay suppliers, and to pay employees. So basically, it's a $15 billion industry that went to zero in about a week. So that's essentially where they are. Without that cash flow, without the infusion of liquidity, they simply can't keep paying their bills.
So for the movie business, and I personally, I love going to the movies. So just say that up front. But it was kind of in decline a little bit before with all the streaming stuff going on.
Well, I'm going to challenge you on that.
I'm going to say, do you think that's not the case, that the movie business is robust, or that there is some sort of secular issue happening that's making it more vulnerable right now?
No, it's very robust, and if you look at the numbers over time, you really get a sense of it. We've been over $10 billion for the last 8 years, over $11 billion for the past 4. And if you look at admissions, basically, we've been very stable over the last 5-6 years. It's been up and down based on the kind of product that was in the movie theater. But if you go back farther, if you look at 2004, right around where our peak was, if you look at $100 million grossing movies, we have more of them. They sell more tickets, they make more money. It's in that $50 to $100 million grossing kind of title, comedies, dramas that are star-driven, character or story-driven, not big IP productions. There we have fewer of them, they make less money, they sell fewer tickets. And the reason for that is the studios have stopped making them and putting them in movie theaters. And the reason for that is because what used to sort of sustain that was you'd have theatrical release, which would make a certain amount of money, and then the home video release would make more money. So you could cover any mistakes, any shortfall in the movie theater. But what's happened since 2004 is transactional home video has fallen by 62%, from $24.9 billion in 2004 to $9.3 billion last year. So they got out of that business. They couldn't sustain it. What we're seeing now with the rise of streaming, which is the thing that's actually killing the home video. It's not hurting theaters, it's hurting home video. With the rise of subscriptions, they have this huge competition right now among major streaming players, putting billions of dollars into the business, doing a lot of content, trying to get subscribers, trying to get filmmakers. And they need a way to differentiate that content. One of the ways to do that is to put it in movie theaters with a full theatrical release, which basically gives it sort of a brand name when it makes it to the streamer. So it's going to be a reverse of what we saw in the early 2000s, which was DVDs being a backstop to theaters. In this case, theaters are going to be a backstop to subscription and make money for them, but they have to get to the theaters first.
Patrick, you pointed to the diversity among your members, anywhere from sort of the big names like an AMC to the small local theaters. I mean, if this closure or this lockdown is expected to last another month, even a month and a half, 2 months, how many of those can survive? I mean, what do you see on the other end?
Well, we think most can survive, and that's why what's in front of the Senate right now with the relief legislation is so important, because what all of them are missing, no matter what their size is liquidity. They have to be able to pay those bills, pay those leases, and to get them over this period where there's no revenue coming in. And at the same time, we need support for our workers that we can't provide right now because we have no revenue coming in. So those two elements are really important, both for large companies with a loan guarantee package as well as the Small Business Administration loans that are going to provide liquidity to keep those theaters in business until our customers can come back. And that may be a few months from now, but that's why this legislation is so important. And it's not just movie theaters. It's any kind of public-facing business that right now is seeing, their foot traffic and their revenue go from, down to 0 or maybe 10% of what it was they had a week ago. And that's in small towns, big towns, every neighborhood across this country. And that's why this legislation is so important.
All right, Patrick Corcoran with the National Association of Theater Owners. Thanks so much for the time, and we'll talk to you soon.
My pleasure.
All right, coming up next on Yahoo Finance Live, we're going to have a quick look at how the market settled on this historic Rally Tuesday for the markets. We're back with that in just a couple of minutes. All right, welcome back to Yahoo Finance Live. Miles Levin with you here in New York. Let's just kind of go around the horn here for some final thoughts on this huge market rally. Jen Rogers, I'll send it over to you first. An 11% gain in the Dow doesn't come around more than twice in a century. I think we expected to see some huge moves here, but kind of hard to know how to proceed after a day like this.
Yep, we're going back to 1933. I mean, it feels a little bit like a sugar high here. I think a lot of people are skeptical about how long this is going to last, given that the headlines will continue to be rough. We've gotten some headlines after the bell. I mean, we had those Nike earnings, which I frankly didn't think were terrible. Some people were braced for something really bad, but we're also getting some headlines right now from Facebook. Facebook saying that while they're seeing engagement is up, their ad business is not. It's weakening due to COVID-19. And that's a theme that I think we're going to see from media companies. We already heard that from the New York Times, remember. People want news, but then the advertising component that goes along with that looks like that's weakening. And that's going to be a knock-on effect for a lot of companies. So I'll be looking at how that plays out tomorrow.
And Andy Serwer, just a reminder that, we have this shock and we expect there's to be a bounce back, but along the way, we are going to enter, we're probably already in recession. And even the biggest companies coming out saying we're seeing negative impacts from thing X. That's what happens in recessions. And I think it's a theme we need to get used to.
Yeah. And I mean, echoing what Jen said, I mean, it's hard to really see this day as anything other than just a gyration during a, frankly, very challenging time. And I've talked to some people today who are in the bankruptcy and distressed area, and they're busy, and they're going to get busier. And so make no mistake about it, companies are going to continue to report some tough numbers. They're going to be going through some tough times, and we're more on the front end of things than the back end of things. There's no doubt about that, you guys.
Yeah, it's certainly, it's just, it's hard to keep reminding yourself that there's such a long way to go when you have these kind of, one-off sugar high type days, as Jen said, but certainly there are going to be more challenges ahead for all of us, both in the market and I think most significantly and most notably on the public health side. Again, just taking a final look at this market, you see the S&P 500 was up some 9.4% today. The Dow up 11.4%. The Nasdaq higher by 8.2%. That's all for now from New York. This has been Yahoo Finance Live. We'll see you back here on the stream 9 a.m. tomorrow morning.